All right, welcome everybody to the finale of the 2025 TraderLion Trading Conference. That should be a tongue twister. Super excited about today's lineup, and just overall very happy and proud of how the conference has gone so far. We've had a tremendous group of presenters. Here is just a quick subset. Everybody's been fantastic, sharing their expertise, sharing their experience, and hopefully you guys have gotten a ton of great takeaways that you can apply tomorrow, next week, this year to your trading. So let us know in the chat right now who you've most enjoyed listening to, and maybe a few of those key takeaways. And also while you're doing that, let us know where you're tuning in from as well. We'll have a friendly competition about who's furthest. That'll be pretty fun. Here's a quick look at today's schedule. Again, a fantastic lineup here. Outside of the last presenter at 9:30 a.m. To kick things off, we've got Stan Weinstein discussing stage analysis in modern markets. We're going to go through a ton of case studies there. Then at 11 a.m., we've got a special one for me personally. Dr. Eric Wish will be discussing his key setups, the green line breakout, the blue dot of happiness, which is a new one, and also another new one, a daily 8 EMA bounce setup, going through a ton of examples of when they work, and also crucially when they don't work as well, and how to manage risk along the way. This will be fantastic. Highly recommend you guys watch this one. Then at 12:30, we've got Rohit R discussing the secret path of big money, mastering institutional buying in winning sectors and stocks, sharing his process. And then at 2 p.m., we've got an excellent presenter and educator, Matt Caruso, discussing timing growth stock leaders with market trends and sentiment. You don't want to miss this one. That will be fantastic. And then last but not least, to close things off at 3:30, I'll be presenting on finding and trading breakouts with relative measured volatility, sharing my perspective and experience trading VCPs and how to identify those pivot points, and crucially, how to save time when looking for those proper VCPs. So that will be hopefully very helpful to you guys as well. But overall, a fantastic lineup to close out the last day of the TraderLion conference. So let us know in the chat right now who you're most looking forward to hearing from. It'll be interesting to hear which ones you guys are most looking forward to. All right, and with that said, again, we worked very hard to make this freely available. I think it's a tremendous resource for traders, and in exchange, what we ask from you guys is to help us share it. So share the links on Twitter to the streams. You can scan this QR code and it'll create a tweet intent for you. You can also share it in Discords, wherever you communicate with other traders. I thank you in advance. And, we work really hard to make this an amazing educational experience and want to reach and help as many traders out there. That's our main goal. So please go ahead and give us a hand, help spread the word about the conference, both this year's as well as the previous year's ones as well. A huge thank you to NinjaTrader Live for sponsoring the conference. You can basically tune into NinjaTrader Live 6 days a week for daily futures trading, real-time market coverage, and actionable strategies. And you can scan this QR code or click the link in the description right now to learn more. A fantastic resource. If you're at all interested in futures trading or just trading at large, this is a great resource to check out. So highly recommend you tune in to NinjaTrader Live. In addition, I'll probably be asked this question again today a few times. Yes, all these sessions are being recorded, and you can actually scroll back at any time during the stream to watch a presentation you missed or just want to watch back on the same URL that you're on right now. And also, it's available in the free educational course that we've created on the TraderLion website, which not only houses the recordings, but also the slides, presentations, resources, speaker notes that we're creating for each presenter, and not just this year's, but also all the previous year's content as well. So this is a tremendously valuable resource. It's available 100% free. You can check out the link in the description, as well as scan the QR code right here to sign up. Highly recommend you do this. This is the way to get the most out of the conference experience. And you also get access and free entries into giveaways of TraderLion Masterclasses and DFU. So if additional educational resources wasn't enough, you can win free stuff as well. So definitely go ahead and check this out if you haven't already. All right. I also want to mention a resource that we just created and published a little over a month ago now that we're extremely proud of, the Trader's Handbook, which is our debut book. Here's my copy right now. Really excited and proud about how this turned out. We've gotten tremendous feedback from readers. Over 13,000 readers have already picked up a copy so far. We've got over 400 reviews on Amazon, rated 4.9 stars. That's extremely rare, and we're very proud of that. And we honestly think that this can really help you accelerate your learning curve We worked tremendously hard to share our experience in the book, going back to Ross Haber's 30 plus years in the markets, sharing his experience trading with William O'Neill, managing his hedge fund. And also we've synthesized a lot of the key principles, tactics, entry setups that, I've learned, communicating and interviewing many of the market wizards over the past few years. So this is really an excellent book that can teach you the key principles and is fantastic whether you're new at trading or more experienced. There's something in this for you. And not only do you get this book when you pick up the book, but by sending us your receipt at TraderLion.com/handbook, you also get access to the free educational resource that goes along with it. And that comes with chapters going through in detail the content of each chapter. So there's a bonus resource that goes along with each chapter. And there's also additional bonus webinars, educational resources, and model books as well. So don't miss out. Definitely pick this up if you haven't already. Here's a nice review from Mark Minervini. The Trader's Handbook is a comprehensive encyclopedia for investors interested in learning the ins and outs about technical analysis and stock trading in general. Packed with explanations, practical insights, and real world examples, it also features a model book section showcasing historical stock market winners, highlighting their breakout points, key patterns, and notable price behavior. A great addition to any trader's library. Great to hear that from Mark. So go ahead and listen to him if you haven't yet picked it up. It's actually on sale right now in the US, 25% off on Amazon. So don't wait. Go ahead and scan this QR code or click the link that's in the chat right now or in the description. And again, each of the chapters covers one aspect of building a trading system. We talk high level, the key principles that are extremely important and shared among all traders, but also show how we personally apply it. For instance, if we're explaining setups, we talk about what creates a good setup, and then we show and share the ones that we specifically use and go into the details about how to execute them. So whether you want to learn about risk management, post analysis, doing trading studies, building a model book, everything's in here, screening routines. And I highly recommend checking out this if you haven't already. And if you've already read the book, let us know in the chat what you thought about this resource as well. All right. So with that said, I also want to point out that we have a ton of other free resources on TraderLion.com. This includes the Ultimate Trading Guide, the TraderLion Podcast Archive, educational articles, our blog, and much, much more. Definitely check out TraderLion.com if you haven't already. And if you want to go even deeper, we work extremely hard to partner with fantastic traders and educators to create amazing masterclasses where you can learn the ins and outs of systems. And for instance, you can learn station analysis from Stan Weinstein himself, who you'll hear from in just a few minutes, swing trading from Oliver Kell, trading psychology from Jared Tendler, market history from John Boyd, learning the blueprint for trading success. Each of these masterclasses are fantastic. The educators went above and beyond and created an amazing resource that is timeless for each of them. So definitely check this out. And again, if you've taken any of these classes, let us know what you think and which ones you would recommend in the chat as we go. If you haven't taken any of them before, the Swing Trading Masterclass is the one that I would recommend first. Oliver was fantastic in this, sharing his whole process, whole system, and I learned an immense amount in helping create this resource, and I know you will as well. So definitely check this out if you haven't already, and you can visit TraderLion.com/university. And right now during the conference, this is the last chance for this as well. All of these are 30% off. So if you've been on the fence, this is the great time to get these amazing resources at a discount. So definitely check out TraderLion.com/university if you haven't already. All right. In addition to creating this educational resource each year, the conference, we also try to do a great thing and help raise money for a great cause, St. Jude Children's Research Hospital. We are about halfway, a little bit over halfway our goal. We want to reach that and get as close as we can today. So if you haven't yet donated and have watched some of the conference presentations and have found value and gotten at least one key takeaway, which I know you have, this is the time to help us pay it forward and donate at least $1. So I want to see a lot of donations coming through the chat. Again, we take no cut of this. YouTube takes no cut of this. This goes right to St. Jude Children's Research Hospital, a fantastic cause, helping children going through terrible times and helping them get treatment and get access to great medical care. So please go ahead and donate if you haven't already. And, we keep this event 100% free, as I mentioned, but this is a way to give back and support the conference and support our causes as well that we care about. So please consider a donation to St. Jude's using the donation box to the right side of the stream. Again, even $1 is great, but $5, $20, that's fantastic. And if you do $20 or more, I'll give you a virtual high five in the chat shortly. So definitely go ahead and do that if you haven't already donated, please go ahead and do so. I'll be doing so as well in just a few moments. All right. Again, I also mentioned that in addition to this conference every year, we work extremely hard to make this YouTube channel the best educational resource for traders out there. This includes webinars with market wizards, the TraderLion podcast, educational tutorials, the Trader's Handbook webinars. We work so hard to, again, make this a place that teaches you how to trade for real, how to manage risk, all of that. And one of our goals this year is to reach 200,000 subscribers. We're getting close to that number, and you can help us reach that. If you haven't yet subscribed, definitely go ahead and do so. We've got a lot of great content yet to come this year, and you'll be notified first once you go ahead and subscribe. And also, if you've enjoyed the conference, please leave a like on the stream right now. That helps boost it and let other traders know about this resource. So that's a great way to help us out as well. But go ahead and subscribe if you haven't already, and leave a like on the stream right now. All right. So with that said, let's enjoy today's session. This should be fantastic. And I look forward to seeing you guys' feedback. Make sure you guys have your notebooks ready for Stan, and we'll be right back in just a few moments. So stay tuned. Take care. All right, welcome everybody back to the TraderLion conference. It's my honor to introduce the next presenter, Stan Weinstein. He needs no introduction, but I'll give one anyway. He's the author of Secrets for Profiting in Bull and Bear Markets, which is a foundational text for many of us. I'm sure many of you guys have read it. If you haven't yet, definitely pick it up. He's also the founder of Global Trend Alert, which we'll talk about at the end, where you can hear Stan's updated thoughts every single day and week. So Stan, first of all, thank you so much for being here. Looking forward to this. Awesome.
My pleasure, Rich. We work well together. We've done this before. Let's do the best again.
Yeah, sure thing. I want to start with the current market. Here's a label on the chart for those of you. We did a podcast back in March. We talked about the correction, the signs during this period right here, the choppiness that broke down here. We didn't know the next leg down was coming, but I'd love to hear your thoughts about how the correction unfolded and how you saw things during the recovery. And of course, now we're in a strong trend. Things have flipped, but it's still, split, 60-40 maybe. I'd love to hear your perspective. So start us with this correction, this next leg down.
Right, well, it came right on schedule. You can see when we spoke, the market had already broken its long-term moving average, had a failing rally. You got it right back up to the MA, and then all heck broke loose as it got hit hard. But then we really smashed, even more than you see in the averages. Stocks got decimated into that early October oversold low. And at that point, where I really thought we are going to probably see a double bottom, it was so oversold that you had a quick V bottom, and that's when we turned not long-term bullish, but intermediate-term bullish on that day. I remember it was in early April, and you had that sharp down, and it closed up on the day. They really shook the tree good, and that was the start of what we had since then. So great, you're in a good intermediate-term uptrend. But this is a terrific time that we're doing this review now, because This is not a normal A to Z monolithic bull market. It's like you alluded to, because you know your stuff. I call it a 60-40 bull market. And if you're in gear with us with the 60% that are in stages 1 and 2, it's very rewarding. But at the same time, if you're holding in what I call inferior merchandise, in the stages 3 rolling on top, the stages 4 which are getting hit, you're not happy and you're not living the bull market dream. So it's a very challenging market, but it makes our technical approach more important than ever.
Absolutely. And to go a little bit more in detail into this break, you mentioned in this podcast how if we broke this low quickly, it could be a lot more rapid, the fall, which ended up happening. Could you talk us through, in terms of stage analysis, did we break into a stage 4 here, and when did that kind of transition back into a stage 1, stage 2? Walk us through from stage analysis perspective what kind of happened there.
Right. Well, this market is moving so quickly, it waits for no man, no woman, and no stage. So
Yep.
yes, for sure, you were in stage 4. But here's where I think our approach is so helpful, because instead of getting stuck on trend ratings, whatever, when you have, like we had, I'm trying to remember, I think it may have been April 2nd, but it could be off a day or two. When you had that reversal day, it was so sharp, you didn't know at that point, oh, you're going to have this long-lasting rally. But on that day, I did have clients start to cover shorts and start to put a toe in the water on the long side, because you knew a good reversal was occurring. And then as you went by, you saw after that sharp up, the next down didn't even come close to that prior bottom. And the number of stocks at that point hitting new 52-week lows was so far below the extreme that you had. So it was clear that, okay, now short term was migrating into an intermediate term advance. It became even a longer term stage 2 when you then gapped above, you can show them there, the 200-day moving average, boom. And since then, it's been utopia. But again, it's only utopia if you're in the right stocks. I can't tell you how many even supposedly sophisticated market players are holding what I consider to be inferior merchandise, and it's very frustrating because this is far from a monolithic advance.
Yeah, excellent. I want to get to you've got a list of buys and sells that we'll get into. Any last thoughts about the general market? Or actually, I want to bring up maybe a few names as well as that we covered last time.
Sure.
We've got NVIDIA. We talked about this when it was, it was pretty close to breaking to stage 4. Obviously, the stage 4 didn't last too long. Could you interpret the price action for us here, where it bottomed with the market and now is actually breaking out into new all-time highs?
Oh, yeah, absolutely. Show them. And this is the beauty of the system. Fundamentalists don't understand. Say, oh, look, the chart was wrong. Not at all. You can only deal as best you can deal as the cards come out of the deck. It's a probability game. So you take a look and show them, Rich, it broke down and it got clobbered. But then, look, you actually had a classic little reverse head and shoulder bottom. Although it looks a bit like the Hunchback of Notre Dame there, you can show them there. And that told us, okay, you want to cover your short. We had been short at that time. You want to cover your short, fine. And then when you show them that upside gap, when it moved above, right there, above which moving average is that?
So this is the 50, everybody. This is the 200-day moving average. Yeah.
Right. So when it not only moved above the 50, but look, each card that came out of the deck was textbook perfect. First, you caught that double bottom. Boom. Then you not only moved above the 50-day, but look how you gapped above it. Then look after you gap, when it tried to come in the next 1, 2, 3 days, looked like it was magic. Each time they sold it off, it held perfectly at the 50-day moving average. And after that, it was bombs away in the upside. And then, the good intermediate turned into a long term, show them again the upside gap. Gaps are important. And note, you have starting at after that short term double bottom, which had a gap. Then you had a second gap at the 50-day. Now you have this third gap. here at the 200-day MA, that's a sign of just how powerful the move is going to be, because gaps are very meaningful, and if they don't get covered, which you see, each of these gaps were not covered. It didn't come in and go in there. As long as it doesn't do that, that's perfect. And you had a textbook example.
Yeah, excellent. And I'm glad you pointed out the gaps, because it's amazing how many there are in this trend. And as you've mentioned before, gaps equals tiger in the tank, especially if they don't get filled. Any thoughts on the current trend? Obviously, if you own it, it's in trend. Maybe there's nothing much to do. What would be the first sign of worry for somebody? Maybe more of a trader perspective to trim some. Yeah, please.
That's why I love working with you. You're 2 steps ahead of me. Take a look. First of all, separate the short term from the long term. The long term is a thing of beauty, a joy to behold. The short term now, you have a little potential double top forming, and show them that little bottom 1, 2, 3, 4 days ago, right there, right. Let's catch exactly what that low was.
So that's 164.58.
So let's go on that, like round numbers, under 164. So to me, it's very simple. I'm not telling people if it breaks down, blow the position, but for sure, if you care at all about trading, and even if you're a long-term investor, in this market that's so incredibly volatile, even investors have learned that profit taking is not a dirty word, and with these sharp moves, it's good to take some chips off the table. So if you double top here, you can't go close at a new high, and then you close below 164. Never a guarantee, but I know what I'll be doing. It's just like I always come back to the blackjack analogy. I don't worry in that particular hand. If you've got 11, the dealer's got 6, you're going to double down if that hand is wrong. But if you always do it, you're going to be right the great percentage of the time. And it's the same thing here. If you do a short-term double top and a little hint, show them, Rich, that this was the first gap right off to the left of that little bottom. This is the first gap that was filled the whole way up. So again, if it closes cleanly to new high and it starts running, God bless. But again, as long as people understand, I'm not talking long term here, but I am talking as a disciplined trader. If you double top, you can't break out, you close below 164, take some off.
Yeah, those are great subtle signs there. Any thoughts on the semiconductors as a group itself, because they've been very strong the last few months, but anything you've been noticing personally about it?
That's been one of our top 2 or 3 groups. The semis have been fabulous, and even now some of the semis are extended and some are terrible, like Intel blew up today, but there's still some good looking semis. But in general, I would say that the group is a long-term hold, short-term, except for a few like AVGO looks like it could break out again here. Except for a few, I think it's a good hold, but I would look to do new buying in some of the stocks that we'll talk about tonight that look like when we put out the semis a couple of months ago.
Excellent. Well, let's go ahead over to those names, and I'll run you through the tickers here. So first of all, we've got AD&T. So we've got a longer-term downtrend, but recently looks like a changing character. How are you interpreting this chart, Stan?
Right. Okay, show them again. You had sort of a reverse head and shoulder. That's one, off of the bottom. Then you moved above, and that formed the stage 1 in there. Then you moved above the long-term moving average and moved into stage 2. And after the run-up, it tried to correct it. It didn't come back close to the 200-day MA, which is very encouraging. And now it's going through another consolidation. So at this point, it's a strong hold. But if it were to break out again, show them like there's a straight line above the recent highs. If it closes cleanly above that, I think it's going to run again. If not, and this is the beauty of the system, while it's long-term bullish, if it doesn't break out and show them that little low about 5-6 days ago, if it breaks below, go a little to the left, that's it, you nailed it. If it breaks below that low, hey, take a few chips off, it'll come back then to the 50-day MA. So really, as wild as this tape has been, And I've been playing this game for a lot of decades. This truly is a fast-moving, quickly rotational wild tape. But if you have the proper discipline and you really set the game in its proper perspective, even in this kind of volatility, you can still do very well. It's just a matter of don't overthink things. Always make a good probability bet. And don't worry about being wrong. We're going to be wrong sometimes. That's life. Just go with the odds.
Excellent. And say we had an inside bar tomorrow, and then we try to break out through this line of resistance. Would your stop be at this prior low, or would you move it to maybe this prior swing low? Swing low here, a little bit higher.
It depends who I'm talking to. If I'm talking to a day trader, a 2 or 3 day trader, yes, I'd press it. If I'm talking to somebody who's looking for the next 2 weeks, I would go, it's not that far away, I would go at that main point. But again, each person, I say this over and over again, should buy and sell to the sleeping level. So if somebody is a very nervous trader, do half and half. Half under the first one that you showed and half under the second one, and that's it. And the more mechanical and disciplined, well, you know this already, Rich, that you can become, the more successful you'll be, because you have to know our head is often our worst enemy as we start to overthink things.
Excellent. And we've got the next one, AGIO here. And by the way, for everybody, the industry is right here as we bring up these stocks. So this will show the industry as well. So this is biotech, AGIO, Stan.
Good. And there's so many bios now on the wrong side, the long side of 3s and 4s that aren't working. They're almost everywhere. It's not specific groups, although like a lot of insurance stocks are very negative. But on the buy side, it's interesting. It's a lot of my small to medium biotechs. I've had so many, it's unbelievable. It's aerospace. That's been another real good group. I also see casino stocks coming on here. It's also been solar. They've been very good, although short term they're going through a little correction now. It was my gold stocks. But to show you just how divergent this tape is, I don't know if you can show them 2 charts. See if you can show them the chart, Rich, for RGLD gold.
Yep, here we go.
This is why I'm telling you the system, I think, is so important. Gold has been acting well. Look at RGLD. It's had downside. It rolled over, made a stage C top. It had a downside gap. It looks terrible. And you don't want to be in it no matter what you think of the group. Now let's show them Newmont, Nancy Eddie Mary.
Yep, there you go.
Now look at that. That's breakout. You would think that it's a totally different group. So this is why it's one thing to talk about, yeah, we're in a bull market, but then there are good groups and bad groups. Now you not only have to separate the groups, but this tape is so crazy, even within the groups, you have good and bad happening. So the discipline is so very important.
Yeah, excellent. Anything else you want to mention about AGIO? We've got bottoming action stage 1 here.
Yeah, it's a good strong hold. And if it would go topside and close above that high of 3 days ago, I think it's going to run again.
Excellent. All right, next up we've got BWXT breaking out of a nice short-term consolidation today. Looks good.
I just sent this to you tonight. I felt it was very timely. When we went through the charts tonight, it was like, oh, it's first happening today, which some of the others are a few days away already. So this looks real good. And working it from here back to your horizontal line there, I think it's a good risk reward. I like it. And again, also show them how when it had that breakaway gap by the 200-day moving average, it didn't come close to trying to even cover it. Then you have that second gap right there. It didn't cover that also. This has its tiger in the tank.
Yeah, and this is one of those aerospace names you were mentioning. That's been a strong area.
A good group. And that's another thing. I wrote in my book years ago, and people say, Stan, you wrote that book back in 1987. Is it still valid? Yes, they've obviously sped the game up, no argument. But supply and demand will always be supply and demand, and psychologically, fear and greed will always be fear and greed. So it's still the same thing, but the game is going so much faster. So as I wrote back in my book then, I said, it's what I call my forest of the trees approach. First, you want the market forest to be bullish, then you want the group to be bullish, then you get the trees in the group. But here you see that the groups, if you have two equally strong charts, but let's say one was in insurance, which is a bad group, but it could have a good looking chart, and the other one's, let's say, in aerospace, which has been dynamite for us, or biotech, go with the good group. Each thing is an incremental thought on your part to get a little closer to perfection, although we never achieve perfection.
For sure. All right. All right, next up, we've got CDNS. This is a software name breaking out of this base here. I'll draw the line across. How would you analyze this one, Stan?
Again, look at it. It was perfect. First, it did that hunchback of Notre Dame, head and shoulder, little bottom back there. Then it did the gap. Then it moved above its 200-day AMA. But this one was interesting. This one was weaker, which tells you something. So that's why it's so important to take a few chips off the table when you screw up there. You know, when you made that little breakdown after that little double top, you know, there. Then, yeah, right. Then it came down, it held the 200-day AMA on a closing basis. Then look, it came down, it held the 50-day AMA, and now it's starting to get its oats again. And I think that it looks like it's getting ready to go. And if you'll note that the volume in the latest session was also positive, that's always another little positive hint.
Yeah, and I think that was a big takeaway from talking to you recently is obviously overall more stage one setting up here, but it's starting to respect the moving averages. It broke through them and now is respecting them and holding at the 250 and then here at the 50. And I think that's one of the key things to look out for when a stock is potentially ready to start a stage two uptrend and get really into the momentum move is when it starts respecting the moving average. And then obviously it set up that nice pivot today. And I really like yesterday, a really tight day on not no volume, but a very tight day overall, a lot of contraction and then nice expansion today on the breakout, as you pointed out, on big volume.
Rich, I told you that's why I love working with you. You know your stuff. So you're teaching along with me. That's
Yep.
all valid. That's what people have to get. I don't want to be a wise guy and say, oh, the game is easy, because it's not. But it's not as difficult as so many people make it. You don't have to spend hours wasting your time reading the Wall Street Journal, which, forget it, I think it's bad on a lot of levels. But in listening to the so-called quote-unquote experts on the CNBC and Fox News Channel and all that, Fox Business Channel, the bottom line is, if you just go and lock yourself in the room and quietly look at the charts, they'll talk to you. Not only the individual stocks, but you also get messages like when you see how many stocks first on that early April day had the key reversal days, then how many when they came in refused to confirm and come back as low. That was a hint. Then how many thereafter started moving above their 200-day moving averages. Each of them become part of the story, that chapters in the book, and if you put it all together, you'll end up at the end of the book being happy.
Yeah, and Dash is a good example because there's a lot of names that ultimately started really nice trends, like Dash, let's see, Palantir as well, where they held above the 200-day moving average on this base here, Hood as well, and they found support there or above it, and those were the ones that really started this super strong trend and acted really nicely. So that was a good thing to look out for.
So right, and look how this one never even pulled back close to its 50-day moving average. That's a sign of super strength.
Excellent. And this one, is it a bit extended now? Would you be taking some off on this reversal day?
No, because you just go to 4 days ago. Your trading stop is so tight. Why should we guess? Okay, I think your instincts are right. It's probably 60-40 making a scalping top here. But it'd be one thing if the inflection point were 30 or 40 points lower. But you're so close here, you could turn out to be very sorry one good day and you're suddenly breaking out to a new high, and then you're going to kick yourself. Why did I do that? So even if it goes against us, I like to do things for a reason. That would be a reason.
Excellent. And I wanted to go to a weekly really quick on this one. This is a great chart to look at. We obviously had a big disappointment after the IPO, formed a long stage 1 base here. Anything of note on the weekly in terms of stage analysis? Here's the stage 2A breakout, and it's been in a strong stage 2 uptrend ever since. Anything else you want to add here, Stan, on this weekly of Hood?
No, just what you had said. I used to say when I was on the seminar circuit many a day ago, the bigger the top, the bigger the drop, the bigger the base, the better the move. This had a beautiful base. It was like a foundation under your house, and it's not surprising that it's been a big winner. And the other little subtlety, show them how the 2 times that it had that temporary break on the way up of the 200-day moving average, each time, number one, the moving average was rising, so you got to give it a little more credence. And number two, both times it did not close below the 200-day MA. They shook the tree, they scared the people, and in case one, and then go up higher in case two, in both of them, they closed near the high of the day. That was, again, there were all these subtleties. So many people just look at a chart and say, oh, it's a good chart, it's a bad chart. If you really learn to listen, I don't mean to sound mystical, but it really, the market and the charts are talking to you. And if you're just open-minded and you hear the little things that it's whispering in your ear, there are a lot of little subtleties along the way.
Yeah, it's basically the opposite of a key reversal bar to the downside, where it's showing significant support at the low of that base. And then would you be watching basically for the next entry, the move through a moving average, line of resistance? Is that what you'd be waiting for?
Well, there are so many things, but yes.
Yeah.
Also, after the first time we made the false breakdown, you've had that little reverse bottom forming, like a little reverse head and shoulder. And then when you broke out above the horizontal line there, you had a hell of a trade.
Yep, excellent. All right, let me jump back to the buys here. And here is Dash on a daily. This is the recent base during the correction. Now in a strong trend, pushing through these highs today. Anything you want to add on this one, Stan?
No, it's just a good-looking chart. And this is another thing that's important. As you get later in a move, it starts to become increasingly selective. When we initially came off of that early April bottom, well, you should never do this. You could have literally thrown a dart and almost everything worked because the market was so oversold. But now it's kind of like an aging athlete. Now he doesn't have the same sprint in his move or whatever, and you see that not as many stocks are showing as good action as this Dash is. So we have to be more disciplined and selective than ever as you get further into the move. And I think this is a good short-term and long-term look.
Excellent. All right, next up we've got EW Edwards Life Sciences. We've got a big move up today on volume, but a close off highs kind of in the middle. How would you kind of analyze this one, Stan?
Well, first of all, I'm glad that it didn't close at the high. It wouldn't be buyable. I think that it got a little ahead of itself, and now it shouldn't come back to today's low. That would bother me. But I think it's going to flag in the next day or two a bit. And again, you can do some long-term buying. I would put a stop under Thursday's low, just 2 days. That you're limiting your risk, and the upside, could be quite interesting because number one, look at the dynamic action. Number two, look at the volume, which is the highest it's been in a heck of a long time. So volume, price action, it looks, and the group is good. I think that it has a good risk reward.
Yeah, a nice stage one base coming here and first popping through the moving averages. So excellent. We've got GTX next.
Right, and this has been another winner for us. Initially, it broke out from that little reverse head and shoulder bottom when it was first recommended. Then it had that nice run up. Then when you had the downside gap there, traders should have reduced. It came in even sharper than I expected, but it turned around. Again, you made that little breakout of the horizontal area right near that right there, and you're running nicely. And I think it's a good long-term hold. I think that it's acting very well. There are so many of these. If you just stay with the charts that are acting well, there are so many that are still being so positive. It's just when we'll show them later that it isn't all roses here, that there is definitely some thorns, but right now it's a good looking chart.
Yep, and I think people will be interested in what you have to say about the Tesla chart that you put in the sell category. So we'll see about that. Next up, we've got Generac, which again, super strong bar up on this day and breaking above the 50-day moving average, supported at the 50 after it gapped up above it, and now is above the 200-day moving average and poking its head above this mini consolidation here. I'll draw in the line. Anything else you want to add here, Stan, on this one?
I think you've summed it up perfectly, and this is why I sent you what I felt were timely stocks, because some of them that early in the week when we spoke, they've already shot to the moon. Others, a few of them have fouled up. But here, these are timely patterns, and not only do I want people to look at this and say, oh, I'm going to buy this stock or that stock, but I'm trying, as I've used this analogy so many times before, I'm trying to hit tennis balls. So they're practicing their forehand and their backhand, and they're seeing themselves, what you and I see in the charts, and they see, because so many people, it amazes me, without naming names, even so-called chart reading experts that I'll often see on TV will be saying something that gives me the shudders when I see them looking at a chart and saying, oh, here's a good looking chart. And I'm saying, that's not a good looking chart to me. I want to train everybody's eye so they really see what a Picasso is, and they focus on these good looking charts. And then if one or two don't work out, but let's be honest, nothing in life is going to be perfect. But I think if we follow the good discipline, I think we can be right 8 out of 10 times, and the 20% we're wrong, that's just the price of business.
Exactly. All right, next up we've got INSW, which is setting up a spot right here. Again, longer term downtrend transitioning. You've got the inverse head and shoulders here, and setting up this spot. Is that the pivot that you're looking at, Stan? This line here.
You've nailed it perfectly, Rich. And the other thing, I purposely put this in here because this is a hated group. Okay, it's not one of my hot groups. It's oil. It's a hated group, but I think when you start to see stocks in a group like this, which people have hated, start to shape up, it could be an early indication. So if it breaks out, I think it's worth adding to the portfolio as a hedge, and they may be getting around to this because at some point you can only take, at least on a trading basis, Google so far, and the alphabet so far, and they'll want to be looking for new merchandise. So I think if this breaks out, well, it's certainly not a day trade, this could be a very interesting thing, and it showed them not only the short-term little head and shoulder, look at the whole chart, Rich. You've actually got a giant reverse head and shoulder bottom. Show them that.
Yep. And you've got a little subtle gap right here 3 days ago. Yep.
Right. I think that's, and I'll be honest, I didn't see it the first time. It looked interesting to me, but now that I study it on this blown up chart here, I first see the long-term potential head and shoulder bottom, and again, the bigger the base.
Yep, and I'll show the weekly just to show that a little bit more clearly.
Right there. So clearly, Rich.
Yep, excellent. All right, next up we've got Lunar. Here's the weekly, but let's go to the daily here. Let's see. Are you watching this pivot right here?
Yeah, absolutely. If it now can close above Thursday's high, I think we could have a little run there. And I like that it held at, I guess that's probably
the 200.
Yep. Yeah, it held at the 200 and it respected it. And now if it closes above, I think it'll run right into, on the left side there, you'll see where it had that breakdown right at the 50-day moving average all the way to the left. I think it'll run back to that resistance rather quickly.
Yeah, interesting how it's holding the 50 here. Look at that, and you've got demand bars, upside reversals off that level. That's interesting.
Look how many times it did that.
Yep, exactly.
The subtleties that we want to pay attention to.
Yep. All right. Next up, we've got JBI, Janus International Group.
It's getting ready. You take a look, the 200-day moving average hasn't even quite leveled out yet. So it's still a little early, but I think that this is going to be turning in the weeks ahead. So you can do initial buying when you go above that high of probably 2 weeks ago. And then when you see it'll probably come back a little test, and you'll see the 200-day MA maybe 2 weeks from now start to turn slope up. That'll tell us that it's on its way. So this is still early in the game, what I call a stage 1B, late in the stage 1Bs.
For a stage 1B to really look ready for a stage 2 uptrend, do you want the 200-day moving average to be uptrending ideally? This one is a pretty sharp transition from a downtrend to an uptrend, but are you looking for that moving average to start sloping up to really get interested?
Yes.
Yep. Awesome. All right, next up we've got KMT, Ken Metal, and we popped above the 200-day moving average nicely. Looks like it's trending here. Any additional thoughts here, Stan?
Look at how it respected it to the silly millimeter. After that breakout, it held exactly there. And then the next couple of times it even comes close. So it's obviously not a quick trading stock, but it's another good long-term investment. And this is why I remain, as I have been for quite a while now, moderately bullish on the market. But I keep emphasizing I'm bullish, but understanding it's a split tape. So rather than being 100% A to Z bullish, hey, it's like we said earlier, it's 60% bullish. And if you're in gear, you can still be doing very well.
Excellent. All right, next up we've got MTW. And yeah, look, I'll draw this line right here. How are you looking at this one? It looks like a nice recent pullback to that pivot. What are you watching for now?
It held right at the pivot right, and now if it closes above that little high there, that you got it, I think it runs again. And when it came down on the pivot, it didn't even come close to the 50-day moving average. Again, there are so many of them, but I tried to show tonight things that I felt were relatively timely rather than just ego stroking and showing, oh, we had this and the thing has gone to the moon. I want to show things that I think are actionable in the days ahead.
Yeah, and I like after earnings here, it had a powerful move higher. These 2 bars in a row through the 50, through the 200 there. And yeah, now setting up this beige within the stage 1, getting ready for stage 2.
And look how it came close, but failed to cover that gap after breaking above the 200-day MA. Go to the little left, yeah. Look at how it held right above that. It's like magic. And I've said this before, but people who may just be seeing you and I do this for the first time, gaps that aren't covered, probably I would guess something like 80% of most gaps get covered. But gaps that don't get covered lead to powerful moves. So that's another important subtlety.
Excellent. All right, next up we've got MLI, Mueller Industries.
Another good-looking chart. This one's, from when I gave it to you early in the week, it's had a bit of a move. So I'd buy this on a pullback, make a little line across the basket above the breakout there. So flagging in toward there, I think that's a good intermediate term buy. But don't buy it right here because it's had a bit of a move in the last 4 days or so.
And on that pullback, you're looking for a decline in volume overall on the pullback, or does volume not matter too much?
No. Declining volume makes it better for sure. That's a good sign. And this is another thing. We're always in control, Rich. Let's say it comes in much more than we expect, and it doesn't hold at your little line there, but it can't, forget about an inch, but it comes well inside. Forget it.
Right.
Move on to the next one. There's always another taxi coming along.
Yep, there's another table to play. Perfect. All right, we've got NTES. This has been trending nicely. What did you want to focus on here?
Okay, I like China. China is undergoing a correction right now, and this has a little correction, downside gap, so let it come in. But especially if it holds at that last gap, look to your left. I'm guessing it was probably about 132, 133. See if you can see what the highs were on those days.
Am I at the right gap here? What, right here?
Yeah.
Yeah. So this high is 13.50 flat.
Okay, so let's say 1333. If it's you see it holding near there and it starts to turn up, I think that'll be a good investment point to go in.
On a pullback, are you typically buying as it gets to that level, or as it shows strength and pushes off that level typically?
Pushes off. Okay, I want to see that I'd rather pay a half point more and see that it's not crashing below it.
Excellent. All right, next up we've got Oklo. This is a fast mover here. What are you watching for this name?
This has just been a dynamite stock all the way. It's in a good group, and if we could now go topside above yesterday's high, I think it's a buy again.
Excellent. All right, a lot of tennis balls being thrown at people. We've got Sky W. Nice little consolidation here. I'll draw this line across. Anything else you want to mention here?
No, just that I like show them how the last 4 days or so the volume is sneaking in. You know, I like that. It hasn't even broken out yet, and you can see buyers sneaking in there. I think that's another subtlety. These are all subtleties that most people don't even look at when they look at the chart.
Excellent. All right, next up we've got SMCI. This has been a very sharp decline recently, but now is more stage one. What are you looking for to potentially transition this into a tradable stage two?
We're already in the stock. It's terrific, but I think that you can even do more buying on Monday if it breaks out above today's high. I think it was about 54 and a half. You close above there. I think trading wise, you'll run to that prior high in long term. Let's take a look at the long term chart. I think long term it could be even more spectacular.
Yeah, here's the weekly.
Right. And it's in a good group. So I think that it's interesting. And I like also how since it broke out above the 200-day MA, you can see it clearly on this chart. Look at how it's respected the whole time, the 50-day moving average.
Yep. Did you guys get involved on this breakout here?
Yes.
Yep. Awesome. All right, let's go to the next one. We've got MODG, Topgolf Callaway, and let me go back to a daily here. This is a nice trend, nice gap as well here, respecting the 200-day moving average, pushing off strongly here, and now in trend. Anything else you want to highlight here, Stan?
Yeah, it needs to close above that high. I think it's like $10 a nickel or something.
Yep.
Close above that, I think it's going to be a repeat buy signal. It's been respecting the 50-day to such a degree, it hasn't even come close to it. I think it's another good one, and I see, again, while it's not as dynamic volume-wise as the other one we spoke about, you can see a little bit of volume sneaking in, even while it's consolidating, which is encouraging.
Excellent. And this one, nice inverse head and shoulders here.
Oh, I'm telling you, that's what so many people missed. There was that reverse head and shoulders taking place in so many stocks when people were worrying about the tariffs, and Trump's tariffs are going to cause a bear market and make stocks go much lower. The market was singing a different song. You can see it in the charts. It was unbelievable. But then again, that's why I say it's good. When I was young and foolish, I used to proselytize and want everybody to be technicians. I've kidded around on the show before, and as I've said, I don't do it anymore. I don't want everybody to be technicians, because then who are we going to sell our bad stocks to?
Exactly. All right, next up we've got TT, Train Technologies. This one has been really nice orderly consolidation here, pull back into it, and then this is the sign of strength here that I think you're looking for off the pullback and acting really nicely the past few days.
Again, and show them 3 days ago that little subtle upside gap.
Yep, right here.
Right there, and it didn't come close to covering it. I think it's just a nice, beautiful Picasso.
Excellent. Yeah, I love this gap through the 200-day moving average. Is this something that you would buy here? This gap up here? Or would you wait for?
100%. Yeah. Again, as an investor, gotta be honest. As a trader, you think twice because it's a little extended. But if you're playing intermediate term, you're looking 2 months at a time. Not even a question. That's a stage 2A.
Excellent. All right, next up we've got Val here. Again, nice bottoming action, now above the 200-day moving average. Are you watching this high here or Thursday's high for
Thursday
potential add. Yeah,
close above that will be repeat buy signal.
excellent. Anything else you want to mention here? There's a nice transition from downtrend to potential uptrend here, and it actually lines up nicely with this line of resistance. I'll draw that in.
Again, look, you had that subtle reverse head and shoulder bottom in there, and I'm telling you, the market was not talking to us; it was yelling at us. And meanwhile, I can tell you, if you go back and you look at the bull bear figures, how many people were on the wrong side of the game there.
And this is another oil and gas name similar to INSW, so it'll be interesting to see if that group and area develops further.
Right, the subtleties coming in there, little buying sneaking in.
Excellent. Next up, we've got VRSN.
I think this is fantastic. Just unfortunately, it moved a little too quickly today, but any little pullback, I think this is a great trade and investment. And look at the volume that came in here today. Look at the beautiful parallel area it broke out of. It's great. So I think it'll flag in over 2-3 days. It probably, if I'm right, Rich, doesn't come all the way back to your line, but say it comes back maybe half to 2/3 of today's move. I think this is a beautiful thing to buy.
Excellent. And a question for you actually about how markets have changed. Obviously, we had the rule changes about how information could be disseminated, and now everything comes out on the earnings report. How did you have to adapt your trading and how you traded and entered names based on that change? Did you have to do that at all? Because obviously this move is after they had earnings, it looks like, last night.
No, you're 100% right. It wasn't a matter of having to change tactics. You just have to live with it. It was much easier in the 80s and going into the early 90s when we do know that there was shenanigans going on, and sometimes the accountant spoke to his brother-in-law or whatever. But people are being much more careful now because there's a real downside to inside information. So you do get these sharp moves, and I would say you have to be much quicker. You know, that's the reality. There's no waiting around. You got to be quick. And but the other thing that's interesting, back in the 80s when I was writing the professional tape reader, we had a whole string of issues that were takeovers. And, we even had a certain pattern where when you had more than 2 to 3 so much volume and it broke out, whatever, didn't know at the time, but a big percentage of them turned out to be takeovers. Now that's not true at all. There are a lot of times I've seen a negative, semi-negative chart on a Tuesday, and Wednesday they suddenly announce the good news of a takeover, and it flips the whole thing. So there really is much less inside information going on, and that's the way it is, and you got to adjust to it.
Just got to live with it. Yep. All right. Last of the bullish charts, we've got GES. We've got GES here, just poking above the 200-day moving average recently. And again, really nice bottoming action over the past few months.
Right. And this is why I purposely had Holly send it to you right before we did this podcast. If you take a look, it's very timely. It's what I call the stage 1B. It's late in the base. Everybody's hated it. Again, it had a reverse head and shoulder bottom. It hasn't done diddly in the bull market, da-da-da-da-da. And talk about everything to me is risk reward. Even if we're wrong, I would only buy it breaking out above that little area so you can get it. I don't remember, it's 13 and a half or whatever. What exactly was the high there 3 days ago, Rich?
That was 1372.
Okay, fine. So let's round it up to 1375. Close them up 1375. I think it's a good buy. And from a trading point of view, if then it reversed and went below today's low, I would take a quick loss and say, fine. Conversely, so you're defining your risk, which is small. Conversely, on the upside, let's look at a weekly chart and see where it could go.
There we go.
Gee, look at the upside. We could have, in the next 2 months, a hell of a move with that very small risk. This, to me, is a perfect, on a breakout, risk-reward stock. 1B about to become 2A. So it's great. And the other thing I like, when I mention it to some clients, they hate it because it's got bad fundamentals, it hasn't done anything. So that's good. I think the next part of this market move, you can see in the last 2 weeks or so, a lot of the stuff I put out, I'm not judgmental. To me, I just want to get good stocks and hopefully make people money. But if you really do step back and judge what's going on, there's a lot of stuff that's going that I'm recommending that are not widows and orphan stocks, and that's telling us something. We're getting later in the game. It's becoming more speculative, so you can play the game, but you got to know that it definitely is becoming, not as easy as it was when it was the first or second inning.
Yep, excellent. And a lot looking through the rest of the group, there's a lot of names that they've been in longer term downtrends, but now we're starting to see some potential rallies. Big move on volume here with AEO. They had Catalyst here. How is your view on the overall group as a whole, the apparel retail?
I think you've just done a great job. There are some that are already in stage 2, and there are a lot like you show me that are forming stage 1 bases. And the bottom line is, like, let's look at RL. Look at Robert Larry.
Sorry, give me a sec. There we go. Ralph Lauren.
And that's not waiting for anybody, That's been on our buy list, So I think the group is shaping up, and a lot of stocks, they're worried because brick and mortar is going out of business, this and that. A lot of the stocks are starting to come to the fore, and we're getting later in the movement. It's the old thing, every dog has its day. I think you're going to see a lot of dogs barking here.
Excellent. All right, let's push on to the sell list, and we'll start out here with Bro, and this is a daily chart of Bro. Below the moving averages, rejected at the 50 SMA in that area a few times. Are you watching this low for potential add to a short?
No, I don't want to short it here. I cover short here against that. I think it's starting to make a short-term bottom, but 2 things to accomplish. Number 1, this shows how when you've had a good short and you're in an area and it's starting to hold, you should take some off. And then if it closes cleanly above Friday's high, I'd cover the rest because you're good, Rich. Show them where you think it's going to jam to.
Right here, yep.
Right, up into that area, and it'll be a sale again. That's where it'll be a short again. So it's 2 things. 1 is showing how to handle the stock, the short. 2, it also, I just want to make very clear, they're going to see when we go through these stocks, if you only looked at some of these crummy, and I could have given you another 50, if you looked at some of these crummy charts that I pulled out, you would think you're in a bear market, but you're not. You're in a hedge market, and this is why following the system and being in gear is so damn important. Let's go to the next one.
Yep, excellent. All right, we've got CWAN here.
And look, I mean, since this broke this 200-day MA, it's been a horror show. And actually, if this one breaks down below its low, you take a look at the low there, I think this could immediately start another down move. But even if it doesn't, this is a stock you don't want to own. And it's amazing when you look at all the volume and so many of these bad charts, how many people are buying these inferior charts every day. To me, it's crazy.
Yep, excellent. And next up, we've got CRWV, which was pretty good to alongside since its IPO, but now is leaking below its 50. How have you interpreted this one, Stan?
Very easy. We interpreted that we sold it. The bottom line is it yet hasn't developed. It's not trading long enough to have a 200-day MA. But take a look on a short term, trace out for them. You'll see it yourself. A little short term head and shoulder top. You can shoot a line across there, a horizontal, slightly up sloping line, no, a little lower. Make it lower, off of the bottoms, off of the bottoms.
Oh, right here.
No.
Sorry.
Off of the little, off of, yeah, in this area, right. Go in there. Yeah, now you're talking.
There we go.
There you go. So you had a little head and shoulder. You broke it. So that's the first sign if you're in the stock. Hey, you made a lot of money. Don't be a pig. Start selling. Then look at it how if you shot your line a little to the right, the next rally failed right below your line, right at the line, and then you broke down. Now you're breaking the 50-day MA. Again, we have to understand. Don't overthink this. It's a probability game. You could sell a stock and suddenly, boom, they come out with good news, but that's a 1 in 10 shot. 9 out of 10, this stock in the weeks ahead is doomed, and I don't want to be long it.
Excellent. All right. Next up, we've got Costco. Here we go, breaking below the 200-day recently.
Another good company, bad chart. It's done its deal, and it also did sort of a slanted head and shoulder top, and it broke the 50-day, and now it broke the 200-day. And this is what people understand. The fundamentalists, as it comes down, will say, "Oh, this as it gets cheaper, it's a better buy." And I don't see it that way. To me, that's where they make a mistake. Oh, if it was a good buy at 500, it's a better buy at 450. To me, no. You want to buy strength. You want to buy healthy patterns. You don't want to buy something like this, which is first running into stage 3, into 4 trouble.
Where would this transition to the stage 4 for you?
Well, it's already in stage 3, and I'm out. But I guess officially, take a look at that spike. A little, keep going to your left, that extreme, no, a little to the right now, a little to the right. That's it.
Yep.
Below there, it's stage 4. But that's why it can be, fallacious to wait for that to develop. I always say, shoot first and ask questions later. Once you made the double top, once you broke the 50-day MA, once you broke the 200, you're gone, So don't wait for official ratings. It stinks. And we've got so many A's, why would we want to be in a D?
Yep, and the key reversal bar down here, the 50 SMA curling down, there's a lot of warning signs to be on guard for.
And that's what it's all about, which we're teaching them tonight, Rich, to look at these subtleties so the game becomes a little less mystical and hopefully more profitable.
Exactly. All right, next up we've got Docu here. Would you like it on a weekly or daily?
Let's do the daily first.
Yep. Here we go. Here's the daily.
Yeah, I like the daily. I think it's failing right now under the 200-day MA. And if it breaks below the low of the last 2-3 days here, I think it's going to start a down move. It'll have been a failure. And you can see, first, look at the big downside gap. Then when it tries to make a recovery, so far, look at how each time it failed near the 200-day moving average. And this is another subtlety. The 200-day moving average hasn't even rolled over and started down yet. That's still in its history ahead. When it starts to round over and start down, I think it's really going to have trouble.
Yeah, and I look at this chart and I just see all this choppiness. There up moves and down. There's no cohesion to it, and that,
right.
To me, that suggests weakness for me when I'm interpreting things.
Totally right.
Yeah. All right. Next up, we've got GoDaddy, GDDY.
Another one. Take a look again. ABC. First, you see A, where you had the failing double top back there. Go by, double top. Then a little breakdown, so you did some trimming. Then B, now you started breaking the long-term moving average. C, you came back up on the next rally and failed right there under the 200-day. And again, why would you want to own a stock like this? And meanwhile, there are so many bargain hunters and fundamentalists, and people are thinking, this is a great time to scarf up the stock. To me, it's ridiculous.
And not necessarily for this one, but when you're looking to short a name, are you shorting it at a failure of the moving average where it gets rejected from it, or when it breaks a line of resistance afterwards?
Both. Incremental. I don't like to move all or nothing. So the first thing is good, and you have very low risk, because if you're wrong and it closes above the 200-day MA, you take your small loss. But then when you see you're right, this is where people who are losers, they average down. We average up. When you're right, you start pressing your bet. It's really the same thing in blackjack too when you're on a roll. So the bottom line is, you did it right, and now it starts to foul up more, so you press your bet.
I like that. Press the bet in the direction of the trade as it's going in your favor.
It's going your way.
Exactly. All right, next up we've got GSHD, another insurance name here.
Right, and this is a bad stock and a bad group. And forget that it blew up on Thursday, but take a look. See, these things don't just happen. It's not usual. You have an A+ chart and suddenly it turns into a D. You look at a series of lower peaks, 1, 2, 3, 4 lower peaks. You broke the 200-day. There's no excuse to have been in the stock. You had one more finky rally that failed to even get quite back to the 200-day. It failed then at the 50-day. Somebody knew something, and then boom, Now, they must have, I didn't even know, they must have come out with horrid news, and the rest is history.
Yep, and just want to show the weekly here. Yep, you can see the lower peaks here on the weekly as well. 1, 2, 3, 4. All right,
Right.
next.
Look,
Yep,
I'm telling you, it's so clean. When people have learned to truly observe, it becomes an eye-opening event because they look at so many things that aren't relevant, and we're looking today at the things that are truly relevant.
yep, excellent. All right, next up we've got LOPE, and I'll bring it over to a daily chart here, and there we go, breaking below the 50 here, and now below the 200 day.
Right. Now, this is not developed enough that I'd want to short it, but it is something you sure don't want to be in it. Again, we're sharpening their eye. Look at how it was a good stock until you did the double top. Way back, you'll show them that double top. Then you broke down below. You got it if you drew a line there. Then you'll see when you rallied, if you had a line that failed right at that line, then it broke cleanly below the 50-day. Now you're breaking below the 200. It's a sequential game. You can see ABC. And to think that there'll be people on Monday morning buying this, to me, it's asking to lose money.
Excellent. All right, next up we've got ITJR, Integer Holdings Corporation.
It's oversold short term. It's likely to hold here against that prior low from a couple of months ago, which you show them there. It's right above it. But on a rally up, this is a sale. It's not a buy. And I don't even think it'll get up to the 50-day MA. I think it'll be lucky to. I think it's not even going to get to that high of 3 days ago or 4 days ago. No, 3 days ago. I think it's more likely going to run into trouble at that little break of, if you have over the air right there, just at that little bottom. I think it's going to run into trouble as it gets there. So you don't want to be in this stock. And again, we're sharpening their eye and we're showing them that this is not a monolithic A to Z bull market. And this is why you need to understand the stages and work with us to be in gear on a stage analysis basis.
And Stan, we're looking primarily at daily charts. We're looking at weekly as well to see both sides. But are you looking more these days, more at dailies versus weeklies? And how's that changed over the years, if it has?
Yeah, I'm definitely looking more dailies because things are moving so quickly. And for my day traders, I'm looking at minute by minute trades. But the market is sped up, so I'm looking more at dailies. But then when I'm doing my weekend work, like during the week, we go through a lot of dailies. But then before we put out the in-depth report that we put out every Sunday morning, then we're checking it against weekly charts. So that's where the weeklies come in. But on a nightly by nightly basis, you're looking at the daily action.
Excellent. All right, moving on, we've got ISRG, recent failure at the 200-day moving average after, looks like earnings. Now pulling in here. What are you looking for with this name, ISRG?
I'm looking for an oversold rally, and if anybody is unfortunate, they're holding this, they should sell it up.
Yep, excellent. And just scrolling out here, you can see this here. Recent gap down, rally into that area, can't fill it.
Look how it didn't cover the gap.
Yep, exactly. Perfect. All right, moving on. We've got LB here. Deep below the 200-day moving average. Short-term rally recently. You'd be watching for a rollover?
Right. Perfect. Had it perfectly. They probably came out purposely. They probably came out with news yesterday. I see the volume, but anyway, it doesn't matter. This is an example of if you're short, they should be ready to do reducing. When you're this far below both the 50 and the 200, and you get a sharp break to a new reaction low, and then it moves back above the low of which was Wednesday's low. So you move above Wednesday's low, even though it's a piece of you know what, you want to start covering your short. And I think there's going to be a good oversold rally here, which would give, if somebody is unfortunate enough to be long, a chance to sell it on strength. And if you're looking to short it again, there's a couple of plays here. You should be out now because I think there's enough is enough. And on a rally, maybe 2-3 weeks from now, failing up near the 200, it'll be a short again.
Yep, excellent. All right, next up we've got McDonald's here.
This I just want to show, here's a perfectly good company, just like we had the Costco, good company, but I don't want to be in this stock. I think that it's going to fail as it comes up into resistance, probably about 302, 303 up there. And then down the road, if you start breaking down, first it's below the 294, that'll be a more aggressive sell signal. And then if you come below the prior one, which I think is about 292, below that, boom, I think it'll run into big time trouble. So again, this is what we see. Don't get hung up on names, on beautiful stories. There's a reason why, we'll find out later on, the stock hasn't made a new high in a heck of a long time, despite this bull market.
Exactly. All right, moving on, we've got PEN, Penumbra Inc.
Yeah, this was a hot stock. And now let's follow the whole sequence from go to that black line where it made its ultimate high. At that point, you'd say, still a good stock. Then after that, look, yeah, you get a little finky action. Then when you start breaking below that prior low, you would do a little trimming. Then right there, right. Then when you break the 50-day moving average, you go, oh, I'm getting a little concerned. This is the second time, actually the third time you broke the 50-day. To use a crude analogy, it's almost like somebody having a repeat heart attack. So each thing is taking something out of the person. Then, boom, once the last time it broke the 50-day MA, it's done. And now it's broken to 200. So this is a stock you want to sell on strength. You do not want to be bargain hunting in it, that's for sure. But near term, it's oversold. It's going to have a PS rally.
Excellent. All right, next up we've got SKWD. Again, similar failure at the double top here, breaking lower, and now pulling into the 200-day moving average after breaking the 50 back here.
It doesn't break that low of Wednesday. You'll probably get an oversold rally. But the main thing, I'm trying to do two things here with these charts. One, to show people how many, and like I said, I could have given you dozens of more lousy charts. How many charts are there that are ready to cause you losses if you don't really understand your discipline? That's number one. Number two, to see this isn't a normal bull market, because in normal bull markets, you may have always a couple of charts that are a problem, but you have a plethora of so many of them that are a problem in a market that's theoretically, day after day, the S&P is registering new all-time highs. You got to know that's another subtlety. That's telling us something. We're getting later in the game. It's also telling us something that most days the new highs, even on the New York Exchange, are more like 80 or so, or 80 plus. In a really healthy bull market, we should be seeing 250, 300 new highs. You're definitely getting later in the game, but hey, we're all good enough. We can play it. We won't be the last ones on the dance floor, but we do have to know it's getting later in the game.
Excellent. All right. We've got Tesla here, which has been a choppy one. Recently had earnings gap down, try to push higher into the 200-day moving average right here. How are you looking at this one, Stan?
I purposely put it not because it was a screaming chart like some of the others, but so many people care about it, and I get asked about it so often by clients. So first, I don't like it. Look at three lower peaks. 1, 2, you'll show it to them. 1, 2, 3. There's 1, 2, 3. So already I don't like that. Number two, you see that the 50-day moving average is starting to round over. I don't like that. Number three, you see that it's edged below its 200-day MA. And now what we have to watch for, which would really put the kibosh on this, in the next couple of weeks, if the 50-day breaks below the 200, which would probably be 2-3 weeks from now, even if it's going to be bad, that would be really negative. And then, in addition to that, if you start closing cleanly below 300, which is near that low of Thursday, and the market always looks at round numbers, I think this stock could start to get itself into trouble. And even if it doesn't, why would I want to consider buying it when we have so many A ideas and this is a D? So I felt that this was important for us to look at. It shows us a lot of things, and it also tells us something to watch in the days ahead.
Excellent, Stan. This has been great. There are a lot of names similar. Let me bring up Palantir that have just been running for a while. Again, we're getting maybe a little bit later in the intermediate move. We'll see how it plays out. If you have this and you're more of a longer term trader, like to hold for a few months, how would you personally be looking to both try to capture any remaining trend, but also protect yourself if it does ultimately roll over and form another base?
Fine. Well, first of all, I'd enjoy what I've got, and I would put a trading stop for part of the position, and there's no magic level. I'm more aggressive, so I would probably put it 1/3 to 1/2, but some people may only do it for 20%. But under that low of 4 days ago, if you close below that, I would definitely start to take some chips off the table. I don't care what happens. That would be the first sign, like we have to make a move. Then if thereafter, which it hasn't done for months, if you at some point, Rich, maybe it's a month from now or 2 months from now, you close below the 50-day moving average and the moving average is flattening at that point, I get the hell out of the position. But we're looking so far down the road. At this point, it's good. You stay with it and you wait to even get the first little negative signal before you do any selling.
Excellent. Stan, were there any other charts that you wanted to go over, or is that pretty much it? I've got a few other questions.
I think we've covered the waterfront quite well.
Awesome. There was a really interesting question that we got from an audience member about any advice you have about protecting your health and taking care of yourself so you're in the right headspace and physical, health-wise, so you're able to trade for decades and have that longevity. Any thoughts there that you might share with people?
Yeah, again, I don't want to come across as some kind of expert. I just know what I do for myself. Number one, I've read it, I take a lot of supplements. Number two, I try to work out. I can no longer do aggressive jogging. At my tender age of 83, my knee barks up, now and then. But I work out on the treadmill. I walk with my knee well padded. And I think if you do some exercise, you'll also take some supplements. And once in a while, you do a little meditating and you just get away from the firing line because it is so crucial. And you get whatever works for you. You get out, you play a little tennis. I've never played golf. Some people are golfers. You just get a little diversion. I think that's the best you can do in this world.
And you might have mentioned it there briefly, but how important is it once you've done your homework, you've done your work for the day, you're ready for the next day, to get out, go for a walk with your significant other, get away from the screens a little bit? Is that pretty important as well to de-stress?
I think for sure. I think for sure. So much of it comes down to common sense, both in life and health and in the market. Common sense goes a long ways, and we just have to, again, have good discipline when we're playing the market. And we should also have, I'm not going to tell you I'm perfect at this, but I have pretty good discipline at, taking care of myself. So we try to have discipline for our health, and you do the best you can. I think life and the market are similar. They're probability games, no guarantees, but in each case, you just try to put the best probabilities forward that you can, and then whatever is. Excellent.
Well, Stan, this has been great. For those people who want to learn more from you and connect with you more, you obviously are working hard every day and every week on Global Trend Alert. I look forward every weekend to reading your thoughts. It helps both confirm what I'm seeing, and then I always have something new that I catch reading there. And it's great that we're offering it through TraderLion to subscribe to Global Trend Alert. Anything you want to add about Global Trend Alert, what your goals are with that, and what you hope to pass on to clients?
No, I just think that hopefully, I think that it's my legacy. I'm not bragging. Maybe I'm bragging a little. I can't tell you how many letters I've gotten over the years where people have said, hey, you've changed my life and thank you. To me, that's really great. And I think that's my ultimate legacy. But hopefully the legacy goes on for a long more time.
Excellent. Well, Stan, this as always has been great. Obviously, stage analysis is at the core of how I trade. It was one of the first concepts that I learned for trading actually by Dr. Eric Wish when I first got started. Any last words of advice for traders out there, either about stage analysis or trading in general?
No, I just think what we said before, stop making the game so hard, stop overthinking, just be disciplined, look for good charts, look for the little subtleties the charts are telling you. Don't listen to what your neighbor is saying or this and that. It's okay if your neighbor gives you a tip and you go look at the chart, you go, are you kidding me? Or if you take a look and you, oh, he's onto something. But really, at the end of the day, I always come back to that one word, discipline. If you're really disciplined and you try to keep your emotions in tow, I think the game becomes a whole lot easier and more profitable. So that's the best we can do.
Excellent, Stan. Thank you as always. To everybody watching, I hope you guys enjoyed. Check out Global Trend Alert. The link is in the description below. And stay tuned. We'll be right back with the next presenter. Cheers. All right, so let me stop recording. All right, welcome back, everybody. It's my pleasure and honor to introduce the next presenter of the TraderLion Conference, Dr. Eric Wish. Dr. Wish is an individual trader and professor emeritus at the University of Maryland. And many of you probably already know this, but for those who don't, he was the first person who I learned trading from. I took his class at the University of Maryland, and it taught me the key principles that probably saved me years off my learning curve. So I owe a tremendous debt to Dr. Wish. Really excited to hear his presentation today on green line breakouts, the oversold bounce setup, and the ADMA bounce setup, going through those, as well as how he manages risk and also his sell rule. So Dr. Wish, thank you so much for being here, and yeah, a pleasure to have you. Thank you.
Thank you, Richard. It's really an honor and a privilege to talk with you like this and to let other people hear what we want to talk about. It's every professor's dream that they have a student who goes on based on the course that they've taught and becomes another teacher and makes such a difference in the world, and that's what you've done. So congratulations to you and your family for all the great work you're doing at TraderLion. I know it wasn't a straight line. I know you started off in engineering and but found your passion in trading and in the stocks, and that's just fantastic.
Yeah, and I also want to mention just a huge thank you for writing the foreword to our book. That meant a lot. It's great to have you be a part of it because it wouldn't have happened without you. So thank you so much for doing that. And I also want to mention just a little bit more detail about the class. Obviously, I took that back when I was a junior at the University of Maryland. I forget the exact title of the course because you changed it a few times, but Intro to Technical Analysis and the stock market. And I went on to TA a few years, and every time I took a class, because I took it as many times as I could, including TAing, I learned something new. So really looking forward to today, and I think it will reinforce a lot of great concepts for folks, help out a lot of people who are doing this part-time, as I know many people watching are, and hopefully everybody will learn something new. So thanks again for your time, and looking forward to it.
Sure, and today, actually, I got an email from someone who's now living in New Zealand and is actively managing his money and trading, and he's did a fantastic job based on what, started off with what I started teaching. And so there are loads of people around the world who contact me and say, can I take your course? Even at the university, when I tell a professor what I'm teaching, they say, can I take it? Because as you probably know, in the United States, they don't teach financial literacy education. I think the only thing I got was in the 6th grade, they told me how to balance a checkbook. And
we didn't even get that, so you're a step above. Yep.
So I have, as you know, I am committed to teaching young people what I wish someone had taught me at their age. And for the audience, I am not a professional, big-time trader like a lot of the audience is. I had a career, and I still manage my money, and I've been able to retire, and I've done quite well in the market. But I've been doing this since the 60s when I was in high school, and I hope that there's people in your audience who want to still have a career and not be glued to the screen every day, because I wasn't able to. Now that I'm retired, I watch a little more, but sometimes that's a double-edged sword. Sometimes it's not helpful if you're always watching your stocks. So I'm trying to adjust to that now. But what I try and do is to teach people some tools they can use that I found useful, and basically you can take whatever you want. If there's nothing valuable for you, don't take it. And I tell the students, don't trust what I say. Try it out. See if it works for you. That which works for you, go ahead and use. So that's what I'm doing today. And I usually tell people that sort of in my advice, I'm not really giving advice, but if they think I'm giving advice, it's worth every penny that they paid for it. And by the way, I've never accepted money from that. All of the teaching I did at the university, the money was basically returned to my department to keep researchers going and to keep the research and substance abuse going. So anyway, I'm just extremely happy to do this. Is there any other questions you had, Richard?
No, I think that's good context. I hope that folks out there, especially younger folks, take a lot of this to heart and really looking forward to diving into the principles and setups that you use and continue to use that can help a lot of people get started. So let's go ahead and dive right in.
Right, and this is just the beginning. I mean, I hope it's okay to tell people that we're going to create a course. We're going to make it available to people who want to take it in the next year, and all the material that I'm introducing today will be done in much greater detail, and we'll be doing a lot of it in the software that you've created, Deep View, and I think it's going to be very exciting. So let me get going, because as I used to say when I present, I like to stay close to my data, and so you're going to see a lot of slides today. You ready?
Let's do it.
Okay, so this is just something, that's actually Enron. And I'm just saying all of this is educational. I'm not qualified to tell you what to do with your money. I'm just educating you to learn, to teach yourself how to approach the market and how to perhaps do quite well. You know, I just want to tell you, I was big into stage analysis, into the 30-week average. And way back, I know this slide popped up, and I actually bought a put option to bet that it was going to go down, but I hadn't done it before. I didn't stay with it. But I'm just telling you, just by watching the stock, it was possible to see that something was going wrong with it when it was entering a stage 4. That slide was done by my late co-instructor and IT person, David McCandless. He died in February 2022 when he and his daughter he finished teaching the course that with me, and then he decided to go with his daughter and to build a sailboat, and they showed us pictures as videos as they were building it, and they took it out one day in Baltimore Harbor, and the water was horrible. The wind was horrible, and I guess the water, and it capsized, and he died by the time he reached shore. So thank you, David. I know you worked with him. Did you want to say anything to what I said?
Yeah, of course. David was a huge part of your class. He was so kind and helpful to every student who had questions. He worked with all of us TAs to create the quizzes, create all the educational material, helped you a ton with the slides, and my favorite part, the animations that he would do to help teach some of the concepts. David was a huge part of the class. I thank him so much, and very, very sorry for his loss, 100%. Very thankful to him.
Thank you. And at my research center on drug abuse, David was the librarian for 20 years, and he caught the passion for the market by listening to me, and he really took off with it. And so thank you, David. And Amy Billing, who helps me now with the course, and who provided some of the slides that I'm going to be showing today. She knows a lot more of IT than I do, too. All right. In 2005, I entered the Barron's Stock Challenge for business students, even though I never taught a business course, even though I'm a research psychologist, by the way. And I entered and came in, as you can see here, 5th in the country among all the business professors. And I used this to go to the honors program. Remember when your course was on the honors program, and what basically in 2005 I went to them and said, I've been teaching a course on drugs in American society. I'd love to teach a course on stocks. It's my second passion. I showed them this. They asked me to write it up, and that's how the course that you took got started. And it was an honors course for many years, of which you took it that way. Since then, I've done a lot of public speaking. I was written up by IBD, and they're real people, real success. I actually ran IBD meetups for a time locally, and then I did a number of talks at the AAI conference locally. But this was before you had all the Zoom stuff, so it was stuff that I could only go to. All right, now, for those who need help falling asleep, there's an article, an interview done by me on what my history was, how I got into it, why I teach the course, all of that. It's 10 pages long. And I was interviewed by Les Masonson, whom I really liked. Les had written a book, I think, Buy, Don't Hold, about buying ETFs and using relative strength to do that. And I really like him. So anyway, I got to tell you what happened recently with Les. So first I'm going to show you this. It's sort of out of sequence. I may not have showed it, but I have to show it. I've shown this on my blog many times, and it always works. So listen, on day 1 of my current QQQ short-term uptrend count that began on April 25, it's now in the 63rd day, all right? QQQ since that day in April 25 is up almost 20%. TQQQ, which is the triple leveraged bullish formation of QQQ, designed to move 3 times as much as QQQ does. In the same period, TQQQ has advanced almost 66%. Okay, I revised these right after today's close. All right, this 66% performance was more than all but one of the NASDAQ 100 stocks. AMD went up 72% in that time, and all but 6, those are listed, of the S&P 500 stocks. So the moral of the story is buying TQQ on day one beat 95% or more of these stocks in these indexes. So if you think you could buy these in advance and know it was going to be great, go for it. But I'm suggesting that a number of you might want to try this out. I have posted on my blog a number of times this analysis, and it always works as long as the short-term trend count lasts for, a reasonable amount of time. And I've actually tried it. I just want to tell you, on day one of a new uptrend, right, you're scared because the market's been in a downtrend and you don't believe that the uptrend has started. But I'm telling you, if you hold your nose and just buy a little, it might work out very well. All right. So Wes had seen these analyses, and he is publishing a book now, the QQQ and TQQ ETF Profit Machine, and it's coming out in a couple of weeks, and I wanted to just let you know to be looking for it. And I think maybe you'll interview him at some point, Richard.
Yeah.
All right. So in my class, I've been reading on this since the 60s, 1960s, and there are just a handful of books that made a difference. And these are the books that I posted on my blog. And the first book that I teach the kids, I have them read, is How I Made $2 Million in the Stock Market by Nicholas Davis. And let me just tell you, that book is easy to read. And if you've never read it, you have to read it. That book turned me around on how I approach the stock market. Because the first book that Merrill Lynch gave me when I opened an account with my mom way back then, I had to do it with her because I wasn't 18. And it told you a lot of stuff that doesn't work. Davis turned me around. And he also has another book, Wall Street, the Other Las Vegas. And the second book that I helped people, I had them read, was Stan Weinstein's book here. And I know you're going to be talking with him. He's going to do one of the sessions. And he told me all about stage analysis, which has helped me tremendously. I then went on after that to get IBD in the 80s, and this book, How to Make Money in Stocks, was the Bible of the course. These other books are phenomenal. Mark Minervini, of course, I call him the modern-day Nicholas Davis. And there are a number of great books that summarize this, John Boyk's book, but I suggest you go ahead and look at these 3 books and go ahead and read Davis. So Davis influenced me. He influenced O'Neill. Because he made $2 million while he was dancing around the world. Remember, back then, he would send telegrams into his broker. You didn't have what you have now, okay? So, when I went to Mark Minervini's gala in January of this year, I met Stan Weinstein. So that's him and yours truly. And a few years earlier, in 2016, I went to Mark's course. And that's him and me, and we haven't changed a bit since then, right? So, anyway, Bill O'Neill, before you entered his workshops, he had a big barrel, I am told, that said, deposit ego here. So I used to pass this around to my students, and basically, the idea is, you're in it to make money, not to be smart. You're not to try and the market's always right. You got to take your losses. You can't be afraid to take losses. You're going to take a huge loss, and that's going to be it. You have to take your losses quickly. All right, this is the mantra of the course. In an uptrending market, buy visionary rocket stocks that are bouncing off of support, or that are oversold, or that are breaking through resistance on above average volume. I quote myself a lot in the course to the students. Anyway, it takes 14 weeks for them to learn how to do this and to practice doing it using a virtual stock market system, which was the same one I used in the Barron's stock market competition. Okay, so I do this. If I were present, or if I could do this, I would ask you, how many do you prefer buying stocks at new yearly highs? And I used to do this at AAII. They were a little bit older people, and I would, out of 100 people, maybe I would get 10 people who would raise their hand. And then I would say, how about stocks that are all-time highs, that never traded higher? Would you like to buy them? And maybe out of 100 people, I get 2 or 3 people, okay? Well, this is what Nicholas Davis said way back in the 60s. I buy the most expensive stock I can afford, and I buy it in round lots. That means back then it was 100-share lots. If you bought for less than 100 shares at a time, it cost you extra in your commission. And by the way, when Davis was trading, it could cost him about $100 to buy and $100 to sell. And that's how when I started out, it was like that. So imagine you're down $100 or $200 the moment you bought. So anyway, someone wrote him after his book, and in a subsequent edition, he added this. He answered questions. And one of the questions was, when you use a historical high as a buy point, do you hold literally to the historical high? That means the all-time high. Can you buy safely a stock making a new high for a lesser period? That is, 5 years. It also shows stepped-up volume. And Davis's answer was, I strictly adhere to historical, that is, all-time high. I think most people forget that when they read the book. Okay? So, this is showing the Dow in 1929 to 1956, and I drew a green line here at the top that the Dow had traded at in 29, okay? And you can see, you know how people will say to you, the market always comes back? I'll say, yes, it did. Now, the Dow in 29, it took 25 years. So look, here's where it came back in 1954, 55, okay? This is when Davis made his fortune. The Dow had come back and was trading at all-time highs. This is when he made it in 58 to 60. I want to just show you this. When he was making his fortune trading, it was a stage 2. This is the 30-week moving average. That was rising, and the market was rising above it. Okay? Stage 2, which I learned from Weinstein, is like the sine qua non. In Latin means that without which nothing. You have to buy stocks when in a stage 2, and you have to buy when the market is in a stage 2. All right? So, I found this quote online. I found a lot of stuff online that people say, and it says, this is Larry Height said, the second item is something that Ed Sekoda, I think he's a market wizard who was a brilliant trader, taught me. When a market makes a historical high, it is telling you something. No matter how many people tell you why the market shouldn't be that high or why nothing has changed, the mere fact that the price is at a new high tells you that something has changed. And I have a little note here. And I actually ran this by Mark Minervini before I said it. I said, do you mind if I say this? Mark Minervini's tremendous returns in the U.S. investing championships occurred when the market index was making a series of all-time highs. And basically, that doesn't take anything away from Mark Minervini's accomplishments. He beat everyone in the competition, all right? But what I'm saying is, you have the greatest chance of making a lot of money in the market when it is in a period of all-time highs, by the way, like now. Okay, hold on. So, why do you need a setup? Because a setup tells you that a stock is about to move in a direction now. Everyone, you've got to trade using a setup that you think works for you. Why? Because if you have a setup that tells you the stock should move up, or if you're shorting down, then you always know when it has failed. If it has failed, you exit immediately. And I have a saying I used to tell the students, every loss brings me to the next gain. All right? You can't resist losses. If your setup fails, you're out. All of the setups presented today assume the relevant index is in an uptrend. Why? I'm not going to read this whole quote. You can read it later. But the critical point, the main point is what I underline. The critical point to remember is that the same price pattern that works so well in a rising market is likely to fail miserably in a declining market. I learned this. I come out of a bull market where I had made money, and then I said, well, I know what setup works. I'll just keep doing it. And I would lose and lose and lose and lose. And in the beginning, you basically lose all your profits. So you go back and forth, until you figure out this game. Okay? So, how do I determine the market's trend? And by the way, for those who are IBD fans, you can look at their follow-through days and what they say. I have my own things that I follow. In addition, I have a general market index, a GMI, which I post on my blog. I also have the short-term trend count, which I list on my blog. Remember that example I gave you with TQQQ? Well, you would have known if you're following my blog when I said it was day one of a new short-term uptrend of the QQQ. And the final thing, and I just started using this, is what I call the 10-30 weekly chart of the indexes. Okay? And, you know, there are people who do their technical analysis and they keep having so many indicators and so many things. My approach, I'm not that smart. I just want it to be simple. You know, the KISS, keep it simple, stupid. I really like that. So, I just updated this. Fortunately, Richard allowed me to present after the market close. So this is as of the market close. The GMI, all of these components, I'm not going to go through them now. All of them are yes. The GMI2, almost everyone is yes. Some of these are uncorrelated. They're never going to get 9. But basically, I look at these things every night. I update this, and I know what the GMI is. And when I post, I tell you what it is. And these just are very sensitive indicators that I keep doing recording because it keeps me focused on what I want. Notice at the bottom, U63, we're on the 63rd day of the uptrend. The QQQ and the SPY above their 10-week average for 13 weeks. That's very important to know. And also, I'm sorry, I've got to go back. The 10, I'm going to show you this in a minute. The 10-week average of the Q is above its 30 for 5 straight weeks. Okay? You can look at this. In our course, we will explain all of these to people. So, when the GMI is above 3, 2 days in a row, it turns green. When it's below 3, it turns red. I just want to show you, this is showing you the QQQ and the GMI signals when they're red and green. Look at this. This is the last time we had a big drop, it turned red over here. And look what happened. And then it turned green, and now we've been green. This only goes through the 15th, but it's still green. I told you the GMI is still 6, okay? Now, this is important for you to look at because, people are always trying to predict what the market's going to do. I don't predict, I react. And I think that's what Jesse Livermore did too. And I think that's what O'Neill did too, and Davis. But anyway, look. Just look at this simple chart. It shows you the 10-week average of the Q, the 30-week average, right? And then this is the weekly average, all right? So, we have gone through periods. When we had a good market, look at 19. The 10-week is rising above the rising 30-week. By the way, 30-week average, stage analysis. You've got a rising 30-week, all right? Then you had a period where the market closed, the Q closed below the 30-week. That's when I get defensive, all right? It comes back, so I'm waiting, it's below. Now you've come back above it, you close back above it, the 10 is above the 30, and you had 2 years with the 10-week above the rising 30-week. And then all of a sudden, you get it. The weekly close is closing below the 30, the 10-week closes below. I'm out of the market, right? And you wait for it to come back and for the 30-week to climb up like this, and now you had a 2-year period to be in the market. And then you had this big drop in April. And All right, here's the first sign. You're closing below the 30-week. The 10-week closes below. I'm out of the market. I'm defensive. And then, bingo, you're back above the 30. And look, the 10 is above the 30 again. All right? By the way, I want to just tell you, when I started teaching, it was after the 2000 drop when my friends, you remember the internet collapse, and my friends, my colleagues are watching them, and they're losing their pensions, they're losing their hard-earned money, and I am not bragging, I am sitting there in cash. And I had moved all of my TIA, that's the pension money in education. I got out that time at around 100 and something. I don't know if it was 110, 120. That's what my mutual fund's at. And I got out, and you know, a few months later, my mutual fund was trading in the 30s. Can you imagine how you'd feel if your pension that you're relying on, your retirement money, collapses like that? I never let that happen, and I did the same thing in 2008. And that's why I teach people, because you have all the pundits telling you can't time the market, you can't get out. And William O'Neill has said, those who tell you it's impossible just don't know how to do it. All right? So that's the cues. And this is another formation, a Guppy chart, I call it, after Darryl Guppy, who's the most famous technical analyst in Australia. And these are 12 moving average. These are the shorter and the longer ones. The red ones are the shorter. They move faster than the longer ones. And I modify it. This is the closing. This is a daily on this one. This is the closing every day. And basically, all I'm trying to show you is here's a down market. When I see this in a stock or in the market, I'm defensive. When this comes back and the price comes above all the moving averages, notice how the price is leading the moving averages higher? I'm happy to be in the market then. So that's just another way that you can these are the exponential moving averages that it uses. But this is another way to track the trend of the market. Now, here's the SPY, the S&P 500 thing. And here again, here's 2024, here's the drop. Here you're down below the 30, your 10-week is below the 30, and now you came back above here. Look. Had a little blip here, all right, but your 10 is still above the 30. Everything's good until you got that big drop in last April. Then things came back. Here's the price coming back above the 10, and now the 10-week is above the 30. And for me, I'm moving my money back, my mutual funds. I'm moving my retirement funds. I'm using my IRA, all of this stuff back into the market. You know, so I'm kind of amazed that all these people telling you you're not in a bull market, that the market isn't strong, that it's gonna end and all that. You know, don't listen to that. Follow the market. You know, I tell Richard, you'll remember this. I tell them this anecdote. If you're crossing the street and you're in the middle of the street and you see a truck bearing down at you on high speed, you sit there and say, I know he's going to stop. He always stops here. Oh, he's my friend. He's not going to run me over. All that stuff that fundamentalists say. You know, what do? You get the hell out of the market. You get the hell out of the street. And that's what you do with the market. The market turns. Your indicators suggest it's turning. Don't listen to everyone. You know, I listen to CNBC just a few times, but I always have it on mute. You know, and by the way, you see this green line? We're going to talk about it in a minute. This means that the market is trading at a highest, this is all-time high. So you've got a situation where the market is trading at all-time highs. And remember what I showed you with Davis, with that, and what, you know, people make money the best in Minervini when the market is trading at all-time highs, okay? So let's go to setups. First one I'm going to tell you is a green line breakout. All right? I found this. I dug this out. I'm trying to figure out, why did I think of this? And I used to get monthly charts from securities in Boston. They sent them to my home. This is in the 60s. And I noticed that there were stocks that went up, hit a high, and then in the bad market that came, fell down, but then when they broke through to new highs, all-time highs, it was amazing. So this is Taser, famous stock. You know, Taser came public, went all the way up to 21, and then fell down to $3. Okay? At some point, it came back above 21 here to an all-time high. You see this line? This is my green line breakout, but I didn't know it at the time. But that's what I did. So what happened? The stock went from 3 to 21. That's a seven-fold increase. And all the people are saying it's too high. It's already gone up 7 high, whatever. You know what it did? It went up 7 high, sevenfold again. And I tell the kids, as a psychologist, I know the best predictor of future behavior is past behavior, right? The same with a stock. If you want to find, and David Ryan talks about this, O'Neill and Davis talked about it. They love to buy stocks that already doubled. You want to find a stock that's going to double? Find one that's already doubled. Okay? So I rode this stock up. And Richard, should I tell him the story about my big loss?
Yeah, go for it.
Because people don't usually tell you about their losses, but you know, if they're honest, they do. I went to a meeting on drugs in Baltimore, and I had a position in Taser, and I said, I don't need to put a stop in. I wasn't religious about using stops then. And I came out of that meeting, and that meeting cost me $28,000. And I tell the students the moral of the story is don't go to meetings in Baltimore. No, really, the moral of the story is put in a stop, always. As Mark Minervini says, if you don't use stops, the market will stop you. As soon as I buy something now, I figure out where I'm wrong, where my setup is wrong, and I put a stop in. You make it good till cancel and leave it alone. Unless the stock really performs and goes much higher, you can move your stop up to break even or to save some of your profit. Okay? All right. So, on a monthly chart, you start off on a monthly chart, but the green line will show up on all your other time frames. Draw on a monthly chart and at an all-time high, not surpassed by at least 3 or more months, bars. That's bars. Each bar is a month. So 3 or more. So basically, you're looking for a stock that hit an all-time high and rested for 3 months. Okay? And except for a recent IPO, it can be not surpassed for a few weeks. There are stocks that what's the life cycle trade is excellent on this, but they do it a little differently, but they're doing the same thing as a green line breakout on a lot of things. Look, Jesse Livermore, I once read, wrote something like this. He loved to buy a stock that came out, went up for a while, came down, and then after a while broke through to an all-time high. Okay? So, again, green line indicator on a monthly chart, draw a horizontal green line at the top of a bar reaching an all-time high after it has not been surpassed for at least 3 consecutive bars. Now, when a stock closes above its top green line, that's an all-time high, it is a green line breakout, a GLB. If it then closes below, it is a failed GLB, and I sell immediately, but closes below, because lots of times the stock will go through the green line and then come back below intraday, but then close back above it. So I like, if I have to, I'll put a stop in for GLB or an alert, but if I can watch the market near the close, I'll see if it's going to close below the green line. Okay, so for a minute, this is a test. For a minute, look at this. David built this for me, by the way. Just look at this. Where would you draw the green lines using this definition? Just think it through to see if you're right. All right. Here, absolutely. Reaches the top. This is a monthly chart. Reaches the top. Doesn't exceed it for at least 3 months. Blah. Then finally it breaks here. That's a green line breakout. This one failed. Came back below. Bounced. And then here you get the real green line breakout. Maybe it occurred. It occurred with high volume or not. Now you're right. You're trading here continually at all-time highs. Okay? So, oh, I gotta finish this. Up here, did you draw a green line here? I think it's gonna be here. No. It's only not surpassed for 1 month. You need 3 bars before you can draw the green line. Okay? Now, it's amazing how this works. Here's Cisco, one of the greatest stocks in the 90s. Look at the green line breakout here. This is a monthly chart. See, monthly? Look at this. Breakout here, breakout here, breakout here, breakout here, breakout here, breakout here. Finally, it reaches a top that isn't surpassed for 3 months. There's your next green line. You know how many people probably bought Cisco up here or continued to buy it here thinking they got a bargain? It's never passed its green line, all right, since 99. Look at Microsoft, the same pattern. Here's your IPO green line breakout right here. A little one here that failed, then another one, another one, another. Look at them all. And then Microsoft had a green line that wasn't surpassed. Think of all the people who wasted their time and money holding Microsoft for 15 years until you finally got the green line breakout here. Okay, in 2015. That's how you play a winning game, a winning hand here. Now, this is gold. Just want to show you it can work with gold. I wanted to show you this famous Facebook IPO. Facebook opened here, went a little higher at about 45, came down, and spent, what? A year below here. And then, boom, here's your GLB. And look what it did since. Here's a green line, another green line, and formed another green line top. Some of these charts have not been updated since then. All right? Now, someone I know, Richard Moglen, I followed him a lot on X. He said this, he quote from William O'Neill, so the first thing I learned about how to get superior performance is not to buy stocks that are near their lows, but to buy stocks that are coming out of broad bases and beginning to make new highs. The only mistake here is he should have said all-time highs. I'll show you that in a minute. In fact, do you know how William O'Neill learned this? There was a guy named Jack Dreyfus running Dreyfus Mutual Funds, and William O'Neill saw that he was doing so well, he went back and charted, that's CHARTED with a Boston accent, he charted the stocks and when Dreyfus bought it, and guess what? They were hitting highs, new highs. And that was probably the beginning of William O'Neill's success. All right? Now, William O'Neill and IBD started this whole thing about how to find and own Americans' greatest opportunities. He did this in 2012. Bear with me. I'm going to get current in a minute. All right? So he had a bunch of charts like this. By the way, O'Neill, just about all the charts in this book are weekly charts. He didn't get sidelined by all the daily junk, the whipsawing. He followed weekly charts. Now, I know there are people here who probably work with him, and maybe I'm wrong, but that's what I surmise based on doing a lot of reading and studying his things. And basically, he would show, where he bought. By the way, you see this? That's a GLB. Where he bought, and he showed his formats, and he showed how he would add and add and add and add and add. Right? Notice, by the way, these are stocks he made fortunes on. These things are taking 81 to 83, 2 or 3 years. How many people hold stocks for 2 or 3 years? But the real winners, you can do that if you have good exit strategies. Now, you know what I did? I went on Market Surge, and I took all of these stocks. I think there were about a dozen or so that he showed in that series, and I drew in the green line, and I also drew in where he bought. Look at this. Here's the green line breakout. He bought somewhere in this year. Okay? Here's another one he bought. This is Netflix. Here's a GLB, green line breakout. He bought after this green line breakout. Here's Qualcomm. I remember this. This is a phenomenal stock. Went from 4 to 100 very shortly. But anyway, all I want to show you is, here's your green line breakout, right? He bought it somewhere in 1999 and made money, but he was buying a green line breakout. Here's Apple. More green line breakouts. All right? So, I just found this. Someone posted it, and I went back to his book, and he says, O'Neill said in 176 in his book, as a smart investor, your job is to buy when a stock looks too high to the majority of conventional investors and sell after it moves substantially higher and finally begins to look attractive to some of those investors. If you had bought Cisco in November of 1990 at the highest price it ever sold for, when it had first made a new all-time high, and looked scary, you would have enjoyed a nearly 75,000% increase from that point forward to its peak in the year 2000. So let's go look at that chart again. See the green line there? That's what O'Neill is talking about in 1990, buying it here. So, the implications of all this is O'Neill bought many of these stocks after GLB or an IPO GLB base. He also bought some stocks before they had reached an all-time high, but all were headed to all-time highs. One way to pick winners is to buy at or after the GLB using setups. Don't focus on stocks or bases that are far below all-time high. I'm amazed when a lot of people who practice Can Slam and IBD are looking at cup with handle in various bases, and they're looking at stocks that are substantially below their all-time high. I know why they do it, because I watch some of these presentations. They think they can get in early, like what do they call it, a sneak cheat, and they try and get in early, like when it's first forming a stage 2 base. And look, it reached an all-time high and a green line, which is much higher, so why miss all that? But you know what? Think it through. When you're in the stock at the time it's starting at stage 2 uptrend, you have no idea if it's going to ever go to an all-time high. So if you get in it early, you may have lost time, you may have failures or whatever. Why not get in at the perfect time, right? When it's breaking through all that resistance to a new all-time high. And basically, after seeing Christian Flanders saw my presentation at the Minervini Gala, and he said something like this. I don't know exactly. I'm sorry, Christian, if I misquote you. But he said a lot of his winning stocks, remember he had huge gains in the investing championship. A lot of them had been GLBs. Okay? Remember, if you buy something at an all-time high, there's no overhead supply of sellers who bought at a higher level and have losses. In fact, Stan Weinstein said it better. I'll show you in a minute. I love this quote from Burton Crane. There is no magic about buy signals. They are only devices by which we call our attention to stocks that have already begun to attract the attention of others. I tell this to the students to say, you don't want to be a pioneer. You want to buy stocks that it looks like you have a setup that basically shows that people are buying. They're buying it preferably all-time highs. It means, and on high volume, it means that the big guys are already buying it. I love this quote I just found, Richard. I don't know, I just in case, this is someone who put it on X, and I hope that Stan will say this is accurate. He said, whenever a breakout occurs with a stock moving into virgin territory, and that is it's never traded there before, this is the most bullish situation you can buy. Think about it. There isn't one person who is long and has a loss. That's kind of amazing. So I hope by this time I've convinced you to at least look at the possibility that you should be focusing on stocks that are either breaking to an all-time high or have already reached one, and now you can find a good setup to find it when it's buying off of support. Okay? So I wanted to show you this. Jim Roppel was written up. I think this is IBD. He had a famous trade. He made $1 million and he retired and then went into the business based on this. He bought Broadcom. All I want to show you is, notice that he bought, this is what one is, he bought, when he didn't know, maybe he didn't know it, he bought when it was hitting an all-time high on a GLB. Okay, now, does this really work? On my post, I was, in the down market in 2008. I was in cash. I had gotten out. I avoided it. And I did on this. And I talked about a number of stocks that are hitting all-time highs. Look, if you've got a market that has been horrible, I love it. Because it means you don't have many stocks hitting all-time highs. The few that do, that may be the new leader. So I talked about GMCR, all right, and other stocks, and here's what it did. At the end of '08, beginning of '09, here's your GLB. It had a 13 bagger after that, went all the way up to here, to 130 from around 13. All right? In fact, I told my stock buddy, who's brilliant, and buys a lot of stocks on technical analysis, but basically on concept. And, she's saying, in your office, didn't you just buy Keurig K-Cup machines for your kids, your students, for your workers, I mean? I said, yeah. She says, that's what GMCR does. Wow. So I didn't know the reason, but I'm telling you, I'm going to say something that a lot of people might not like, but I think it's true. If a stock is trading at an all-time high and it has a GLB, I am less likely to even care what they do. I know that sounds silly, but someone cares like they do. They pressed it to an all-time high, to a GLB. The other thing that I'll just say now, get it off my chest, everyone talks about relative strength, the relative strength line and everything. For me, what could be better relative strength when a stock has a GLB? Because I know this, because I track it. Like in the past year, there have been no more than 100 GLBs on a day out of over 6,000 stocks. If you're one of the 100 out of 6,000, I'd say you are showing relative strength. And lately, the number of stocks hitting an all-time high is roughly about 30 to 40 to 50 out of 6,000. That's good enough for me. So let me show you some. Here's Palantir. See the GLB? Okay, now, again, I'm not going to belabor this. A lot of you will say, I would have bought it here. And you would have been right because it did have a GLB. But how many stocks that have a pattern like this that you bought early never did this? They just, fizzled. All right, that's Palantir. Here's GEV. A lot of people are talking about. This should be orange because once I have a new green line, I make the prior ones basically orange. But look at this. Here's your GLB. It went flat for a while. Wham. Look what it did. And then recently, it broke to an all-time high here. It's off to the races again. All right. I wanted to show you this one to show you that you might say, hey, look at this. Twilio is now in a stage 2 uptrend. Here's your 30-week average. It's turning up. Why don't I buy it? And you know what I say? It's got a green line top here. I'm not touching it. This may fail. Okay? Look, I want to show you a daily example. Brinker, which is really good. Look at the GLB here, right here. Look what it did. And I'll give you a quick preview of what we're going to talk about. You see this little line here? That it didn't break after GLB until here? That's the 8 EMA, the 8-day exponential moving average. This pattern happens a lot. So where can you buy it? Either you buy it here, or you buy it off the bounce of the 8, the bounce of the 8, the bounce of the 8. It never touched the 21 again since here. A lot of people that use the 21, which is a great indicator. But notice, a rising stock stays above the 21. Look at that. All right. Now, here's IBIT. This was a green line breaker right here. I actually bought it here on this day. All right. Boom. Notice how it's staying above the 8. And then it formed the green line top. Okay. I think it's broken it already recently. I'll show you in a minute. All right. So, all right. Again, to try and convince you, on my blog is a table like this that is updated every day throughout the market. All right. And this is what it looked like on today. And what I did is I went through and I selected successful GLBs. Keep in mind, these are GLBs that didn't fail, that the stock moved up. And all I'm trying to show you is it's not too late lots of times to buy a stock at a GLB. So HWM in 2023 had a GLB at 51. It's now at 189, up 270%. Look at, and then I added some in 2025. Well, here's GEV. Here's its GLB at 447. It's now at 644, up 44%. Look at this. GLBs can work. Breaking to an all-time high after a rest is not a sign of extension. Usually, it's a sign of something great happening with the stock. All right? So, to put it all together, I buy stocks trading at or above their last green line top. So everything I'm going to show you assumes that there's been a green line breakout and the stock is above it. Either it's breaking out or it's above it. Okay? How do I find GLBs? You know, one of the things I like to do in my presentations and my teaching is not just show you the pattern, but show you exactly how I find it, because I want you, my students, to know how to do what I do. And that's what we're going to show in the course we're going to have, Richard. I want people to learn how to do this so you don't need me, right? And you don't have to buy from me to find out the good stocks. You'll be able to do it, all right? I identify stocks that reached an all-time high today. I do this oftentimes at the end of the day. And I'm hoping, Richard, that you're going to create something really good to create the green line in deep view when we teach people this, so that you can save me the time of having to draw in the lines and find it at the end of the day. All right, on a monthly chart, I draw in the green lines. I told you where it's drawn. For stops trading below their last green line top, in other words, maybe they hit a 52-week high, I set an alert for when the stock trades above it. So if I find a stock that's climbing, but it's below its green line, the last green line top, I will put in a alert in my program to make it tell me as soon as it crosses it. Most important, the GLB fails if the stock closes below its top green line and must be sold. When a later higher green line is drawn, I color the prior green line orange so that when I go to it later, I don't see what's a green line and realize that there's a higher one. Okay? Now, here's some examples. Here's a GLB on very high volume. I love to have high volume here when the GLB occurs. Now, lots of times, goes up, comes back, retests the green line, and moves up again. Okay? Here's another high volume GLB, IBIT. I told you about that right here. Okay? And you can see the volume above the 50-day average of volume. Okay? HRNG had a high volume. Look at this high volume day on the GLB. See that? Okay? But look what it did. It failed. Went way up and came back down. Okay? It failed. Yeah, you never know if it's going to fail. Look, the other thing I want to teach you is this is another indicator. These are Bollinger Bands. See that? 15.2, high and a low one. And basically, statistically, about 90% of your prices should be between those two lines, which means that if a stock bounces off it, that can be a buy. So basically, these red dots that I use tell me that the stock was outside the top Bollinger Band and then closed below. Sometimes stocks, when they do that, rest. Like they rested here, they rested here. This didn't have much of a rest, it went back up. Okay, so I just want to tell you what that is. Now, again, here's the GLB failing. Okay? And one of the ways you can see it, you see this 8 moving average? It's above it, now it closes below it. That's a sign of weakness. All right? Now, here's another one. AS, very high earnings came out. GLB went sideways. Okay? We're going to talk about these blue dots in a minute. Here's another one, monthly, showing you ODD, high volume. This is monthly GLB. Okay? NVIDIA. This is a monthly. Look at the GLBs on NVIDIA. One here, one here. Look at this fantastic one. Went from 50 to looks like 140, went sideways, and now broke out again above its GLB. This was 53, by the way. Tesla. Look at this fantastic IPO GLB here. Then went sideways, formed another bunch of GLBs. All right, now it's below, by the way, its top GLB. I'll show you later. All right. Now, so that's the green line breakouts. I told you how to create them and how to draw them in on your charts. It's very important that you do this. Now,
Dr. Risch, just jumping in before you do that one, could you clarify, did you buy on the close of the green line breakout day, or would you buy intraday as it's breaking above the green line?
If it looks good and it's good volume, I would buy. I might buy. It's a great question. I might buy as it goes above it. But you know what? If it closes back below, I'm out.
Yep.
You know, and also, that's a great question, Richard. I tell a lot of students, do you know how you buy a stock in the morning and by the end of the day it's at the low of the day, right? Or it's broken down. I tell a lot of students to wait and do a lot of their trading around 3:30 to 4, so you know where the stock is likely to close. So if you have a green line breakout and the stock is sort of going back and forth over the green line, I wait until near the end of the day to see if it's going to close above or below it. If it's closing below it, I'm out. Okay? The blue dot of happiness. This is the layout I have on my charting program. I put this there for my students because my students have these F keys. Daily chart. It's on a daily chart. Now, a lot of people use stochastics, but almost no one uses the one that I found by mistake. For a while, I used to do the 10-4 stochastic. And I'm not going to tell you exactly what it is, but it was a slower stochastic. And one day I noticed stocks bouncing when the stochastic got very low. And I looked at it and I said, oh my God, I thought it was the 10-4 stochastic. Somehow I put it in as the 10-1 stochastic. And it's a super fast stochastic. I call it SFS. I found it by mistake, but wow, is it amazing. Now, if you're using Market Surge, you can't do this because Market Surge has a stochastic. You can't change it. Okay? But if you use one of the softwares where you can manipulate it, you can do a 10-1. What does it do? It looks at the range of the stock of it traded, the highest it traded and the lowest it traded over the past, I'm going to say 10 days. All right? Now it looks at where is it in that range. Okay? If it's near the top of the range, it can be 90 or 100, basically. If it's at the bottom, it's at 0. Okay? So basically, you're asking, where is the stock trading now in its range of the last 10 days? Almost think about it as a stock bar, where the top of the bar, which is a 10-day bar, with the top of the 10 days is the top of the bar, and the lower is the bottom. Okay? But no one does a 10-day bar. Anyway, so I use for my layout the 10-1 super fast stochastic. I have those 15 2 Bollinger Bands. John Bollinger, when he introduced Bollinger Bands, says use the 20-day average with 2 standard deviations above and below that average. That's like the range above and below the average. I use the 2 standard deviations, but I use the 15-day because I found it worked better for me. For the moving averages, you can say I have the ADMA, the 21, the 30. I thank Mike Webster for making this famous, the 21 EMA, the 30 simple moving averages, the 50 and the 150. All right, the 150 is like the 30-week with, stage analysis. And I have a volume and the 50-day average volume daily. And then I have the blue dot. So here it is. The blue dot is drawn on the chart, when the super fast stochastic went below 20, which means it was low, right? And then it crossed above 20. That is the blue dot bounce, all right? And it occurs, I like it best after a recent all-time high. Remember, I love all-time high stocks, okay? So you may have to go back and study this, but when I show you, it'll become clear. So, look, this on my chart is the stochastic, all right? The 10-1 stochastic. The rest ignore that. The 10-1. So whenever the 10-1 falls below 20 and comes back, I do a blue dot. See there? And there? There? That didn't go below 20. Here's another one, and here's another one, okay? And what I find, you see it's above the last green line top? In a rising stock, finding a stock that had a recent all-time high, this is an all-time high here, and then became very oversold and bounced, that's a blue dot. So look what the stock did. Look what it did here. Look what it did here. Look what it did here. All right? That is the blue dot indicator, okay? And just think about it. Wow, isn't that great? If I can buy a stock that was so strong it recently hit an all-time high and now became oversold and is bouncing, what a great setup to try. All right? And then you just put your stop below it. Now look, you see right here, this bounce and this one? It's also near the bottom Bollinger Band, which is another plus. So it's getting near extended on the downside over here. All right? By the way, when they finish my class, it's amazing. My students can do this. And they didn't know what a stock was when they came in. All right. So the blue dots set up principle. Stock is above or approaching the last green line top. It recently reached an all-time, and it's now bouncing from oversold. That's the FSS crossing above 30. It's a plus if it's also bouncing up off of the lower 15-2 daily Bollinger Band. After I buying, I enter an immediate stop loss at the bottom of the price bounce, or sell if the SFS closes back below 20. I said it best to do it after 3:30 because you sort of know where it's going to close. I will check the fundamentals and avoid a close near earnings release, because you know earnings can be crazy what they do to you. And it's a plus if the stock had a recent above average volume rise to an all-time high. Okay? So, look, you got to get to the point where you use a setup that says a stock should behave in a certain way, and it doesn't, and you immediately sell it and you take a small loss. And you let your stop loss do it. You know? You got to do that. That's the only way to survive in this game. Okay? And I don't care. I don't care if I take these small losses. Every loss brings me to the next gain. All right? Here, here's Palantir. All right? It's one of the ways I found this procedure. Here, look. Here's the earnings. Here's the blue dot. It was below 20. I even had a green line breakout here. Wow. Look at this buy. Whoop. All right, then hits another all-time high. Look at this. It's a oversold bounce right here. Look at this. Boom. All right. Now, here's some more. All right. Not every blue dot bounces, but if you have a way of putting in a stop, you get out, it comes back, you do it again. Look at this one. It's all above the green line. These are all-time highs. All right? Look at gold. I traded gold this way. It's interesting that when gold gets this oversold on this stochastic, the bounces often are tradable. Look at this. This one it did, but the bounce didn't hold, so you get out. Another bounce. All right? Here's the SLT. Just look at the bounces and look at the oversold. These are all green line. They're above the green line. The stock is trading at a series of all-time highs. What an incredible setup. Bounce, bounce, bounce. If you're into options, you could sell cash secured put at this point if you want. Here. Okay? Next. All right? Here, didn't work. Here, it held the bounce, went up here. Here, it had another one, it failed. You're out. Here, another bounce. Okay? Here's another one. Travelers, which is, I think, in the Dow. Look at this. I love finding stocks in the Dow average that get really oversold because you know they're not going to go out of business probably, with the exception, I think, of GE at one point. But anyway, look at this. Now, this is below a green line, by the way, so But this is after the green line. All right. Philip Morris, which I don't like to trade because I'm in the stock prevention and addiction research area, but look what this did. Look at this. Above the green line. All right. Look. So lots of times, if you have a green line breakout like this, you could just put the stock away, and as long as it doesn't, lose the green, go below the green line, you just hold the stock. Look at that. Here's another one. Dot. Look at the lower. You see it. VRNA, great stock. Look at this. All right. Here's your blue dot. Failed. So you're out. This one didn't fail. Your stop is right here. Look. Another one. Another one. And then, of course, it was bought out. Oracle. It's been a great stock. I'm going to show you this in a minute. Look at all the failed blue dots. It fails in a downtrending stock like this. Look at these fast-moving averages below the 30. Now they come up above the 30. Look. Blue dot. Earnings came out. Here's your green lines breakout on Oracle. Beautiful. Notice, again, a preview of things to come. Notice how it's following the 8 moving average. Is that fantastic? Here's Palantir again. Blue dot. This one, okay, failed. Put the stop here. You get sold out. Gives you another one. You buy it back. One of the things that I've learned over the time, and I know, a lot of the pros already know this, that if you like a stock, if you've done the research, you like the stock, it's doing well, it's been a GLB, and you get shaken out, if it gives you a new buy signal, buy it back. A lot of people got shaken out and now maybe shorted it, and now it's going up. Okay, look at this. All right, Palantir. GEV, a lot of people are trading GEV. Here's your GLB. All right, so you had a breakout to an all-time high. Here's where it becomes oversold. It's still among the green line. Look at it. Look at that. All right. I don't know why this works. It seems to me that many significant rises, look at this, begin after becoming extremely low, oversold, with the SFS below 20 and bouncing with the SFS crossing back above 20. I don't know why it works. All I ask you to do is put the SFS on your daily charts and see if it provides useful setups. Teach yourself what it looks like and how to use it. I really don't understand why it works. Maybe a whole bunch of charters with a lot of money are watching it. I don't know. Or maybe it's correlated with something else. All right? I told you this already. In a downtrending stock or market, blue dots fail. You must have your stops in place. I went to an IBD meetup, and I saw a really nice guy presenting to the group Apple. And he had worked it out. He showed how he made money on trading it with his setup. And I looked at it, and I said, in a stock that's as strong as Apple was at this time, you could have bought every Monday or every Wednesday. And you could have bought on, heads or tails, and you would have made money. All right? So when you see people talking about setups and showing you all the winning ones with their setups, or maybe even a book of all the great stocks and all these setups that worked, they can mislead us, especially people new to this. You think that these setups always work when they don't. And they need to show. I'm suggesting that anyone who comes up with a list of winning stocks have an appendix or a chapter that says, this is when they failed. Because depending on the market, the setups that you use will fail. And you have to be ready for it, and you have to set the risk for it. All right? Here's Apple. Look at Apple. Apple's been, lousy as a stock. It's below green line. Look at this. And look at all the blue dots here. Yeah, it's having all these oversold points, but look at it failing. So do you buy it here because it's oversold bounce? I wouldn't. Still below the green line. Okay? Toast, same thing. Great company. You know, when you go into a restaurant and they they take your order and you pay for it online and everything. A lot of them are using Toast. But look at all the times it failed. So you watch it, and then earnings came out, and it went up. But anyway, all the blue dots failed there. All right? Now, I'm making a shift now. And I found out about the ADMA from Richard and from Pat Walker. Pat Walker is a fantastic trader and teacher. I loved listening to him. You need to go to his videos and see it, and you need to go and watch the interview that Richard did with him. And he talks about trending stocks, and one of the things he uses is the ADMA. Okay, you can follow him on X at Patrick Walker 56, and you can find videos that he's posted just about the ADMA. This is one of them you can see. And his group, he has a service, it's called Mission Winners. And it took a while to sink in, but I started looking at the ADMA, and I was flabbergasted about how well it works. And I'm going to show you. I'm almost scared it works so well. Okay? Many growth stocks trend on the ADMA for weeks. Here is a setup I like, and this is my addition. I combined the GLB with the ADMA bounce. Scan for stocks that have had a GLB, are riding the EMA, and bounce up off of it. Now, that's a great setup when you do a bounce, because if the bounce fails, you know exactly where you're wrong, and you know where to put your stop, and you get out. Buy on the day of the bounce and place a stop below the low of the bounce. Sell after one. I like to sell after one or two closes below the ADMA if it's been trending. You know, you have to look at these moving averages and look at the stock's history. Some follow the 8, some follow the 30, some follow, all different ones. And you want to use the one on the stock that it follows, basically. All right? Look at this. I mean, you can't look at this and be, I can't look at this but be amazed. This is the ADMA, all right? These are the other ones, the 21 EMA, the 8, the 21, and this is the 30 simple moving average. And look at this stock. It has a GLB. And by the way, before it had the GLB, you could look back on the day of the GLB and say, wow, this stock follows the 8. And it has a GLB, and the 8 is following the 8. You buy it either on this day, with the idea that you'll sell if it closes below the green line, or you wait for it to bounce the 8. All right? Notice how it's not breaking above, it's not staying above the top Bollinger Band. Told you it does that. Anyway, look, this stock is above the 8 EMA forever until here. So you buy it. If you don't buy it here, you find it, you buy it here, maybe you buy it here, and then you wait. If it closes below the 8, that's a danger signal. If it closes a couple of days and the 8 isn't rising, you get out. All right? Here's Microsoft. Can you believe this? Here's Microsoft going above the 8 forever. Had one day when it was right on it. But look at this. Here's your GLB. So you have a GLB. Then look at the 8. It's following the 8. You buy it here maybe. Remember, you don't get whipsawed here because it didn't, even though it went below the 30, below the green line, it closed above it. And then you buy it maybe, if you didn't buy it here, you buy it here. Right? Didn't close below the 8 here, so you're okay. Maybe you buy it here. It went over here, but it was only one day. Boom, came back. Maybe if it closes below, you put a stop over here. Look at it. I mean, how can it be so great? I don't know why this works. Maybe there's a whole bunch of people who use charts, and they all say we're going to buy it when it hits the 8. I don't know. Well, I don't really care. As long as it's work, I'm going to use it. Look at Oracle. Green line breakout. It's above. Look at this. It's above his earnings. It's above the 8. Look at this. Follows the 8. Gets above. Gets a little extended here. Comes back down. Comes back to the 8. Maybe it gets sold out. Not here. It retakes the 8. Look. You see that end? I had a note there. It retook the 8. This is a buy signal right here. It's above the green line, and it's bouncing the 8. Oh, I got to tell you this story. My friend Judy calls me on this day, and she calls me on this day, I believe. And she says, CRWV, it has a high short interest, you should buy it. So you know what I do? It's first thing in the morning. I don't like to trade first thing in the morning. I go ahead and I go and market surge, and I look up the fundamentals, and I see the stock is losing money. I said, I'm not buying a stock that's losing money. So I let it go. I didn't look at the graph, and I didn't draw the green line. If I had seen that this stock on this day was having a green line breakout, I would have bought some. Because that stock went from 64 to about 170 in a couple of weeks. Look at how fast it went up. And what I want you to notice, and this is amazing, look at the 8-day moving at EMA. Never went below it. It bounced it. Could have bought it right here on the bounce if you were scanning for this. Look at this. Now, you got some closes below the 8. The 8 leveled off. Time to get out. Take your profit. I'm just amazed at this, and I was kicking myself that I didn't look at the green line breakout. All right? Here's the chart showing the weekly chart. If I had looked at the weekly chart, look at this. It was an IPO breakout. Here's the IPO. Went to the 64.62, went sideways for 6 weeks. This is the Livermore setup I told you about. Broke out, wham. And I want you to notice something. I'll get to it in a minute. This is a weekly chart. Look at the 4-week moving average. It's the 4, the 10, and the 30. It hasn't been around long enough to have a 30. But I want you to notice it's climbing the 4-week. Don't forget that until it doesn't. All right? ITRA. I traded this. Look at this. Had a green line breakout. It's above the 8. Look at this. Hadn't closed. I don't know if I got it through. Anyway, it hadn't closed below the 8. Look at all the times you could have bought it off of this bounce. Okay? Oh my God. Look at SEZL. Green line breakout. Look at it. Oh my God. Look at this tracing the 8. So I finally said I got to buy it right on this day. It closed below the 8 and I got out. But I'm just telling you, I hadn't scanned for this. But look at that. Rocket Lab. All right, daily chart, green line breakout. I traded this well. Look at this. Following the 8, following the 8, following the 8, on the 8. I don't know what it did today. It's right on the 8. Okay? So, you know, if I had the gong that I had in class, I would say this is a golden nugget. All right? Sign up to get my tweets at Wishing Wealth, because I put out, this is a tweet I put out. Rocket Lab had a high volume GLB on Thursday. See daily and monthly charts. You can go to my blog, you can see it. I've done this over and over. Look at this incredible rise. This almost looks like a flag, and then it broke out. Okay? So here's Palantir. Why am I showing you this? I think I'm showing you this this is a daily chart. Here's a, see this? Bounce, 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 blue dot. Okay? AVAV, green line breakout. Look at the high volume here. Bounce, right here. Oh, I love Hood. Love Hood. I traded this. Look. Well, a lot of my students have Robinhood, but look at this. Here's a monthly chart. All right, went to here, 100.92, went way down, turned around, and then had a green line breakout right here when I got interested in it. So here's the daily. Notice, before it had the green line breakout, notice it following the 8. Is this amazing? Look at following the 8. I could hear Pat Walker saying this because he's showing this in his website all the time. Look, here's your green line breakout. Here's your buy. If you didn't buy it here because it's following the 8 and saying I'll get out if it closes below the 8 or the green line, you buy it here, buy it here, bounces off the 8. Here's your, bounce off the upper Bollinger Band, and it's now just, this is as of today. It's just on the 8. You could potentially buy it here today and put a stop here. I don't know. Okay, the best time to buy it is on the breakout. And here's my blog post. Day 45 of the QQQ short-term uptrend. Hood takes off with a high volume GLB and closes at all-time high. So I'm telling, look, I don't sell this. What I've tried to do since I started teaching it at the university, I've wanted to help people learn what I'm doing, learn what I've learned. After doing this, I'm sorry, I think I've done it 60 years now. Okay, I'm just giving you the benefit because you get so much junk put out in social media, so much junk with people just selling you stuff. When I tell the students, find someone who's walked the talk and then learn from them. That's why a load of people go to Mark Minervini and learn his things, and the other people who've done it. I'm a different type of trader. If you want to be someone who watches the market every day and goes on a margin and takes, in a sense, risks and trades, loads of times, like in the U.S. Investing Championship, go for it. But I'm not doing that. I would rather have something quieter. I can find my setup. I can put my stop in. I don't even have to look at the stock during the day, depending on the stock. Okay? Now, here's Hood. Here's the weekly chart. Now, this is a mistake. This is not the ADMA. This is the weekly chart. And what I wanted to show you, forget this thing. You see the 4-week average? I don't know why this is true. And maybe it's mathematically could be proven. I have found that a lot of stocks following the ADMA, like I've been showing, if you put them on a weekly chart and put the 4-week on, this is the 4, the 10, the 30. Remember, they're above the 30. It's stage 2. I love the 10 above the 30. They follow the 4-week average. I don't know why. But you know what? If you don't want to do all this daily stuff, or you want to make sure that you've got a good stock, put this chart up, the 4-week, the weekly chart. Look at the 4, the 10, and the 30, and see if you have a pattern. You see these green bars? These show bouncing off of the 4-week, because sometimes I would buy off of the bounce and put my stop right below the weekly thing. All right? Now, I also did, Judy's been telling me about Joby for several years now, and it finally had a green line breakout. It's going to have electric flying cabs. They're finally taking off. And I'll tell you, she told me about it here. She loved it. I think she was buying it down here at 3. But the stock is finally breaking out. You may want to keep an eye on it because it's a whole new industry of flying cabs and electric that can take you like to the airport at 200 miles an hour, and you can avoid the traffic. And Saudi Arabia has it, and a bunch of, you have to go and read it. A bunch of car companies and a bunch of places are investing in this, okay? Here, ARKK, Kathy Wood stock, she's had a really great time, where her ETF went way up, and then it went way down, and now she's starting to do well. I just want to show you this. This is the daily chart. This is the ADMA. Why is it that her stock is tracking the 8? Are people looking at it and say, I'm buying at the 8? I just don't know why it works. All right? Now, I scan for stocks that are in an uptrend, that have been near an all-time high and are bouncing the 8 EMA today. I ran this stock today, this scan. This is how many stocks came up out of, I think, 6,000 stocks. I don't know. Anyway, they are, all of these stocks, I'm not saying go out and buy them. I'm saying go out and look at them. All of these stocks met that criterion, and I have them sorted by the close today, by the close a year ago. So this stock, Rocket Lab, is 9 times its price a year ago. Okay? I love to do this because Davis and David Ryan, remember I told you they like to buy stocks that have already doubled? Well, this is how you find them. So I love to pay attention to the stocks that are near doubling, you know, when I'm looking for stocks, okay? Now, ASPI just came up today. Here's the chart. It's above the green line. Here's the 8, and it just bounced the 8. So, if, and it bounced off, you see that's upper Bollinger Band. If I were interested in this stock, Judy told me about this stock because it's in nuclear fission isotopes. She told me about it. I might consider buying it. I think I bought a little right here because it's a bounce off the 8 and it's held the 8. And, you know, and it's holding the green line now. So that's a setup I like. All right. This is a stock. I don't know if it's on this list now. I don't think it is. This is another stock I traded. I think I bought it in this area after the green line breakout. And it had a nice rise. And I got out. I had, I think, a 30% rise gain in it. But all I want to show you is it's above and it's had blue dots. TTM, and I wanted to show you when I got it. Look at the 8. It's following the 8 up, then it starts closing below it, and it's over for now. Now it's back above the 8. Look at TTMI. How about this? Green line breakout. It hasn't closed above it. This is the first time it closed below the 8 right here. And now it closed again, so if I owned it, I probably would be lightening up or selling now because this is the second day and the 8 is now trending down. But look at it. It's above the green line. And if you were following it, you would have seen it tracking the green, the 8 EMA. All right? I love CCJ. All right? Green line breakout, tracking the 8. Now it's not. Now the 8 is coming down. Now you have a bounce. Again, look. As these are different things. But it's holding, it bounced now above the 8 right here. So if you're following it and you liked it, you buy it here, you put your stop here, and you're holding. It's still holding. Look at it holding the 8. Okay? So, normally I do this with my students, but you're my students today. I tell them to buy companies you know about through your career or personal use. And if you don't like doing this, buy a market ETF like SPY. And for all of you on this, especially if you don't have one, open up a Roth IRA now. Let me tell you something. You get to my age, and I have a lot of money in my accounts, okay? But they're all pre-tax. I've been getting them at the university or on my IRA for many, many years, all right? So you know what that means? I have to start taking out required minimum distributions. When I take them out, I know that 30% of it's going to taxes because it's all taxed. You know, for every $1 million I have, I only keep 70% of it. 30% is going to be paying to Uncle Sam. So, when I was doing this, there were not Roth IRAs. There were not Roth 401ks. Now they have them. You enter in that. You don't take a tax deduction when you do that on the money you put in, and you're never taxed. How crazy not to do this. So whenever I meet a young person who looks like they're working now, earning the money, I tell them all about Roth IRAs, and all of my students know about them. And basically the rule is you can open up a Roth IRA, and you can put now $7,000 or how much you earned that year, whichever is less. So if you only earned $1,000, that's all you can put in. If you earn $10,000, you can only put in $7,000. You need to do this, okay? All right? There's a Harvard study looking at people over many years, and basically they said, building positive relationships is one of the 5 habits of self-made millionaires, according to one man who spent a half a decade studying wealthy people. Spend more time with people who make you happy. I know this is kind of strange, but I got to tell you this because I tell everyone who meets me. I was born with very high cholesterol. My father died at 39. All of his sibs had heart attacks. And I was fighting high cholesterol all my life. I went to every lipid research clinic in every city that I went to school. I went to, last one was Johns Hopkins. I went to City University in New York. I went I met with the guy who did the Framingham Heart Study, the famous guy there. I did, and I was on every drug that they made to try and bring down my cholesterol, which untreated was over 400. And I watched an interview of Bill Clinton with Sanjay Gupta, and it turns out that Clinton's family wanted to help him because he had heart issues, and Clinton went to look for the best science that could help him, and he found this guy called Esselstyn, and you'll note at the top the book behind Bill Clinton's life-changing plant-based diet, and I went on the regimen. I've actually met Esselstyn, and that book has saved my life. It brought my cholesterol down to normal. When I tell doctors who I'm seeing that it was all a nutrition-based system, their eyes glaze over, because physicians aren't taught prevention and they're not taught nutrition. But I'm telling you, I'm living proof. If you know of anyone fighting heart disease, needing stents, having inherited heart issues, whatever, read this book. It is amazing. Okay? So the homework for you is review this presentation and try out the blue dots in your charts and the GLB with the daily 8 EMA. Review my TraderLion conference presentations from 2021 and 2022. The links are on my blog tab. You can also go to TraderLion and find them. Watch my wishingwealthblog.com or on X at wishingwealth. Sign up for the waiting list for the new TraderLion Masterclass that Richard and I are really going to do. And well, you can watch this presentation. I guess if you're watching it, it's at least the 27th. Here is the square to sign up and getting on the waiting list for the book that we're going to do. This book is not only going to teach you how to do what I do, but it's going to, I've been using TC2000, but Richard's going to interpret it all in Deep View, so that you'll be able to have a section that'll say Dr. Wish's Blue Dot, or Dr. Wish's setups, and they will all be built for you to try them out. And again, you don't just try them out and use money. You can buy one share at a time, learn how it works for you. That is very important. You know, I read this famous person who made millions, who was interviewed about it. He said, I could give out exactly what I do and very few people could follow it. So most people don't know how to do it. You've got to try it out. You've got to ask questions. Richard said there were 50,000 traders at this conference. Wow. You can reach, thank you for listening. You can reach my blog here. You can email me here, but to be honest with you, I don't always trace this. I don't always look at this. You can direct message me through X at Wishing Wealth, because sometimes I'm more apt to see that if I don't get inundated with stuff. That's what I wanted to present. Thank you for listening. I hope that I didn't put too many people to sleep, but again, if it did, you can give your friends, a spouse or whatever, a copy of it, and they can do this instead of taking sleeping pills. I really enjoyed doing this, Richard, and I hope I didn't talk too long, and I got through everything, which I'm a little surprised at.
That was excellent, Dr. Wish. First of all, thank you so much. I do want to mention for the masterclass, which I'm super excited to be doing. We'll put the link in the chat right now. It'll also be in the description to sign up for that waitlist. Go ahead and do that if you're interested at all. We'll send out all the information to that waitlist first, so definitely go ahead and do that. And I can honestly say, Dr. Wish, your class changed the trajectory of my life. So, and I think it can help out a lot of people out there. So I'm really looking forward to do that. That'll be very special. One question I did have, I've got a few here, Dr. Wish. For people who are doing this part-time and don't have too much time to look at charts, during the day, which of the setups that you talked about today would you recommend starting, trying out first? Is it the green line breakout, the oversold bounce, or the ADMA bounce? Which of those?
If you can create the software that will show people when it's a green line breakout, I think that one is probably one of the most powerful. All the others are based on you having had a green line breakout. Do you know what I mean?
Yep.
So basically, you want people to know this is a green line breakout. They can take a look at it even at night, see if the volume was big, if it looks big, see if there were earnings or what it might have been, and then consider a pilot buy. You make a small pilot buy, and basically, I don't like using stops with green line breakouts because I told you it can go back below when you get shaken out. But if you have to do that, and you're not going to watch it, you can't watch it at the close, then put the stop, a little bit below the green line breakout or about below the low of the day that it made the green line breakout. And this is important. If it should whipsaw and you get stopped out and it closes back above it, make sure you buy it back. That's what I would do.
Yep. And we've talked about this a little bit, and I'll just mention it here. I love when a stock has a green line breakout and then forms a base or has the first pullback to the 21 EMA after the green line breakout. That is just like the most powerful setup there, and easy to manage risk, just the low, the bounce there. One question I did have.
The blue dot is looking, as you know, the blue dot is looking for a bounce, but instead of the 21, which is very good, it's looking at for instance, the 8,
Yep, 100%. Yeah. One thing that was one of my biggest takeaways from taking your class that I think would be great to mention here, more on the sell side of things, is your advice to us during the class was whenever you're thinking about selling, maybe there's a scary drop on one day or whatever it is, bring up a red, white, blue pattern chart or a weekly chart and see if it's actually changed trend. And if it hasn't, consider, giving it another day or another day. And that, I think, was just such a simple but very powerful thing that can keep you in some of these long trends until they truly end, until it starts breaking down, forming another base. So just wanted to mention that there. Anything else you want to add on the red, white, blue chart?
I mentioned that. I have a post-it on my slide that says, look at the weekly chart before you sell.
Yep.
And I don't do it enough. I don't do it enough because you get things start falling and you get scared or whatever, and you want to sell. But a number of times I got out of stocks that were really continuing up, and that the adjusted guppy chart is phenomenal for showing you that the stock is still in an uptrend and maybe you shouldn't get out.
Yep, and we'll have a preset in Deep View that is the guppy chart, so you guys will be able to quickly click to that and see it. Dr. Wish, again, a pleasure as always. Definitely recommend for everybody watching it. If you enjoyed this and this is your first time learning from Dr. Wish, check out the previous presentations he's done. Really, really excellent. Goes into even more detail into the concepts. So Dr. Wish, thank you again for being a part of this. Do you have any last advice for traders out there who, maybe they're more advanced, maybe they're just starting out? Any advice with either trying your setups or trading in general?
Well, thank you. This is not easy. If it were easy, everyone would be millionaires. And you've got to, I like what the turtles, the famous turtles said. They approached every stock like they thought it would fail, and that way they would know when it failed, and they knew what to do. So I think people, especially starting out, should start with slow. I really think they should start with one share of stock and try that for a while, and see if they have a good temperament for it. And if they don't, like I said, don't. I used to tell the kids, as you know, if you don't like this, they did the simulation. If they didn't like it, great. Think what they learned. They saved money. Buy an index ETF or find someone who can help them. Exist in this, because not everyone is good at this. Not everyone wants to do it. But if I find it a lot of fun to do, but one of the things I didn't tell them, and this I know I told the class, one of my prime sell signals is, I just added a new one, by the way, Richard. One of the prime time sell signals is when a stock is going up gangbusters so much that I basically, my little voice says this is too easy, I should sell. I literally sold out Yahoo at over $400 a share because of that, And when a stock, you're plodding along in a stock and it's going up a little, each day or each week, and then all of a sudden it has a big rise like that you never expected. I oftentimes will get out. Maybe that's like a climax run. The second thing that I just learned, I think someone else said it in social media, but it works with me. My wife doesn't follow anything I do in the market and has no interest in it. But once in a while, if I've made a lot of money or everything's looking good, I'll tell her that. And usually that's at least a short-term top.
Yep.
And, and that's happened a number of times. So you gotta watch out. And I think, to be honest with you, when I look back at what I've taught the students and everything, what I probably should have put more time into is how to sell and when to sell. And people have to. I've talked a little bit about that today, about following the indicators, but you really got to have a plan. Like I never have. Some people will say, "How much do you expect to make in a trade?" I don't know. I expect to ride it until the trade goes against me, or it fails my indicators. Do you know what I mean? So I don't do that. I don't say, "Oh, it made 15%, so I'm out." Maybe I should do that, but. Another thing I noticed, by the way, and I don't think I've told many people about this, is if I have a watch list of stocks I'm trading that may have 5 or 10 stocks, and I see a day when every one of them is going up, that's a warning sign. It's just everyone is bidding up. They're bringing the stocks up. I got to be very careful. Maybe I should move stops up, because oftentimes that's the end, not the end of a major move, but the end of a short-term move. I don't know, have you ever noticed that, Richard?
Yeah, for sure. When especially if it's up several days in a row into that, close to upper Bollinger Band, everything gaps up in the morning. Yeah. Exactly.
Right. Anything else?
No, I think that's it. Dr. Wish, again, always a pleasure to speak with you. To everybody watching, I hope you guys enjoyed. Hopefully you can take away at least a few things here. And Dr. Wish, thank you so much again for your time. And thank you.
Thank you. And one thing that you didn't mention is the book that you recently published. And let me tell you, when talk about selling and the risk, managing risk, I found that to be one of the best books to specifically tell you how to do that. So I recommend that everyone read that and learn how to do that. That was just superb.
Well, thank you. And I want to mention in your forward, you made your favorite joke that you didn't mention here today, that why you're into both substance abuse research and the stock market. Do you want to mention that joke there?
I didn't do that because Judy told me not to talk about my history. No one cares about my academic history. But when I would introduce myself to audiences, I would say that it isn't unusual. I have this career in substance abuse, and I do this thing in stocks. What's the link? And I say, well, because they're both addictions.
Yep.
And they are both addictions. Yep. But thank you for reminding me on that.
Yeah. Well, we can sense your passion. So thank you again to everybody watching. I hope you guys enjoyed, and we'll be right back with the next presenter.
And sign up. Get me over. Yes. Get me over 30,000. I want to get to 31,000 on
X.
On X. I know you used to say that, when you were starting out. And I'd love to get it up. I've been at 30,900, I think, for a while. So please sign up for it.
Yeah. We'll link that below. So again, thank you everybody, and we'll be right back. Take care.
All right. Take care. Bye.
All right, welcome back, everybody. It's my pleasure to introduce the next presenter of the TraderLion conference, Rohit R. He is a chemical engineer by training. He's a current full-time swing trader and educator. And today he'll be discussing the characteristics he uses to find big winning trades. Rohit, thank you so much for being a part of this. Really looking forward to it. And ready to dive in. Thanks so much for taking the time.
Thank you so much, Richard. I think it's been a great pleasure for me to be here. I think the people who speak at your conference and also in your YouTube channel have been, inspirational people coming like Mark Minervini, who's, one of those founding members for my success. I think he's been that pillar of success. I think I've started learning from him. And I think, so it's been a great pleasure for me to be speaking over here. So what we're basically going to talk today is basically understanding how the patterns are being formed in winning stocks, and how exactly you'll be able to spot which stocks institutions are actually present and which stocks probably are not that strong. So that's your thing. So before we go in, let's little bit know about myself, so that it'll be great. So I've done my BTech in chemical engineering from Indian Institute of Technology, Madras. So it's famously known as IIT Madras. I think it's the #1 university in India for technology. So it's been a great pleasure studying there. I think that's been a pivotal point for me also, because there's been a lot of learning there, how to live in the real world. So it's been a great experience there. And I come from South India, in the bottom part of India, and I come from a place called Chennai. So it has the longest beach coastal side in India. So as I've been very addicted to beaches. We spend a lot of time over there. That's how it is. My parents have been proud about me doing my engineering from IIT Madras more than even generating triple digit returns. So you should understand how important that has been to them. So I was working as a consultant in an e-commerce company, and later 6 months ago I've shifted to full-time trading. You might ask me how that shift was. Definitely, the major problem that comes up is you spend a lot of time in front of the screen now. So you have to be very careful in not over trading. So that's been an important thing to adapt. I have a community of about 1.2 lakh members in Twitter by the handle @VVStockAnalyst. We share a lot of trading ideas, concepts, learning and experiences there. I also run a mentorship program recently since the last year, and we've been running that successfully. It's been a great experience actually to have a community, because there's a very soul. It's a one-man game, and then when you have a community inside, it feels like a team sport. So it actually helps, right? So apart from that, as you've seen this picture, I generally love traveling. So I move out to different places whenever I get the time, because I think staying in front of the screens for too long during at least choppy markets is really damaging. So I think when you figure out that the market breadth is not that good, or the internals is not that good, I think you should definitely take a step away and move somewhere for a while till things are better. And one thing why people don't do this often is they think if they move out of their house or if they move out of their office, they feel they'll probably miss out on a lot of trades, right? FOMO. You think that every single green candle that comes in the index, you think you're missing out on some large trades, but in general it's not. Even if you're missing out on a few trades, it's all right, because the market is there to stay forever, and you should definitely also enjoy your life. So we'll go ahead. So I thought, already we've already had a lot of learnings from different market visits about how their long experience in the market was, right? 30 years, 40 years of their trading experiences. I thought, let me give an experience of a person who was a beginner 5.5 years ago, who started off by just 2 books. One is Mark Minervini's book, and William O'Neill's How to Make Money in Stocks. These were the 2 founding books that I started off reading. Probably I'd started reading them from 2018, late 2018, but I started to implement that in full scale and in full size in my portfolio from mid of 2020, after the COVID crash. So my first year was probably what a beginner would start off with, right? So basically I was focusing on buying breakouts that, I was not checking whether they were the kind of high quality breakouts. It just used to be simple breakouts out of a horizontal range. So that's, I think David Ryan says, right? The larger part of the base, the line that touches the larger part of the base. So I used to be following that. There was nothing probably about the right sector. I never focused on looking at different kinds of patterns. I probably more focused on whatever broke out. I thought I have to be a part of it. That's how it started. Smaller position sizes and a large 7% stop loss. I think the 7% stop loss was because I think William O'Neill had started off with 7% stop loss in his book, so I thought I'll start off with that. So that's what I was doing. I underperformed significantly in my first year. I have marked it this way for the viewers to understand. This is my returns on my portfolio, and this is what our benchmark small cap index had done. So I'm not considering the larger cap like S&P or this one. I'm considering the IWM of India probably. That's what I mean by small caps of India, because I think in India the large caps have not moved much since COVID, but the small caps have done very well. So I thought, let me take the comparison with the higher benchmark, right? So that's the first year. So I had made 60%, learned so many things. There were so many mistakes that I committed. So I think the key learnings that anybody who's starting off initially to come into the market is that before you put in your whole capital, I think you should spend some time learning things from probably at least observing somebody who's doing well, or from books, right? Or somebody should help you do it. So some kind of a mentorship definitely helps in the initial years if you don't want to spend time learning directly from the market. So it's basically standing in the shoulders of giants, right? So if you already want to not make mistakes they've made, you want to definitely take wisdom from them. So I used primarily relative strength and base breakouts. That was everything. There was no specific sectors, nothing. And that was my first year in the markets. So I had seen a lot of your TraderLion YouTube videos during that time. It was really helpful for me. And then came FY22, the big bull market of 2021. So what happened was that this was the first year I understood that I can actually do something called super performance. So something in triple digit returns. I thought that's what these people are talking about, champions like Minner Vinny. So I thought, will I be ever able to do it? And 2021 was that year where I was able to do it. And it was primarily also because of the bull markets, but also because I started focusing on exactly what was required. So I focused on leading sectors only. So suppose if I figure out that for this year, let's suppose defense stocks have been doing really good, or probably the computer technology stocks have been doing good, they will form bases and bases and bases. They will not stop with just one single move. So what generally people do is that they try to skip from one sector to another every single week. So this week probably everybody would be talking about cybersecurity, and next week they would be talking about defense. But generally larger trends, right? So suppose when there's a tailwind in a sector, like let's suppose in India, recently the defense has been really in the hot theme, and all the defense stocks have been doing really good since the last 1 year. And when it was 2023, it was the solar stocks and the railway stocks. So the major thing that I had learned during in the first year was that these large winners, large sectoral winners, don't make only one move. They make multiple moves. So generally after the first 100% move, we generally ignore that sector, thinking which is the next sector that's probably going to make money. But that's not the way it works. It's generally that same sector that continues to make 3 to 4 bases before it stops. Right? So the major learning was when a sector in total moves up 30-40% and forms a consolidation, I was focused on trying the same sector again rather than moving to the next sector. That definitely helped me a lot, and I think it's the same in US also, right? A sector forms multiple bases before it stops, right? So then I got introduced to the world of IPOs. IPO bases were fascinating. You get those explosive moves from IPO bases, and that was this year. So what happened was basically me doing 176%, and that year was very confident for me. And then came the real test. This is where I was tested. The bear market, the Ukraine-Russia war bear market came up, and I had to change a lot of things strategy wise. In the bull market of 2021, I was holding on to stocks with the 10 and the 21 day moving average for very long periods of time. So when the stock first breaks out, I do not take profits. I probably trail them more aggressively and book profits at a lesser percentage. That is, if I'm buying something 100 quantity, some stock, I'll probably only book 20 to 30 and ride the rest. That was the primary strategy in bull markets. It works really well. You make a lot of money, but you should be very quick in adapting that. In a bear market, you should start to take profits quickly. If you don't, what happens is that, I think you've observed, stocks break out and then they come back just in 2-3 days, right? So if you don't take profits quickly during a bear market, you'll probably not be able to do anything. So this year started off with a very significant drawdown. For me, since I started off, I had a 15% drawdown on a larger capital base. This was the first testing point for me whether I'm going to survive in this market or I'm going to be one of those boom and bust traders who just came in and then got lucky in the bull market. So then I started working, higher amount of time, and then I started figuring out my mistakes. So the major thing here was that I should try to sit without doing anything. The mistake I was doing was whenever the market was having a leg down, and then they have 3 or 4 green days, quick bounces. What I was basically doing was quickly trying to buy a lot of stocks that were trying to break out of sound basis. But even if I did that, the thing is I should have booked profits very quickly. But taking profits quickly in a bear market is the only thing that can help you. Otherwise, you should at least try to sustain that without taking any damage. Because if you lose anything during a bear market, it's going to take a longer time for you to bounce back, right? So then the major learning of a bear market for anybody to take is you sit without doing anything. You don't try to make money. You basically try to preserve what you've made in the past. And the environment is very much more important than sectors and setups and any other quality check that we do. So going ahead, then came the recovery. The 2023 markets was again very strong for us in India. There was multiple sectors like defense, railways, and solar stocks doing really well. Again, that year I returned 108% versus the index of 76%. Definitely, it was not like a big super performance. That year was probably in line with the market a little better. Majorly why this happened, I'll tell you why this happened. This happened because the previous year was a test for me. Right, so it's not only the physical, it's not the monetary capital that only matters. The mental capital is something very important. What happens in a bear market is when you keep attempting for stocks again and again and again, and then they do not actually give you the kind of move that you're expecting out of it. What happens is that you get tired. And then when you get tired, when the right time comes, you're still, not in that fully confident mode where you're able to execute large sizes. So I still tell all the members who we are talking with or dealing with to basically not get hit during a bear market. I think getting hit during a bear market is really bad and you should learn to preserve. Then came this 2024. Very choppy year in India. Basically, we were up only 2% in small cap index in total, and it was like chopping throughout the year, and then you basically cannot hold stocks for more than 4 or 5 days. You should be quick in again taking profits. The learnings of 2022 helped me here. So here I was pretty much sure that okay, when I get a good amount of profit and the market is not giving more than that, I should take that, because see, we cannot change the market to give what we want. We should basically take what it's giving, right? So that was the major thing of this year. So I was able to return higher than the index, significantly higher. And see, the game was like this. So from March of 2024 to probably December of 2024, the market was up and down chopping. You have to have made money. So we made money during that period. And from January to March, we corrected 30% in the small cap index. So now again, stepping away exactly from January from the market is the key. So I think on December 25th or something, we were completely understanding that the internals were deteriorating and we were out. So that's very important. This is something I learned from 2022. So now if somebody is starting off, I think they should either learn through experience or from somebody else who's experienced it, right? So then what helped again was IPOs, because in a choppy market, I think IPOs work really well, and then IPOs really helped do that. Another thing is to not give up in the starting of the year. So many times what happens is you are basically picking a few stocks. Somebody else is picking another few stocks. What happens is sometimes your stocks don't perform. Everything that you try keeps hitting the stop loss or is not being that big winner, because it's all a game of probability, right? You cannot always be in the biggest winners. So for the first 3/4 of the year, I was not having much gains. It was about 20-25% in line with the markets. And suddenly after that, I was able to push through to 74% because of, focusing on those IPOs. So that's just a reminder that if you don't feel bad that you're not able to perform alongside the market. Sometimes, your time comes different. Just focus on the process and don't lose whenever you're not able to perform. What generally people do, I have seen people do is when, Twitter and everywhere, you think people are just sharing stocks that's moving 100% in a week and everything. So what happens is a lot of FOMO kicks in. And if your trades are not working well, what you do is basically over trading. You try to overtrade, you try to do large irrational trades just because you want to somehow catch up with the others, right? Which is wrong. You should probably give market its own time for you to do it. That was the learning. Again, one more thing that helped me a lot this year was the thing that worked in 2021, right? So sometimes focusing on those same set of sectors that you basically are the leading sectors. You don't try to flip the sectors every week. You basically try to stay with the same leading sectors for a longer period of time. Current year, it's been 20% versus the index being 17%. It was basically the recovery phase from the lows, so I was not able to do well. It's an unlucky start, to be precise. Hoping that after this TraderLion, conference, that my year starts off to be a little better. So this has been my journey so far, all my learnings and how I started off. So if I want to give something as a takeaway, I think it is to work really hard, but also make sure that you start from a smaller capital, learn first how to do the things and then expand your capital, because losing a large capital in the initial days of learning can take a hit on mental peace, and then you'll probably do irrational things. So that's the thing.
How did your risk management and position sizing change over these 5-6 years? Initially you were using stops of 7%.
Yeah.
How do you currently handle that, and how has that changed over time as you've evolved as a trader?
So in the initial year, right, it was again the same David Ryan principle. Don't go more than 10% in a particular stock. So you have 10% position sizes and 7% stop loss. That's 0.7% risk on a position. That's how it started off to be. The game started off that way. But because it was a big bull market, what eventually happened was, even though a lot of stocks were hitting 7% stop loss, because the big moves were happening, I was able to survive. But later I understood having a 7% stop loss does not work in all markets. They only work in raging bull markets, because your risk reward, even if you're getting a 20% move on an average, that's your average win percentage, you'll having only 1:3 risk reward, right? If you have the 7% this thing. So it's very, you have to have a high probability of success, and you cannot try many things. So then that was how it started off. In 2021, it remained at 10%. I did not change that. The only thing that changed was my stop losses became 4.5%. 2022, I remained at 10% position sizes, but I kept the stop losses at 4.5%. The mistake there was that I was not booking my gains quickly. So I changed that with respect. We built a model. After that, we built a model with respect to the general index. So the general notion is that you have to look at your stocks and not the index, right? That helps you a lot. But to me, it really helps me to have an idea with the index, because I think 3/4 of the stocks follow the index in general. So I think even though 1/4 of the stocks will perform when the index is sideways or going down, I think being only in the time when the probability is high overall keeps you mentally happy. Because I think in this game, if you want to play a game for 20 years or 25 years down the line, I think trying to become quickly rich using some high position sizing and all won't work. I think a longevity is something better to think over here. Then in the coming years, I went till 20% position sizes. In 2023 and 24, I was going up till 20% position size, but I don't think I've gone more than that significantly, in maybe 1 or 2 trades here and there, but I never crossed that 15 to 20% range. I think that is a very comfortable range for me. With 3 to 4% stop loss, it remains under 1% risk per trade. So I think that's something that I've been using.
Yeah, excellent. And I'm curious, given your engineering background, I'm a mechanical engineer by training as well. What were some of the key things that you were able to transfer over from your engineering knowledge? Maybe it's something to do with process or testing things. What about your engineering background do you think has helped you really well in trading?
Yeah. So I think being very mathematical with things and being very pragmatic with the results, right? And rather than thinking that, if the market is like not having false assumptions about the market. I think if the market is supposed giving, like I take the average breakout percentage is something that I calculate. That is every week or every month we calculate what the recent week's breakouts have given from the pivot. So if that's only 15%, then what I basically try to do is when I get a 15% move, I'm at least booking 50% of it. I'm not saying I'm going to trail it with the 10 moving average. I do trail a piece of it, but I think what the market is currently giving, I think I have been very quick in understanding that and trying to shift myself. That's been really helpful. And again, the other thing is for me, it's all data. So if the data is saying that the market is good, only then it's good. So currently, a lot of IPO stocks have been working, but if you look at the net new highs in the index, it's been very feeble. It's like very few number of stocks are hitting new highs, and you're not having that. You're not having that kind of huge breadth in the market. Even though a few stocks are working, me being very data oriented, I will still want to wait for those times when the breadth is also improving before I make large trades. I'll probably take 2 to 3 positions open at 10% position size, but not more than that till I see that strong feedback from my trades or from the market in general. So I think that has helped me a lot.
Great. And maybe going back one slide, what were the best books or resources that you found really helped you, accelerate your learning and obviously we all need real experience to actually learn how to trade, because you can learn something in a book, but until you experience it, especially like a drawdown or something like that. But yeah, what were some of the books and resources that you felt really helped you?
I think Minervini's books are something that's a go-to for anybody. Everybody should start with the 2 Minervini books, how to think and trade like a champion and how to trade like a stock market wizard. I think both of those books are definitely worth giving your time, because it gives you the whole journey, right? It tells you the fundamentals, it tells you the technicals, it tells you how to manage risk. It gives you a complete understanding what is required to be a trader. Right? And rereading these books multiple times helps. The first time when you read, you get some perspective. Second time, with a little bit of experience, when you read, you get some more, you learn something different. And I think that's been really good. Your book has been really good. Recently,
well,
I just read that. Recently, it's been great. In the early days, I think I've only depended as a book on that, and I've seen Kulla streams. I think that's going to be very helpful. You should definitely see. And then there's a lot of Twitter handles that basically give you the stream notes of Kulla Maggi. I think that's also something that people can go and read if they can't. A lot of Indians don't understand the way Kulla Maggi speaks. So I think some people want to go through that. It's definitely helpful. I also use that. Yeah, that's my go-to the initial days.
Excellent. Well, yeah, let's keep diving in and looking forward to hearing more about your process and how you've applied to the Indian markets, because it'll be interesting to see how much is exactly the same as how we trade U.S. markets versus any adaptations you've had to make. So
yeah,
let's dive in.
That is the biggest thing that was a challenge for me. So the things in US, when you have a good breakout, right, you can have a move as large as 100% in just 2-3 days. And what happens is, because of these moves, even if you have a very low win rate, right, it still works out very well for you, because those 1 or 2 magic trades that you get helps you going. But in India, what happens is stocks don't move like that. We have a circuit limit. So per day, we cannot move in many stocks more than 20%, and in some stocks we can't even move more than 10%. So what happens is that it's restricted day to day. So what happens is that the quick move doesn't happen, right? So you have to have a little higher win rate. That was a major learning for me. So I have tried to make processes very more in depth, so that I do my scanning a little more seriously, because if there's a 4-star setup versus a 5-star setup, even though the 4-star can do well, I try to prefer the 5-star, because for me, I'm probably looking to improve my win rate. That's very important for me. So yeah, so that's been the main thing. So let's go here. The main thing that I want to share here is that you can't stop the waves, but you can learn to surf, right? That's because you cannot expect something from the market. You have to be ready to take what the market gives. So in a year, if the market has been doing really good, you can go ahead and hold for longer trends. It's wonderful to get a few large trends, but if the market is not that good, you should be quick enough to probably take your profits. And other thing is, try less. I think in a bad market you'll have too many failed breakouts, too many squats, too many too many emotional damage that will keep happening, because every time you get a squat, every time you get a failed breakout, and you also see some other stock that you just skipped from trading go up 30-40%, that pains, right? So what people do is they quickly go and jump somewhere else. They keep jumping, but they don't understand that in the market it's all a game of probability. It's not only setup. A lot of people think a good setup is what helps a stock move, right? But it's not that. It's overall probability of the market at the current time. So that's the general market health. So if your general market health is good, then you have chances of more stocks working in your way. So I think that is what you should focus on in general, more than trying to somehow find that one stock that works in a bad market. I think it's good if you are able to do it, but I still prefer that it's better not to go for that, right? So you should have multiple things like institutional buying, because about which we're going to talk today, large base breakouts from very large bases, IPO basis, rocket basis that Leaf talks about, right? It's been transformational for me. It doesn't happen that often in India because of the reason I told you, but the one or two that happens, it works really well. There was an example that worked really well for us. So then the continuation setups and highly liquid names. Yeah, again, why do I say this? In US, probably continuation setups can be played in every stock because the market overall is very liquid. But in India, the market is a little not that liquid as the US. So what we have to focus is not on, because continuation setups is basically you move and then you consolidate and again you start moving. So you want to focus only on the highly liquid names there. That really helps you to increase your win rate, in my opinion, right? And then most important is trading only in the right phases of the index. I think that's been the most biggest learning. Yeah. So this slide I think is going to be helpful for everybody. You have to stack as many odds in your favor as possible. Even though you have a very good setup, you only don't look at that. You look whether the company has been doing well in the recent quarters, and you also check whether they have been, having the right order book flowing, they've been having the other right parameters in the stock, probably also the liquidity of the stock. You don't want to trade very low liquid stocks. I think one major learning from Kulla Maggie that I've taken for the Indian market is that if you focus only on the top 100 to 200 liquid stocks of your market at the current period of time, probably the 5 to 6 months period, you'll probably be doing really well, right? Have you observed that, Richard? Right? Having a very focused list of stocks to only trade, not go and touch every single stock, because that really helps. Right, so 3/4 of the market follow, 3/4 of the stocks follow general market, so it's important to stay in line. Market breadth is something that I've spoken about, that you should have more number of stocks above their moving averages. That's something to check. More number of stocks should be above their own 50-day or 200-day or 20-day moving averages. That definitely says that the market is strong. Also having a high net high ratio, that's something I look always into. Your stocks, there should be more number of stocks hitting new highs every day, right? That shows the sign of a very healthy market where your probability of success is a lot. Always and always choose leading sector. If you want to trade stocks apart from IPO basis, see, IPO basis is okay because IPO basis are young stocks without supply, so you can probably go over the place without even the sector. But if you're not choosing IPO basis, I think sector plays the most important role in Indian markets. If you can catch the right sector, you will become very quickly rich. Probably I was in the learning phase during all these times, so I was not able to probably, take the full, exploit the whole of what the market gave me. Because if you look at stocks in India, stocks became 20x, 25x in 1 year. Right? It's sometimes bigger than the US. Some moves in India in the defense and railway space has been so huge. Stocks started at 20, 30 rupees and they moved till 600 within 1.5 years, forming base again and again and again. So I think it's very important to focus on leading sectors, and I'll give a very simple tip. So if a lot of stocks are forming the right hand side, constructive right hand side from a particular sector, right? So suppose you take defense for instance, right? If you in your screening, in your every week screening, you have at least 6 to 7 stocks from the defense sector. They are all forming very strong right hand bases, and probably the next day what happens is they don't break out, right? So what we do is we remove them, right? We start looking at other names. But I think whenever you see a lot of names from the same sector trying to come into your watch list, you should create a new watch list and put them into high focus, because they might take 3-4 more attempts, but they as a group, when they're setting up, the probability of your success is really high. So you don't even need that sector to have already had a previous move. It could just be a large base, but there are so many stocks from the sector forming the same constructive right hand side of the base. If that's there, you should definitely not just skip it in a week, you should keep it for a few weeks and then attempt it. The other very important thing that I think works like magic is PE expansion. So I think in the market, your stock's final price is equal to it's the PE expansion into the EPS growth. That's what is your final price of a stock. So generally, if you're picking stocks at 200 price to earnings or 300 price to earnings, the problem comes when if the company is not able to give you that astronomical growth in its EPS, which we are expecting at that price to earnings ratio, we have a huge dip in the P ratio. So what happens is you have a very tough time handling those stocks, because in your expansion process, when your stock is moving up, if you have both P expansion and EPS expansion happening, it's like two things at the same time. It works like magic. So it's better to pick stocks in mid-range price to earnings ratio rather than 200, 300 or those stocks. I know there are some internet stocks that have worked really well, but I think in India I've done a lot of research. I've done extremely deep research for the last 4.5 years, and I've come up with this very conclusive evidence that stocks below 50 to 60 range is really 60 PE range is really helpful. So because you get that both the metrics helping you in the expansion, right? So again, strong fundamental growth and order book. It's always good to have check on that. It's definitely helpful.
And question on the leading sectors.
Yeah.
You mentioned defense and railways. Are those usually the groups and themes that produce the best winners in India markets, and how has that changed, over the previous years?
So in India, there's not like I have seen how it works in the US, where the tech stocks are always the ones
Software.
always called the growth stocks, right? Software. So in India, there's not a very strong software stocks. Like we don't have any those tech stocks. We basically have only tech services stocks, right? So we don't have a something that is going to be the growth sector forever. So the most different thing from India and US is in US you have something called cyclicals very clearly. Obviously metals and all are cyclicals everywhere. Those commodities are always cyclicals, but when it comes to tech, it's always a growth stock. You call them growth stocks, right? But here in India, we have different sectors popping up. It depends on railways and defense was because government of India did a big capex on them. So the capital expenditure was huge, and they were basically reforming everything because as a growing economy, we're basically building the pillars of the economy, right? So for us, it's little different. And there's nothing like specific. The IT stocks have not been that big multi-bagger. See, in 2020, it was chemicals. Because there was a theme called China Plus One. A lot of companies started shifting their base from China to India because they wanted to reduce the risk of high concentration from China, right? Because of the trade supply risks and everything. In 2021, what happened was it was a mixture of everything. Almost all the sectors worked. In 2022, after the Russia-Ukraine war, it was just plain defense and little bit of railways started working. In 2023, the solar theme became very famous, I think, across. How do you call solar? Do you call it a growth theme or it's also cyclical?
It's a little bit of both. There's periods where those solar names can do really well. Recently, the past few years, they've had moments, but it hasn't been sustained trends. But back in 2020, we had Solar Edge, we had ENPH, Enphase. Those are really good names, but recently they haven't been as much in favor, and it's a smaller group as well. So a little bit of mixture of both, I would say.
And then semiconductors also turned out to be a group that keeps working, right? But in India, we don't have stocks like Nvidia or those things. So we have smaller semiconductor fabrication stocks, and they're doing good. But I think it's not like we have a specific set of stocks that keeps doing well. It's probably you have to be pretty adaptive in finding out which sectors are actually having the money flowing in. That's important.
Gotcha. Yeah, thanks.
Yeah. So now we'll enter to this topic of the day, which is institutional buying, right? So what we mean by institutional buying is it's those flags that we generally talk, right? Those high tide flags, those normal flags, probably those momentum bursts is what the basic background of institutional buying is. But what we're trying to do is we're trying to add a lot of parameters inside to make sure that we're not just picking every random name that has an uptrend and a sideways consolidation like a flag. We're only trying the highest quality of flags, or we're trying the highest quality of momentum burst, because we're ensuring whether there's very strong institutional buying inside or not, right? So what this is again, Richard, for the same reason that I told before, that in India you have to have a little higher win rate. You can't work with a 30-25% win rate. Some people do, but I think if you can refine a few strategies to increase it a little bit, it really helps. Helps, right? So how do we look at institutional buying? The first and foremost thing is back-to-back buying candles, right? We're not looking at stocks that have one day green and then it pauses again, or it pulls back again, it moves up. So majority of stocks are like that, right? You have a little bit of up move, it pulls back a little bit and again moves. It's like that. But we are trying to look at some of the highest quality stocks that do not stop just after one day move. It has a follow through on day 2, follow through on day 3, and preferably the whole move happens in one shot in a rush. It should happen in a rush, right? Mm-hmm. The percentage that I consider is 20 to 40% move, right? Anything in the range of 20 to 40%, higher the better, obviously. If you have a 100% move, it's definitely better. But the major thing is you just do not measure the percentage move, but you study the characteristic of each candle in the move. That's how it works, right? So there'll be strong buying interest visible by institutions, unlike retail. So the major thing, how it works in India, I'll tell you with the research that we've done in India, institutions do not buy just one day. The fact is we have lower market capitalization for stocks. So even if an institution, let's suppose JP Morgan India, wants to take a particular 5% stake in a stock, right? They cannot do it in a day. It will take them 2-3 days, and in fact more than a developed market like US, Indian markets is going to have larger moves for that same acquisition because of the lower market cap and then all of those things. So the thing that's very visible in all big winners is they have strong back-to-back buying. You will not have one day up and the next day down. It'll be clearly visible. You should have at least a few 10% candles on the way. If you have 10% candles on the journey, it's going to be definitely stronger, right? And you don't want to see the candles having large wicks on the top, right? Sometimes in the uptrend you have large wicks and the next day it again recovers. Those are also things that can work. But at least if you're trying to specialize this setup, if you want to specialize one particular setup, you only focus on names that do not have wicks. You should have strong buying on almost every day by the close of the day, which basically ensures that each day the institutions want to take the stock home, right? Then you have to look at huge 5 to 10x volumes during those days. You're not looking at some just 2x volume, 3x volume. You're looking at 5 to 10 times the average 20-day moving average volumes. That's definitely required, right? And you're trying, you focus on the highest liquidity names. You do not focus on a very low liquid or low market cap name. You're basically trying the higher market cap names in the small cap and mid cap segment. If suppose it's smaller, it's okay, but it's preferable to be larger. Again, the presence of highest volume ever, highest volume of the year, or highest volume of the week on multiple days of the up move is very necessary to validate into this pattern, right? You just do not, you cannot just have small higher volumes, right? That's not allowed. You have to have some massive volumes, and not just on one day. It should happen throughout the journey. If it happens only on one day, then I do not consider that to be a strong setup, right? And the move should probably be inside the range of 4 to 20 days. And I do not like the ones that take 20 days to make a 40% move. That's not what is expected. You want stronger moves. So that's the basics of what I call institutional buying. To give you an example of Cochin Shipyard, it started at 160 rupees, okay, in the starting of 2023. 2022, and by 2024, that's just 2 years in the journey, it was almost 3,000 rupees. So you can understand it was almost a 20x in the stock, and it always showed institutional buying multiple times, right from the first time it started. Another thing to focus is, suppose if your average volumes of the stock being traded has been like, let's suppose in Indian terms, I'll give you an example, 100 crores is the average 20-day volumes of the stock. And suddenly that becomes 500 crores, the average of the 20 days after that move, and it remains like that. Basically, during the base formation, you should still see elevated volumes. Obviously, in the end days near the pivot formation, you will definitely want to see low volume because the supply should reduce, but the overall average should still remain more. That tells you that institutions are still present in the stock. It's not just the buying and they've not stopped, they're still accumulating in the base. That's something to understand over there. And multiple other stocks from this defense sector actually did this 20 to 25x during this period of time, and I think it's wonderful.
Is there a good example of back-to-back candles? So sorry, in this chart that you could point out for folks?
Yeah, so I have other examples to show that, okay. But yeah, you can see this in the first here, right? 1, 2, 3, 4, 5, 6, 6 back. It doesn't have any big red day, or it doesn't have a large period of pause. You have continuous up. You're able to see this towering volumes, right, compared to the previous volumes. Huge volumes coming almost every day. I'll show you better examples, but this is just to show you that big runs that these stocks do over the long period of time, right? Again, when it comes to institutional entry, there's 2 steps. It's not just a one-step process. Just looking at the big buying does not tell anything about the setup. That's basically your step 1 of the setup. Step 2 is how good it forms a base. How good it forms a consolidation with the moving averages. You do not want if you're moving up 40%, you don't want a 15, you don't want a 20-25% correction. That's absolutely not what's expected. You basically want the most shallow correction, maybe a little bit dip just to make sure that the supply is getting absorbed, but not a lot. You don't want a very deep base with huge red candles and all that. You want a very shallow base, right? That's just cruising the moving averages, the 10 and the 5 preferably. That's the strongest names. So you always prefer shallow pullbacks that are not more than 1/4 of the up move. You can keep this as a starting point. Again, with experience, your eyes will be able to figure out which are constructive, which are not. I think when you started off, we used to measure, right? What's the dip? But over time, we don't, right? We're able to figure that out. So prefer more constructive base formation after the up move. There is characteristics visible of supply getting absorbed. So you don't want too many squats. Like you can go down like this, come down up again like this, right? But you maybe form a small sideways consolidation over here. That's the most constructive pattern. You don't want the stock to directly come from the bottom and break out, because then again it doesn't have high success rate. So what we'll do is we'll dive into a few examples of institutional buying to understand exactly how the thing works, right? So when I said back-to-back buying, this is exactly what I mean by back-to-back buying. First day, second day, third day, fourth day, and then it stops on the 5th day. And it's also up almost 9% on the 5th day. The total 5-day move is almost 92.6%. You're not talking about some 10 to 20% move, but you're having this back-to-back buying on almost every day with huge volumes. And the major point that I told is you have to have probably that strong close on almost all the days, right? You're not having some big wicks on the up move days. Obviously, on the last day when we stop, that's okay. But apart from that, almost on all the days we've had a very a close that's almost near the highs. That's a very wonderful thing to think about. And now, if you look at this whole correction, it's about 20-21%, which is almost in the range of 1/4 of the move, which we spoke about. Right? And then because whenever the move is a little large, like 90 to 100%, the base formation sometimes takes little longer, because to absorb all the supply that's coming into the stock. But if it's a shorter percentage, then you have a smaller base also in general. That's what we've observed. And you can you can clearly see a volatility contraction pattern over here. It's getting tighter and tighter over here, and then you have a strong breakout over here. So when it's breaking out, probably you would have attempted once over here and then it would have squatted, and again you attempt once more. But yeah, it's been a big 100% journey since then, right? And this is what I call in India's these days where the circuit limit changes to 5%, Richard. That becomes a little bit of a trouble, right? So what we have to do when the conditions become like this is you should start taking profits partially on the way. Because obviously during this whole journey you're above even the 5-day moving average. So if you use probably a 5-day moving average or something for trailing, you'll still be inside the stock. But then later you'll have a quick correction to take out almost 50% of your up move. So to prevent that from happening, you can probably take out 1/4 somewhere on the way after you've got 40%, and again a little more again, like that whenever a circuit changes to 5%, so that you don't risk this kind of lower circuits in your stock. That's the thing. So Richard, any important doubts in this so that I can explain?
No, just so this is a recent IPO that had a great move, it looks like. And then for that buy point, would your stop be at the low of the day, the low below the range? How do you typically like to do it?
So preferably I don't use anything more than 4% stop loss in a day in any trade. So it can be either way. So if the day low is less than 4%, right, from the place where I'm entering, then probably I'll continue with the day low. But if not, I'll keep a standard 4% stop loss. I'm not taking anything more than that. Or if the low of the base is within the 4% range, like if I'm entering over here and then the low is only 2.7% lower, then I'll go ahead with that. It's like that.
Yeah, and a common question we often get is, are you buying as it pushes through the pivot intraday, or are you waiting until the close to buy on the breakout day?
This is the biggest thing that all of us have a doubt, right? See, there's no perfect answer. You can sometimes, what happens is when you enter here, you will get squats, right? So you'll not be able to do it fully. But again, I think it's a mix of both. You'll have to enter some during the breakout and probably a little bit during the strong close, because one thing is all big winners, if you've seen, the first day will be strong, right? So I think it's a mix of both. You have to take some part of an entry during the breakout when it pushes through, and if you've seen that it's doing a good one, close, and then you can probably add on a little bit.
Yeah, and this one has a really nice J2 follow through, and then the range after that is really nice and tight closes, and then reconfirms up. I mean, this is a textbook breakout. This is a great example to study.
Yeah, exactly. This is one of those best examples to study as an IPO base and as probably, even institutional buying. The most important thing is on these 3 days, if you notice, it looks like it has been volatile, right? It looks like it's like a 6-7% dip if you notice inside. But the nice part about this is during these days, the index was actually falling 2% or 1% on each of these days. I remember very vividly when I was in this trade. This was one of my live trades. It was live. I think I shared it on Twitter when I took it. So I think the most important thing is when your index is falling, right, you will have this kind of volatility coming in.
Right.
You'll have to handle that a little bit.
And it held up better than the index, and immediately.
Correct. So every day it goes down, but then by the end of the day it recovers. Again it goes down, and then by the end of the day it recovers. And then when the index stopped the fall, it just started to lift off. It's like that exact textbook style of what we've studied of relative strength.
Gotcha. And just to clarify, so after a stock becomes really volatile, sometimes the India government steps in and says there can't be movement more than 5%. Is that what's happening? That's what happened.
So basically these days, right, you notice, right, that it became small, like lines.
Yeah.
Right? These are the days. Till here it was 10%. See, first when this big move happened, they first made the rule to 10%. They said this stock cannot move more than 10% in a day. That's why probably this move was also slower, because the liquidity dries up. Right? Because big institutions don't want to be a part of a stock that has any restrictions. They want to be in stocks that do not have any restrictions.
Right. So at that point, you usually sell. You definitely. That's basically a sign that you want to be out of the trade sooner rather than later when that starts happening, or depends.
Yeah, it's basically like this. So if you are already sitting at a 40% profit, and then you're finding any signs like this day, right? This day I would consider as the end of a move, because it's a bearish engulfing, right? It isn't a big move, and it's kind of had a bearish engulfing over here. This is a day when I'll be probably taking out a lot of my gains. And even when it's initially in the 5% circuit range, you should probably start reducing a little every day. That will definitely help.
Perfect. Yeah, this is a good example. Thanks.
Yeah. We'll go to the next example, which is what I was talking about, railways. So see this, we started off in 2023 December range at near 20 rupees. Okay. And by probably the next November, we were hitting a high of 100 rupees. That's like a 5x, right? So if you look here, you had a 46% of big move over here. Is it visible, Richard?
Yes.
Yeah. So basically at first day strong breakout of almost 10-12%, and then you follow through a pause, again buying, a pause, again buying. So there's not any stop. It doesn't stop on the way, right? That's what I majorly mean by back-to-back buying. Right? Preferably if it happens every day like this example, it's too good, but it doesn't happen always textbook style, right? So we can't do anything, but still you have this big move and then you consolidate very beautifully, you get really tight over here, right? And again you take an entry right somewhere over here and look at this kind of move, 80% in just 6 days. Almost every big mover had this pattern of flags, not the ones that just were very feeble. That's what I'm trying to explain, right? You have these normal flags that's up, right? One day up, one day down, very choppy flags that go up and then it forms a flag pattern. But those do not produce this kind of superior moves.
Right. And the volume profile on this one is really nice. The big volume on the move higher, that 40% move, and then it dies within the tight consolidation there, and then explodes again.
And if you notice this day, right before the breakout, it had the lowest volume of this whole move.
Yep.
Right? That's what you call the pivot volume, right? When the volume completely dries up, when the supply dries up. That's exactly a textbook example here again.
Excellent.
Right? And then you can see this kind of huge move. Again, when this kind of a move happens, this euphoric move, taking profits is everything. If you try to wait till the moving averages break, you're probably going to be always late. Right? When this kind of a big reversal happens, when you call this the exhaustion gaps, right? When you initially gap up, it's fine, but in the end of a move, when you're gapping up like this, right, you should be very careful. You should be quick in taking your profits. Because if you look, the high is about 90 and somewhere over here it's about 670, right? You're basically almost losing a lot, giving back a lot. So you should take at least some profit here and then probably the rest with moving averages. Any other doubts, Richard, here?
No other questions.
Yeah. Again, this is the same stock the next time. So this is what we just studied about, right? This 80% move is what we just studied about. Now, this is what I was telling multiple times, that if a stock is forming very constructive bases again and again, right? It was probably the 4th base or the 5th base of the stock. So a lot of people will say it's an old base, correct? But I think unless it's forming a bad distributive base, you should not discard that stock from your watch list. This has been one of my biggest learnings, and I've been applying that very well after that. Even though sometimes it doesn't work, but I think as a something to keep in your mind, that if some stock moves up, large move, and then it forms a very constructive base, you should be able to keep that in your watch list. Again, here you don't have the best quality of institutional buying, definitely here, right? It's not that high quality one which we are talking about, but if you notice, it's again a 40% move and a very tight consolidation. Are you able to see the profile here? Yeah. So
yeah, I do.
Again, you can see that the volume completely dries up and then again picks up over here. And similar kind of ending. Are you able to notice the same type of ending? Right? That kind of a big reversal bar from a gap up. That's called an exhaustion gap. It works fantastic in India. I mean, I think we've studied that in all the books, but I think it works very well. You should be very quick in taking profits, because if you don't take here, you'll probably take somewhere over here when the moving averages break. Right? You would have almost lost a lot of the gains that you've got. So, any specific doubts here, or how do you rate this setup?
No, it's a good setup, and it's interesting with these Indian stocks. The volume profile is like more pronounced almost than sometimes on the U.S. names. It's interesting to see, and yeah, again, the really tight days on low volume before the expansion higher.
Yeah.
Textbook stuff.
Textbook stuff. The point is these textbook stuff only happens in liquid names. These are probably very liquid names in the market. So if you look here, it's Indian Railway Finance Corporation. It's the government of India undertaking that's basically financing for all the railway developments in India. So if government is planning a capex in the railway segment, these are the people who are going to finance it completely. So they are kind of a monopoly. So these are those liquid liquid stocks. So in liquid stocks, you see this kind of volume profile, but you don't find that in all the stocks. So that's the thing.
What is there a dollar volume amount that you typically look for to say, all right, this is liquid enough for me to trade, or does it just kind of depend on the
I would
situation?
prefer anything above, so probably the 20-day dollar volume, rupee volume of something above 50 crores is, something that I want to be a part of. Obviously, higher the number, better. But below 50 crores, it is okay. Sometimes you get big moves even in that. But as your portfolio advances, so in the initial days, my portfolio was able to handle that. But today with a larger size, I'm not able to actually enter those names very comfortably, and I'm getting a big slippage. So I've reduced personally.
Great.
I'm taking higher liquid names now.
Mm-hmm.
Again, this is another example I like a lot. This is the example that we saw there in the first slide. Are you able to see the textbook style volume profile happening over here?
Yep.
Right. The first move is about 36%. 1, 2, 3, 4, 5, 6. 6 days move back to back. Right. You're not pausing anywhere that much significantly, and you have towering volumes on all these up days. Correct. Except the last day where you have a little bit of squat, almost on all the other days you have a very good closing, doing good, and then a very tight consolidation, and again a move of 26% in just 3 days.
Yeah, an inside day on very low volume. Right
Yeah,
before
inside
that
day on very
move up.
low volume.
Yep.
And you can see these things work very well here. Look at this day.
Yep, very tight.
Very tight, and look at the volume, almost lowest, and then the next day you start this big move again. So probably I will not consider this 26% and this thing to be an institutional buying candidate, because as I told you, you should not retrace more than 50% or 25% of the up move, which we have done over here. So we do not consider this entry to be from the institutional buying setup. That's not the edge over here. But yeah, the next time you can again call this. Are you able to see this 70%
Yes.
big move? 1, 2, 3, 4, 5, 6, 7. 7 days in which almost all the days were huge buying. And you have big 10% days. This is what I was talking in the initial slide, that you should have these big 10% up days. Because this is a stock that's almost, that time was close to almost 70,000-80,000 crores in Indian rupees. That's, I don't know how much exactly in dollars, but yeah, it's a pretty liquid stock. It's a very highly liquid stock. So, and then you see that this 3 days was because we had our elections on June 4th. Our country's elections was there on June 4th. So because the leading party was kind of losing, we had a dip because of that. But this was not only specific to this. This was specific to the whole. All the stocks in the market had this dip. It recovered, and then look at this tightness again.
Very tight, yeah.
Textbook style, you'll have this tightness after this institutional buying moves. And then look at this breakout, you have clean 3 days move again. Then you pull back a little bit, and again big move. Are you able to see that back-to-back moves that's happening?
Yep.
Once a stock shows this kind of characteristic, it keeps continuing that characteristic. So rather than going with all the flags, if you start to focus on these kind of high quality flags, you'll improve a lot on your win rate. Okay, we'll go to the next example. This is from the same sector as what we just saw, and probably if you can relate from here, probably this part to here. That's what I've taken a snip here.
Those
The
shipping
same
stocks
region.
are the ones to focus on, huh?
Yeah, shipping stocks.
Yeah, excellent.
These are not shipping stock. These are basically your warship manufacturers.
Oh, okay, so it's defense.
It's defense. It's defense.
Gotcha.
So look at this. You have a big 63% move over here, which is exactly what was here. 69% over here. This move over here is exactly this move in the other stock. But here you don't see that pronounced volume profile as much as we saw in the previous one. But yeah, again we have a big dip. We go up.
With the election, yeah. Yep.
Yeah, election days. So whenever something happens for all the stocks, then you don't need to consider that thing to be a violation of your setup. That's okay. Right? And then same tight range and a breakout. Again, you have a 35% move in just 3 days. Again, you get tight. It's again one more institutional buying setup over here, you get tight, again a big move. And the beautiful part is you do not have stocks like after it forms this kind of a setup, you do not have a breakout that comes back to your stop loss, spends 1 month over here. It will be very fast. It doesn't take time. Are you able to see how quick the moves are? Don't you think these moves are actually some faster than most names in US also?
Yeah, they're good. Really
I think
good moves.
in US also I see slow moves in many cases. It's probably because of the liquidity.
Yeah, maybe more longer duration moves, but it's more. There's probably some more small caps, momentum names that have similar to this, but these are great swing trade opportunities for sure.
Okay. And the best part is these are among the most liquid stocks in India. So it's not like you're trading small caps, you're trading some of the highest liquid stocks in India. So that's the best part. This is what I call textbook example. We saw the first example, right, in this one.
Mm-hmm.
Are you able to see this big move and then this consolidation?
Yep. Mm-hmm.
Very similar to that you can see here. 1, 2, 3, 4. In just 5 days you move 99.52%. And it's not like one day up you pause, etc. You keep moving every day. Right? And then you pull back and then you form a very tight. It's not that tight over here compared to what we've seen there, but that's also because the base is, it didn't take much time.
Right.
And then you see that the volume completely dries up and then you see this big move over here again. So that's another wonderful example to go through. Okay, again, one more example. See, this is not going to happen every day, Richard. This kind of a setup will not happen every day. You'll probably have these normal flags happening throughout the year. But whenever this happens, right, you can probably have a higher win rate and you can probably size up better. And if it's liquid, that's what I'm trying to share over here. 1, 2, 3. 3 big days. In just 4 days, you're up 72%. Right? Huge volume upthrust in 40 million volumes on these days. Mm-hmm. Huge volumes. And then you go sideways, the volume completely dries up and you get this big 43% move in just 7-8 days. And one thing to notice in all these names is they wouldn't have retraced more than 25% of the up move. Every name. Look at this. Not retraced. Again, here you're always forming on the top, right? You're not trying to dip, except the election thing. If you look at it, it's almost on the top. Every name consolidates in the top 1/4 of the range, and that's the best part about all these names. Let's go to the next example. Again, one more 63% move. 1, 2. Okay, there's a 3-day pause over here, and again 3 more strong days. But they're all almost back to back. And then you form this base, and then you have this quick move. I wouldn't consider this to be a 5-star setup. Definitely, it's a little choppy out there. When it's a little sloppier also, and it's a little choppy. This is the best quality ones. These kind of ones. These are the ones you should be like trying on higher size because your risk is also very less, and you can get a faster move. These are little choppy ones. This is another name. If you notice, a big 63% move in the stock. This is not the highest quality, definitely, right? This is not the highest quality that we've studied. But okay, I'm showing the other examples also where you have almost everyday buying happening. Mm-hmm. You don't have big pauses, you have a big buying. And this was the election again, June 4th. Mm-hmm. And then look at this kind of move, 51% in just 5 days. From the tight range, that range is so beautiful over here on the top of the range. And that's the kind of moves that you get, right? This is one of those biggest movers of our market. It started about 160 and it's currently trading at about 3,000, I think. Again, similar to that, almost 20x move in the stock. If you notice this first up move, will you call this a strong institutional buying or a medium institutional buying? The first one.
I'd say it's very consistent. I'd say more medium, but very consistent, very linear.
Consistent. Yeah. That's definitely what I would also say. Right? But the move is also not very strong. It's only 30%. Right. So I would still consider it to be somewhat medium to good, that range. Mm-hmm. Right? And then, but the base was very nice. Yeah. The base was textbook style. You go down, you come up, and then you go sideways. Lowest volume of the complete consolidation is on this day. Yep. And then the next day you start to shoot. Even if you don't enter exactly on the pivot, and if you enter on the closing of the day, and if you keep a 4% stop loss, you'll still getting a 53% move over here. Back to back, right? Again, you have the same setup. After this, what would you call this, Richard? Is this
Stronger.
medium? Very strong. I
stronger.
feel this is very strong. Right? And then you have a good consolidation over here, similarly tight volumes and a breakout. And you have a large move after that. Obviously to trail this completely might be hard because it gets choppy here and there. You have a big wick over here, so probably you'll take out some amount out. But yeah, in such kinds of moves, you don't even have to do any handling, right? You just have to enter and then you just have to exit here. You don't have to do anything in between. That's the best part of this thing. Again, look at this example. You have a 36% move, almost consistent on every day, very tight range, and you have this kind of a move.
Mm-hmm.
Even if you consider the other 2 days, even if you leave this and if you consider these two as an institutional buying and then look at this small consolidation, you'll still get the second part of the move. I specifically will say that back-to-back buying with a very slow, the consolidation in the top half is what you would characterize it to be. Right? Again, for our viewers, for their comfort, I'm just asking, Richard, do you tell me how do you rate this?
Pretty strong, very strong. Even though that short pause there is tight, an inside day, and then just reconfirms. The volume isn't quite as explosive as some of the examples, but it still stands out compared to the previous volume to that.
Correct. So the last examples were definitely ones to show you the average ones also, because if I show you the best ones, probably you will not find that at all, right?
Yeah.
They'll happen only once in a while. But even this can be considered a good enough institutional buying. See, if you look at these kinds of 1 day up moves, right, and then you form a base over here and you try this, are you able to see that they don't give a push through?
Yep.
Even though you try, suppose there's an up move over here and then you try to buy this breakout, they do not give you follow throughs. Follow through does not happen in the general setups. But institutional buying, whenever you find this kind of a buying pattern, the follow throughs in the coming move is very nice. So handling these stocks become very easy for you, because for me, I can't handle this. It's not possible for me to handle a stock like this and wait for 25-30 days when the whole market is probably bullish and me sitting with a stock that's not moving. Rather, I would rather skip this whole part and try to be a part of this in just 5-6 days.
Mm-hmm.
So that's about it. So those are the examples I've brought forward today.
Yeah, excellent. No, these are great. And how did you refine your setup and chart eye over the years? Is it going back and studying previous examples just like this and noting down the characteristics, trying to find those back-to-back bars? What was that process like to develop this setup for you?
Yeah. So are you talking especially about this setup? How did
yes. Yeah.
So the thing was, I was basically, how it started off, I'll give you a story about it, right? So what I started doing was I started understanding what flags were and what high tight flags were, right? So, and also rocket bases, what Leaf talks about. The problem that I was facing was that when these up moves that we're taking, right, these kind of, let me go to the best example so that it becomes easier for everybody to understand. I'll stay here, right? So when this kind of an up move happens, and in another example, you have a very choppy up move that happens for about 40 days or 30 days, you move 100%. You will call both a flag, correct? You'll probably call 100% move in 25 days and 100% move in 5 days, both as flags. Probably you'll definitely call this one stronger, but yeah, you'll call both of them flags. Instead of making 100% as the benchmark, because see, we've learned that high tight flags means the stock should have moved 100% and then it should have consolidated, right? I thought rather than keeping that 100% as a standard and trying so many stocks, I'll rather go with the quality of this up move. So I'm okay with even a 40 to 50% move, but they should happen very quick. So basically that's how I refined, and then slowly I understood that, okay, I am not going to look at all the flags that's happening in the market. I'm only going to look at these back-to-back winners. They are going to be my sole bread earners. That's how it went.
What are some common mistakes that you see traders make when trading this type of setup? Is there anything you notice when someone's more of a beginner, or just something that you've noticed that can be a pitfall with trading a similar setup to this?
The major thing is that these setups are all very powerful setups, right? They've had a powerful move in the past. So if they're not moving or pushing out immediately after you're buying them, a lot of people I love being in the aggressive way when a stock is bought. Yeah, I don't like waiting a long time after the stock is bought. I want at least a good profit cushion and then I'll wait. Like I buy this stock over here. If it stands 3-4 more days over here, I'm not actually liking that stock.
Right.
After a
It should
strong
go.
breakout like this, it should at least go here and then okay. If you probably consolidate here, I'm not going to scold you. But I don't want a stock that breaks out and then it immediately, does some consolidation over here. Like Dan Zanger says, like winning horses never come back to the gate.
Right.
Look at any example. Are you seeing any example that came back to the gate?
Nope, not really.
Not even a single example. Probably this one probably went up and then it stopped over here immediately. But it didn't come back exactly to where you're looking forward to, right? And generally that's the case with most names. You will have to push through. So in these kinds of names, whenever the push through does not happen, I think that's people continue holding, which is a mistake I've noticed. You should be quick enough in realizing whether it's a winner or a loser, and you should probably take your action.
What's your general process for selling? How much do you like to sell into strength as it's going up, and then how do you typically trail using stop losses or eventually sell into weakness as it more fully breaks down?
Yeah. So there are two things that I have to focus. There are three things to be precise. One is called extension selling, right? What I mean by extension selling is when a stock quickly moves like 40 to 50% within no time. Right? Like you don't even give it 5-6 days, but it moves up like 60-70%, and then you're having those exhaustion gaps. Mm-hmm. That's when you should be very careful and you should take out at least 1/3 of your money. Right? The other thing is if you've probably moved a lot from the base, like 50%, 60% and all of that, I prefer taking a little more of the money out of the table, because in these powerful names, even breaking the 5 moving average means you're losing a lot. Mm-hmm. The 5 moving average will probably be somewhere over here when this is happening.
Right.
And you can't even depend on 5 moving average when your stocks are moving 100% and all in just 4-5 days. Right. So you should probably see, this is what I call by extension. You have moved 100% and you've stopped. Right. That automatically means that you're going to take a pause over here. And even if you don't, it's better to take at least 50% of your profits during these extensions, and then I'm talking very specific to this setup, right? Because you have explosive moves, you have to be careful. Mm-hmm. And rest you can trail using the 5 and the 10 moving average. That's what I always prefer. So probably 1/4 with the 5 and 1/4 with the 10. That will work. I don't like going till the 21 day. It's too much.
Yeah, with these powerful movers, you're giving a lot back. Yeah,
you're giving a lot back. So I think at least 60 to 65% of your profit should be locked in. And probably if you want, if you think that this team is going to be very powerful or something, then probably 20 to 30% of your stock you leave it for the longer run. But I think with however higher the magnitude of the move you're having in the stocks, I think it's equally essential to book profits into strength.
Excellent. Well, Rohit, this has been great. I love all these examples. Any other words of advice for especially Indian traders out there, regarding this setup or just trading in general? Any general things that you found really helpful, or any key takeaways that you want them to have from your presentation?
So first thing is don't rush. I think not rushing when you enter. See, the biggest mistake I've seen people doing is they want to earn so quickly from the market. They think it's some kind of a magic box where you start to earn from day one, right? You see more people, even I think, I don't know about the US, but I think in India at least, the people run behind tips and what I call by, stock recommendations that people give more than wanting to learn, even if they figure out that the person who's actually giving that that recommendation is actually very well knowledgeable, right? I think that aspect is to change for everybody. How is it in US? Do people love recommendations more or learning more? How has it evolved over time?
Everybody wants the tip.
Everybody wants the tip, right?
Yeah, and we like to focus especially on at TraderLion, teaching how to fish, teaching everybody to build their own process, their own system. It seems like you're the same way. But people want the fish. They don't want to put in the work.
Nobody wants to learn, because to learn it takes a lot of effort. Yep. And it's not going to happen in a day. It's going to take probably at least, at our mentorship program, it takes almost 1 year. Mm-hmm. Right? And that's the realistic number. People tell that you can learn the stock market in 2 months through our different programs. But I think it takes at least 1 year to experience the market, to know the things and to apply and check whether what we have studied is working. So that's a realistic time that you should give to yourself, and I think start with a smaller capital. Make money on your own without anybody's advice. Like probably even if you're learning from somebody, don't follow their trades. Even if they're sharing, prefer to make your own trades, let it make loss. But I think it's still, you should give a lot of time to yourself to train yourself to fish. Because see, that person, whoever is there, right, he might not exist after 2-3 years, right? And then you'll shift to someone else. And what eventually will happen is that your life will run away without understanding how these things are happening. And probably the other big problem is, you will see somebody doing well, right, Richard? You always see that somebody in Twitter has been doing really well this period. What you'll do is go and start following the tips or the recommendations that he's talking about the next month. But the next month might not be his best month.
Right.
And what you will do is basically just flip from one person to another by looking at their success and going and falling into their next months, which are probably not going to, because nobody is going to make money every month. And if somebody is making, it's not going to be true. So to be realistic, I think never go and try to look for tips. I know that's the easiest way to make money, probably. That's what people think. It's not still. It's very expensive. You lose a lot of money. And I think learn how to fish. It will take only 1 year, but it could really change your life. Like, just look at me. I was probably having to go for a 9 to 5, and probably today, because of all the experiences that I've got, I'm able to do full-time trading. Obviously I can still do a 9 to 5, but I still think this gives me a lot of privilege and time to do what I like. And if I did not spend, I'll be very honest, I spent at least 7-8 hours every day during my first 2-3 years, without a doubt. Apart from the trading, like apart from looking at the screens, I would have spent 7-8 hours every day looking at old winners. So probably my biggest learnings have been from studying the past winners. You should make a book for yourself from the whichever market you're trading. Suppose if you're in India, every year biggest winner should be there printed out in your table, or at least saved as a PPT in your computer, which you should be going through multiple times, right? That's going to be one of the biggest ways to learn, because you see, now you've seen 10 examples, your eyes are now trained to see something similar. If your eyes see in the market, you'll be able to trade that more confidently. Right? And another thing is to always use a stop loss. I know that a lot of advanced traders will be watching, they'll feel what's the thing, but I think even we, right, Richard, at some points of time get overconfident when we are in higher sizes, and then we try to not follow the stop loss. We think when it comes down, I'll sell it, rather than putting it in the system, right? So I think that should not happen. I think following the stop loss is very, very important.
Yep, and I think this has been really helpful, and I'd echo it's going to take time. I think it takes maybe 1 or 2 full market cycles where you experience a bad correction, a bad bear market,
Correct.
and learn how to deal with that. I think
Correct.
that's really important. And to go along with what you said about people on Twitter or anybody who you see their trades, you don't know exactly how they're managing risk, what their sell rules are.
Correct.
And that's almost more important than the entry or the stock itself. So
Probably
I think
they
it's really
will be
important.
making money. Probably
Yep.
they might be making, but you will not be able to make, because you will not be able to sit on their brain and understand how they're going to handle the trade.
Rohit, thanks again for your time. Appreciate it. Are there any other places or that you'd recommend people go to if they'd like to learn more from, or just any other resources that you'd like to mention?
So for anybody starting off, I would definitely suggest them to start with William O'Neill and Mark Minervini books, because I think that's the base for you to actually do well in the long run. If you wish to learn personally from us, you can do it through our Twitter. My handle is VVVStockAnalyst. I think I'd put that in the first slide, Richard. So we can probably show it up somewhere here. And there's a lot of learning that I share every day through my trades. I probably share all the trades and how to execute and handle them. And we also run the Champion Trading Mentorship, which is a 1-year program focused on completely swing trading and mastering that. So it's like a step-by-step way where we actually learn, and then we try to also, implement that in the market. So you can visit our website www.vvvlearn.com and know more about this.
Great. Well, Rohit, thanks again for your time. Appreciate it. Thanks so much for running through that. I really like the examples in particular. I think that's great for whatever market you're trading, U.S. or Indian. The patterns are that helps build our chart eyes. So that was
Definitely.
perfect. To everybody watching, I hope you guys enjoyed as well. Definitely leave a like down below if you did, and subscribe if you're new to the channel. And we'll be right back with the next presenter. Cheers. All right, welcome back, everybody. It's my pleasure to introduce the next speaker of the TraderLion conference, Matt Caruso. Matt is a former market maker, a professor. He's an experienced position trader and top performer in the U.S. Investing Championship. And he's also the founder of Caruso Insights. And today we'll be discussing a great topic that I think will help out a lot of traders out there, discussing, timing with regards to trading these growth stocks that we all know have great potential during uptrends, but we have to make sure to pick our spots pretty carefully. So Matt, first of all, thank you so much for your time here. Always enjoy talking to you and learn something new every time. So welcome and really looking forward to this.
Yeah, thanks so much, Rich. Pleasure to be here. I think it's number 3 at the TraderLion conference, so the third time's a charm.
Yeah, no, this I've really enjoyed the last few, and we'll probably link in the comments actually your previous ones because those have been fantastic. And looking forward to this one as well. Let's dive in.
Great, perfect. So as you mentioned, there's so much potential with growth stocks, but as you kind of progress through like learning a lot of the basics and patterns and all the rest, there's just such a large component. We all understand that the general trend is important, but it's kind of the devil's in the details. And when you dive in, how do you identify what the right trend is? What kind of impact does that have on your tools, on your timing, on kind of the ride that the stocks will present? So the idea today is to really kind of go through and look at what tools I use for market trend and not only trends, but also how to time things in the short term, because the swings are so significant with these growth names, or really all stocks in there, but specifically growth names. You really want to have that timing element. So rather than kind of bull markets, bear markets, I try and think of them because that has its own connotations. I try and think of the market as being in one of two just general main environments, either an erratic environment that's elevated and climbing volatility, or an accommodative market, so low and declining volatility. By understanding the environment you're in, that really determines the right tool selection. And this environment type is really determined by liquidity. So, bull market, bear market, that you can look back. It's always easy to kind of see, oh, that was a bull market, bear market. But in real time, with the indicators, the tools around us, how do we know how to react? Is this a breakout market? Is this a pullback market? Should I be aggressive? Should I be calm? Because I think we've all been there where you can have just a great 2 or 3 or 4 months and you feel like you have everything figured out. And then almost all of a sudden, wow, just absolutely nothing is working. These tools that were almost perfect suddenly have no relevance. It's not you, it's really the environment that's changed. So I always like to kind of think of, first principles. What are the true kind of pillars that underpin how markets work? And so if we kind of look at this idea of liquidity driving markets, there's this really interesting indicator called the National Financial Conditions Index. This is actually put out by the Chicago Federal Reserve. And what they do is they look at 100 different economic market metrics. And they try and present at any one time what are financial conditions for the U.S. economy at large. And this actually does a great job of just showing what liquidity is in general. If you look at the different houses, different investment firms have different liquidity measures, but this does a fantastic job and looks at similar components. So this essentially what this shows is if the line is falling, it means that financial conditions are becoming easier, and if the line is climbing, financial conditions are becoming more difficult. And so, there's no overlap essentially. I think there's a small weighting of the market itself in here, but it's one of 100 indicators. This is looking at everything from bond spreads to all kinds of different GDP, all kinds of different indicators. But you'll see every major bull market is defined by easing of financial conditions. Every major bear market is defined with worsening financial conditions. Same again, we have easing financial conditions and Oh, here this line should have been green, but this easing financial conditions led to this nice big bull market. And I think people get kind of confused, especially with the Federal Reserve talk and all the rest, where they say, oh, the Fed cutting rates, is the Fed hiking rates? And the confusion will kind of kick in and be like, yeah, but the Fed started cutting rates in like early 2008, and then we had the financial crisis. Or, at different points in time, the Fed stepped in and then things got bad. So what relevance does that have? And so if you kind of look at it from less the perspective of what the Federal Reserve is doing, but you think of it more as the Federal Reserve being one component of the entire liquidity spectrum of the economy, then it starts to make a lot more sense. So if we look at 2008, this is the perfect example where people will say, well, if the Fed's cutting rates, it's a bad thing. If you go back to the 90s, it was a very good thing a lot of the time. So that's where the confusion comes up. But you can see in 2007, 2008, when the financial crisis happened, yeah, the Fed was cutting rates, but they were too late. There was other problems brewing in the economy that far outweighed what was, initially some very small and inefficient cuts by the Federal Reserve. So the Financial Conditions Index actually showed that, hey, even though the Fed was cutting rates, which you think was great, they're adding liquidity, but if you look at the economy as a whole, things were dramatically getting worse throughout the financial crisis. And so that's, liquidity really doesn't equal the federal funds rate, which is what most people kind of would think. And it's not only 2008. If you look at 2020, another good example, the Fed kind of reacted initially and then got very aggressive during the COVID crash. But you can see here, even though the Fed started to cut initially, until all of the Fed's tools came to action and they kind of doled them out a bit at a time as they saw things were getting worse, this drop was really kind of signaled by what was really tightening conditions as indicated by the Financial Conditions Index. And then this big bull market, you can say, well, we had this big bull market. The Fed wasn't even cutting anymore. It was stuck at zero. Then it was all about what is the U.S. government doing? How are investors reacting? So as a whole, what led to this incredible bull market when you think it would never have happened because everyone's stuck at home and businesses are closed, but the amount of liquidity pumped into the system helped to kind of elevate stock prices. So it's just good when we think about, liquidity, we have to think of it as the global measure, not just what the Federal Reserve is doing. So before we get into all the nuts and bolts, and we'll get into more, but just, what is it comprised of, just so we kind of have a high level idea. Like 20 to 30% of the index is credit. So that's like bonds and borrowing and all that, the rest. 50 to 60% is risk. So what are different, what the stresses? And this is where, 2008, the problem was risk because all these things were defaulting and bank runs were happening. So it was a risk problem in 2008. And then part of it also is leverage. So how levered the system is. There are drawbacks because if you look at that chart, it looks perfect. There's nothing perfect in the market. So some of the drawbacks of the NFCI is it's updated only weekly. But in addition, many components are updated only monthly and quarterly. And so there's a lot of revisions to past data. So when I first ran to this indicator, I said, wow, I just found the holy grail. And then after I studied more and more, I realized, there's like quarterly GDP data in there and stuff. So the data, when you look back 20, 30 years, all that data was revised over time. If you look at the actual data, the Fed puts it out. If you look at the actual data, like week by week when they reported it, it's not nearly as helpful as when you look at it with all the revisions after the fact and when we knew what was going on. So basically, we need a real-time proxy. We need something in real time that we can react quickly. Look at the recent tariff correction, which we almost had a 30% drop in the NASDAQ. COVID, sometimes waiting a month is just way too long. You need to know like day by day. So if we kind of step forward, this is something I've spoken about in the past conferences in the past, but it's nice to have a good, deeper understanding of why it works and how to interpret it. If we look at the net highs and lows, so what I like to look at is the number of stocks making 52-week highs compared to the number of stocks making 52-week lows. It can be, choppy, and there can be false signals. That's a bit of a different, deeper discussion. But just by and large, what are the net highs and lows telling us? Well, you'll notice that whenever we have a declining NFCI, so a generally improving liquidity situation, more stocks are going to move higher than lower. You're going to have more stocks making 52-week highs than stocks making 52-week lows. Similar, if you look at 2022, when inflation came around, the Fed had to hike rates. Well, as conditions are getting tighter, you notice during this period, you had more stocks making lows. So it's amazing. We spent so much time thinking about the company's product and what the analysts are thinking about and the chart. And yet so much is out of everyone's hands. It's just driven by the general kind of flows of liquidity in the system as a whole. But in real time, it's a great tool to look at highs and lows. It's not perfect because there's other issues to it because there could be some false signals. But in general, if you want to know, like, okay, we know the NFCI has been declining. Is our net highs and lows confirming that in real time? And this is really one of the tools that helped me to kind of sidestep all of this dramatic drop with the tariff situation, because even before the worst happened, the market was breaking down weeks before then. So there was already a lot of indication, and so was the NFCI was climbing, showing that things were already getting tighter under the hood before that happened. So as everyone always says in the markets, there's always somebody who knows a little bit ahead of time what's happening. So let's look at now what an erratic environment is. So we know there's two environments. There's one where there's like accommodative policy. There's one where things are a little bit, they're under more selling pressure. How do we identify that? What does this mean? How does that affect the kind of tools we want to use and all the rest? So an erratic environment means that there's elevated volatility. The VIX is going up. Trading ranges are getting wider. There's broad selling. Most stocks are going down. If you're trying to buy, you're fighting against the general trend. There's even more challenges. Diversification's of no help. And we saw that in the tariff drops. It didn't matter even if you were a domestic producer and you hadn't have any input costs. Everything went down because the market was falling out of fear. So diversification doesn't help. And fundamentals are no help because everyone's concerned about the one driving issue of that moment. So in general, it makes it a very difficult environment. And that really plays out every cycle. If you look at the 2020 drop, and here we see the VIX is the yellow line. The red line here is the average percentage range of the market, so how much it moves in a single day. And the bottom is net lows. So the reason you really want to be aware of these tools is that as markets kind of weaken under the surface and we go into this corrective period, not only does the trend go against you, everything goes against you if you're a trend follower. The size of the ranges increase, the day-to-day inconsistency or the lack of persistence, the size of the loss you have to take for every time you step in the market if you want to give yourself, at least a day's range of risk. So you'll notice in every cycle, once net lows start to present themselves, if that kind of comes with a climbing VIX and climbing trading ranges, the odds are completely stacked against you. If you're out there with the same tools, trying to apply the same techniques if you look back here in early 2020 before COVID was an issue, if you look at this red line here, in February, the market was maybe moving only 2% a day. By the depths of COVID, the market was moving by 9% a day. If you think you're going to use the same tools in that much of a varied situation, it's just not going to work out too well. And that's typical of every market correction. If you look at like tariff war number one, which was 2018, you can see the VIX spiked up, trading ranges spiked up, net lows came about. If you look at the bear market of 2018, same situation, net lows began. We saw the VIX spike. You saw trading ranges go from 1% a day to 4% a day. If you look at 2011, this was the European debt problems. We saw the VIX spike. We saw trading ranges go from what was 1% to over 4%. You saw net lows. So everything really, really starts to work against you. 2008-9 was kind of like the COVID range where we had 9% daily ranges. Absolutely wild. That was my first year trading professional, was 2008. So it was welcome to the jungle from year one. So we understand that the tools will vary from what we need in a declining market. If you do want to participate, you need new tactics. You have to you have to really keep in mind not only what the company is, you have to understand the broad macro pressures, because the actual fundamentals of your company probably won't matter very much in the short term. Now, the beautiful thing about if you can step into an accommodative market, it kind of switches from everything being against you, from having to take on a lot of risk for small reward and all the challenges that come around. It's kind of like everything turns around in your direction. You get lower volatility. The VIX starts to fall. Trading ranges start to contract. Risk reward setups are much better. You can more easily handle day-to-day risk. You don't have to worry about massive gap downs. It's easier to de-risk your positions if you sell a little into strength and your stop doesn't have to change. You see broad buying. There's persistent net highs. Most stocks are participating. So even if you're a little bit off in your selection, probably you'll have enough working for you that you're still going to make progress. The challenge is actually shift away from the environment, but now go back down to the stock. And it goes down to portfolio management and risk management and selection. So the challenge is kind of switched to, you have to identify the leaders to maximize your returns. It's not so much about surviving, it's about maximizing your returns, which is important. And you have to then also fight complacency, FOMO, counter trend moves, where we've all been in that situation. We've been trading for a while where you think you have it all figured out and then you run into a series of mistakes. So if we look at these different bull markets, you see how everything kind of is flipped on its head. As we entered into this kind of like 2023, 2024 AI bull market, you can see we went from net lows into net highs. And that was also accompanied by falling trading ranges, a falling VIX. So it just actually makes it all easier to kind of put on positioning. Same with the COVID bull market. We went from 9% ranges all the way back down to about 1.5% ranges. So, you're getting all of this upside, and you have to take very little risk to actually kind of participate in those trends. Same thing in 2019. And so the key takeaway is that we kind of know this on the surface, but just to define it so we understand why, is that we need to aim to participate primarily in liquidity-driven bull markets, as it maximizes your likelihood of success. It's so critical. And in every cycle, people say, oh yeah, it's only the Fed that's pumping in liquidity. And there's always going to be that cynical part of the market. If you get on social media and whatnot, it's like, oh, if it wasn't because of QE, if it wasn't for this, that's just the way the market works. You can go back decades, and maybe it wasn't quantitative easing. Maybe it wasn't whatever tool the Fed has now. There was always some tool that the Fed or the government was using that would impact liquidity in the general system. It's just the way markets work. Markets live in, we use oxygen, markets breathe liquidity. That's just the way they work. So tools and methods that are normally effective in accommodative markets are rendered ineffective when the environment changes. So it's not you, it's the environment. And so just taking that step back and stop focusing so much on just what are the specific buy points, but thinking more about, is this the environment I should be operating in? How aggressive should I be? Should I be fully invested? Should I be on margin? Are things weakening until, should I be at a 30% investment right now? So critical. And I think so many of us love what we do. I know I do. It's why I feel like I've never worked a day in my life, though I've been trading since 2008 professionally. But you have to, this quote by Thomas Edison is, everything comes to him who hustles while he waits. In the market, if you're waiting for the right environment, you're actually hustling towards better results, because there's nothing worse than trying to work hard at something, but it's like you're hammering away at something that can't be, and digging a deeper and deeper hole that you have to just make up after when better markets come around. So the irony of the market is that sometimes, kind of like Thomas Edison said, just doing nothing, sitting back, is the kind of the most powerful thing you can do. So let's just assume we're going to have good markets coming our way. I think I've been very optimistic, and I think the AI bull market's going to transform so much of our lives and everything that we do. So let's focus on the bull market challenges and how to get the most out of a good bull market. So one, you want to identify leaders is challenge number one. And two, you have to tackle that complacency, that FOMO, and those counter trend moves, which can be so painful. We'll take a look at that in a second. So why do we have to identify leading stocks? This is from 2022 to 2025. And this is the 2021 COVID peak. And this is the more recent 2025 highs. This chart is so telling. If you look at over that period of time, the triple Qs went up 33% from the highs of the 21 bull market to the highs of the 25 bull market. We had a 33% gain. If you were in NVIDIA, you had a 349% gain. If you were in VRT, you had a 423% gain. If you were in small caps, you lost a little bit of money. So being in that leader is just so critical. And it's difficult. Even though we have so many tools, there's relative strength, there's always going to be something that kind of throws a little bit of a curveball at us. But you don't have to be entirely invested in them. But the aim really has to be of each cycle, how can I get some capital into one of these leaders? I mean, market gains are a big part of this NASDAQ gain was NVIDIA and some of big cap tech. If you could have had at least some fair amount of exposure in what was the main themes, that'll help you to at least match NASDAQ and ideally far, far outpace it. Every kind of bull market that I've really, really kind of done an incredible job in with like hundreds of % return, have always been when I absolutely nailed the theme. I was in early in that trend and just sat with positions. It sounds so simple on the surface, but when you dial it down, it gets complex. But that's just one of the overall arching goals. It's so critical because there's nothing more frustrating than the market flashing green every day and you're sitting in a basket of stocks and they're not doing anything or going down. So really having a mind for being in the leading stocks. And challenge two, this is just a few days ago. And these have all been like, for the most part, except maybe MicroStrategy, not so much, but Spotify, Mercado Libre, Nebius, GE Vernova, Cloudflare have all been very strong off of the April bottom. And the other day there was a strong rotation into kind of some small caps. Markets were down a little bit. And it was a day where sometimes there's these internal flows in the market. If you think of the market, there's so many different players. There's the institutional investors who are running just portfolios. There's retail investors who are trading stocks. There's hedge funds who will trade long short. They'll say like, look, I'll buy growth names because I think they'll do well, and I'll short small caps because I think they'll do poorly. And every once in a while, these trades reverse. So they say, oh, okay, you know what? It's gone too far. Let me buy back my small caps at a cheaper price and take a profit on my growth names. And when those days happened in the market, you can see these really dramatic one-day drops, or it can happen over a week or whatnot. But understanding when a market has gotten a little too extreme, or your stocks have been moving a little bit too extreme, and that you're susceptible to these counter trend moves is so important, because again, you can capture the leading stocks. These have all been leading stocks in one way or another in this uptrend. And if you just position a little bit too late, the drops are sizable. They're enough to cause dramatic pain. They can actually get you to be buying at tops, then you're selling on pullbacks, and you're doing everything in reverse. So you want to have some kind of structure to your process where, okay, the trend is positive, but is it too late to kind of start buying stocks? Because these stocks, again, move so quickly, you have to have that kind of that balancing part to your process. And this is true of not just that one-day move. If you take a look at some of the best stocks from each of the different cycles, I always say, how's the ride? We had, if you look at this on the surface and you don't look at all these other kind of indications, you say, wow, the trade desk from that 2019 bottom to the high, and just 8 months later went up 180%. That must have been so, if only I was there in 2019 to buy that stock, that would have been so simple to hold. We fell 12% in 2 days. Here it fell 11% in 9 days. Then it fell 17% in 4 days. Here it fell 25% in 6 trading sessions. Here it fell 13% in 4 trading sessions. And here ultimately at the top, you fell 16% in 4 trading sessions. If you were in the wrong place at the wrong time, this was actually a very painful advance. And the reality is a lot of times where, let's say the absolute best buy point, let's say right here at these depths, not many people really want to rush in and buy a stock when it's down 4 days in a row like this. Or same here, when you're down 25% in 5 days, you start to be concerned. Is there something wrong with the company? Did earnings change or whatnot? So such a big part of being able to capture an advance like this is being able to survive all of the volatility along the way. And it's not just trade desk. No matter the stock you look at Twilio in the 2020 bull market, up 477%. That assumes you're buying the low tick, selling the high tick. The reality is you had to sidestep a 15% drop in 2 days, 13% drop in 3 days, 17% drop in a week, 21% drop over a couple of weeks, 18% drop over 3 days. You had to react after maybe a strong earnings gap up. Having a plan in place to survive these is very important. Lastly, even with CLS more recently, let's say we looked at 2024. This is one of my good winners here with Celestica. 440% in about a year. Similar. Look at all the significant severe drops along the way. Very, very volatile, very, very wild. So how do we know when too much is too much? The problem is if you try and run traditional like overbought, oversold stuff on these stocks, let's say I look at an oscillator, I look at some bands. The problem is if you go back to principle number 1, like we spoke about, you want to be in leading stocks. Leading stocks will be overbought for almost their entire advance. That's what makes them so hard to capture. If you miss the original buy when it's less obvious to most, and it's really sometimes just downright tricky, throughout the entire advance, it always looks like, it's too much. Like up here, this maybe if it pulls back to the 21, doesn't quite make it, didn't quite touch. Then when it does pull back, okay, maybe on the 50-day, I'll buy it there. So you're always waiting for this perfect setup that doesn't want to come around. So if you kind of use the traditional overbought and oversold tools, you're probably always going to be thinking the wrong way. You're feeling like it's overbought, but in reality, it's just under tremendous accumulation. The leading stock of each cycle is just under tremendous accumulation, and you want to be able to participate, but just in a safe way. The way I go about trying to understand when it's time to protect myself is if these are the best stocks, rather than trying to figure out when this stock is extended, what I should probably be figuring out is when all stocks are extended. When there's broad excitement, that's when, as a whole, there's probably a counter trend move coming, when everyone's feeling very, very excited, because this stock will probably get up way ahead, and this will only kind of break when the whole market finally pulls back. So this is the last one to fall. So if you're using traditional overbought tools, you'll miss the majority of the advance. So what I like to, sorry, I just got a little bit ahead of myself here. So the reality is that market tides are lifted by liquidity, but this one-sided positioning, where everyone kind of gets on the side of the boat and they get very excited, can lead to these fast counter trend moves. So the market is really a combination of the general liquidity and the positioning. So if we take a look actually at, if you take away all the price action, and if we kind of distill it down to, this is just the NASDAQ 100, we're looking at just the 50-day moving average and a price oscillator. I took the actual price out. You can see what you're looking at here is basically the market moves in these strong trends, and you can see a few of them, but along the way, you're having all these jagged movements. So if you're going to be positioning in these stocks, you want to play these trends, but you need to survive the jagged movements back and forth, the chop. And say if you look at 2017, 18, 2017 was a wonderful year. Look at how strong and consistent the 50-day moving average was, just kept climbing and climbing. But look at how jagged it was along the way. So we need a tool to figure out when the market as a whole is a little bit too extended. So the way I like to go about that is look at, is basically try and measure FOMO. So what I look at is what I call my FOMO indicator, is the percentage of stocks on the NASDAQ that are above their own 5-day average. So you can see this in the bottom panel here. And so let's see a reading here of 82% in this area. That means that 82% of stocks on the NASDAQ are above their 5-day average. So think about what that means. If we look at the past 5 days, almost everybody has been buying stocks over the past 5 days. And what's interesting about the past 5 days is, unlike if you look at 50 or 200 or a big thing, we're all impacted. Like, everyone knows what I mean. Like, at the end of like a few good days of trading, you feel like, yes, it feels good. If I can only do another 3-4 days like this, I'll feel great. It's like those natural human impulses will come out after 4, 5, 6 good trading sessions. So if 82 or 85% of all stocks on the NASDAQ are above their 5-day average, almost everybody has been doing buying over the past week. So you have everyone kind of loaded on one side of the boat, and then after is kind of susceptible to a swing the other way. Similar, if you look at it on the other kind of extreme, if only 10% of stocks on the NASDAQ are above its 5-day average, think about, of all the thousands of stocks traded, 90% of stocks are below the 5-day. Almost everybody's been doing some selling. And so the result is, if you look at, let's say, mid caps, this is like the mid cap index, every time we had high levels of FOMO, those were associated with tops. Every time we had kind of low levels of FOMO, basically fear, that's when the market bottoms came in. So no oscillator is perfect. But for me, this is kind of, and it's interesting, the way I came up with this is when I first found this indicator, I thought it was interesting. And I said, hey, I started looking at the different points in time where we had high levels and low levels. And I looked at my notes and my trades. I said, hey, every time I was feeling like that feeling of excitement, it kind of overlapped when the majority of stocks were showing that kind of strength. And so then bit by bit, it was just kind of, I don't necessarily, if I'm in a leading stock, again, key number one is you need to be in that leading position. I don't want to give up my position just because of a short-term overbought reading. But maybe it's time for me to sell my lagging performers. Maybe it's time for me to raise some cash. Maybe it's time for me to put a hedge on. Let me figure out something where, if we are at this bit of a short-term extreme, how do I dampen the pullback, which we know is going to come? We just looked at before. Even in the strongest of uptrends, there's going to be chop. How do I survive? If, for example, Twilio is about to fall 16% in 4 days, and that's my biggest position, how do I survive that? I have to lighten up other parts of my portfolio. I have to put a hedge on. And so when these get to kind of these high FOMO readings, it gives me the opportunity to kind of reassess, okay, am I overly excited just because everyone's feeling excited? Or if we're at very low readings, we're in fear levels, and you get that feeling like, let me just sell everything, get the cash. Am I overreacting just because it's that natural pull of 5 or 6 days of selling? Maybe there's actually some buying opportunities coming up. So it was a good way for me to kind of test what my thought process was and how to kind of counteract the natural human emotion that we all experience, but with an indicator. And this works great because, again, it's not based on price. It's based on the action of all stocks simultaneously, which gives it a really powerful kind of twist to how to look at overbought, oversold. And so if you look at Celestica, CLS here, once again, that same move, it brings a whole different perspective. So what's interesting is that, this is not a price oscillator based on CLS's price action. This is an oscillator based on all stocks. But you can see CLS, which was a market leader of 2024 and 25, this basically topped and had a pullback or had a buyable bottom only when the majority of stocks got to their extremes. So it's kind of like, if you look at here, for example, we had a big move up in Celestica. It's almost like it came down, but only because it had to. It didn't really want to. And then when things got oversold, we had a nice push higher. Again, we had a big run up. It only finally stopped rallying when everyone got excited. Came down only because it had to. And then the moment everyone kind of got fearful, boom, we started to move to new highs again. So again, if we're running very hot, do I need to sell this if it's my leader? Probably not, but maybe I should consider hedging, or maybe I should consider selling other laggard stocks. So if this does pull in a little bit more, I have more breathing room. And if we go back in time, we look at some other stocks like that Trade Desk example. These are all those steep pullbacks that we had that we looked at in the other example. Well, look, every time we were embarking on those steep pullbacks, look at where that FOMO indicator was. Every single time we were up at elevated levels. So the pain comes in the leaders, not when the leaders are overbought, but when the market as a whole internally is seeing that FOMO. So for me, this was one of those really big, like aha moments. Kind of instead of thinking overbought, oversold, but how to manage the portfolio exposure with the general understanding of how these leading stocks act. If we take a look at Twilio, again, that same kind of look from before. Not always, there's some that are going to be like, here we got to FOMO. We didn't fall apart, but we stopped advancing for a little bit. But being able to sit in this stock was a lot more helpful if we offloaded risk in other different areas. And again, we had this tremendous advance, but areas like this where we had a 17% drop in just a few days would have been much easier if you would have maybe sold some at the strength, bought some puts, lightened up a little bit, or maybe at least sold off other parts of the portfolio. And so again, all this kind of really comes together. This is just a perfect kind of picture of what you're looking for. Is you have a leading stock at the time. This is 2020. So Twilio was right in the heart of like communications and allowing everybody to kind of communicate with each other during the pandemic. You had very strong price action. You're breaking out to new highs. You have a good earnings reaction. There's net highs under the market. So there's more stocks making 52-week highs and 52-week lows. That was confirming, even though we're in this pandemic and people are concerned, well, under the hood, there's so much liquidity coming into this market that it's still pushing the majority of stocks higher. And then being able to kind of survive the back and forth movements of this advance by understanding the FOMO indicator helps you to avoid kind of getting caught up in all of the swift moves. If we look even at the next leg up, let me see here. Yeah, so yeah, if we look at even at the final leg up here where we kind of really got excited, that came off again. The main bottoms, the buying points came when we had broad-based fear. So not only does it help to kind of avoid being overly aggressive on strength, when you step in for buying opportunities, it's also a great time to think of how can I reimagine where I want to start putting exposure into the market. And that way, rather than kind of succumbing to the swings of the market, kind of buying when everyone's excited, selling when everyone's feeling fearful, and then out of frustration giving up because saying like, this doesn't work, and I'm just being thrown around by them. They're hitting our stops. Who's they? There's not one person going around hitting all the stops. It's broad liquidity. It's positioning. But if you're just kind of following the herd blindly and you're kind of putting on exposure too high and then you're selling when most people are fearful, you're just getting stuck in that kind of doom loop of like fear and FOMO that just kind of can't get so many people offside. So not only do you have to understand general trend of market liquidity, if you understand that shop, that'll really help you to kind of do your best to position in growth stocks at the right time and survive the big advances. And that's really what our focus has been for the past, I don't know how many years. And this has been such a transformative tool to kind of help me understand how I'm feeling, what the market's doing, and what my positioning should be. So that's my overview of my FOMO indicator and trends and the pillars that drive this market, which if you can kind of bring all of those together, just do such a phenomenal job of being able to kind of get the most out of an uptrend.
Excellent, Matt. This was really great. My first question for you is more an application question of this and how you actually use it day to day. So talk me through how is this part of your routine? What are you looking for on a day-to-day basis, and how that might say, okay, this reading is high, this reading is low. I'm going to be aggressive, defensive, over the next few days. How do you actually incorporate this into your daily or weekly process?
So it's a great question. So what I really like to do is if we're like in that neutral reading, if we're like, let's say 30 to 70, basically if we're in an uptrending market, take trade setups as they come along. There's no extreme. So just you want to just focus on the visual leading action, take it from there. Once we get up to like the FOMO rate, around 80% on the FOMO indicator, I pretty much back off from all strengths, all buys into strength. If there's a pullback buy that comes a few days later, fine. But to buy a breakout when FOMO is at an elevated level, you'll be surprised if you go back over your past trade. You'll see how how high your failure rate becomes trying to buy when you get into it. So some will work, and that's always the trick of the market. Something will work, but your overall odds of success are much lower. And likewise, when we're kind of already in low readings, let's say we're down at 15% FOMO, which is like a fear reading. If we're in a healthy market and we see a gap lower, rather than kind of, being fearful and selling everything, even if a stock is at my stop, I'll maybe second guess, give it a little bit of time, some breathing room, but really look for new stocks to kind of enter into that weakness. Mm-hmm. Ideally, if we gap down on some stocks and we turn positive, or if we're pulling back to some key averages, rather than waiting for confirmation. A lot of people kind of get that added comfort by saying like, oh, if I can wait for it then to rebound. But then your risk goes up in another way. If we're already at fear readings and we're gapping into support, we're gapping into averages, I'll just buy into that gap lower, especially if it's a leading stock and it's been kind of bucking the pullback up until now. So that's where the context is so important. That's why I started with the context, because number one is I want to make sure I'm in a good market. If we're like in a declining market with like liquidity fall, getting worse and all the rest, like I don't want to buy just because of fear. But if we're in a good market and it's accommodative and the ranges are tight and I'm getting this like opportunity while everyone's panicking because the market's down for 6 days, usually those set up the really good risk rewards for like a very quick rally from there.
And you kind of answered this, but just to dig a little bit deeper, say we're after a significant market correction, are you still kind of waiting for after, initial move up and setups are forming, everything we're looking to see with the leaders, are you still more hesitant to buy breakouts when it is overbought in the short term during that, first period as everything is taking off? Are you still waiting for the reading to settle down again? Or are those instances where the market's just getting going and it might stay high, elevated longer? Is that a little bit of an exception to the rule? Just dig a little bit deeper.
Yeah, I know. So I mean, it's a really good question, and I just want to bring up a chart to kind of take a look at that.
Yeah, please.
So if we take a look at this is general complacency. If we take a look here at CLS, actually, at the start of those uptrends, it's a bit of an irony, but the first readings of FOMO probably aren't a big issue if you're coming out of like real depths, because things are so oversold that you'll have that strength. But you'd be really surprised. The leaders always lead. They're always the first to go before the general market. So by using kind of like the FOMO indicator, looking at all stocks, if your stock's a leader, that's going to break out way before everybody is above their 5-day average. I mean, if you go back to the most recent like bottom in April, and you look at all the better stocks like Rubrik or Palantir or whoever it was that was GE Vernova, like they were all breaking to new highs like way before the market was, way before like now the mid caps are coming into kind of some strength in the rest. So the beauty about using this indicator, again, instead of just a regular price oscillator, is like if you looked at a price oscillator, it's like, oh, the stock's moved up early, it's already too extended. But compared to its peers, it's not. So rather than think of overbought and oversold, I like to think of, is this stock under tremendous demand? And it is if this is breaking out before everybody else is. If you're breaking out and everyone's already overbought, you're like the last guy in the pool. Like nobody wants to be that guy. You know what I mean? Like all the easy money is gone. So ironically, like early in the uptrend, when everything is so primed for these big advances, like nobody wants to buy stocks. And it's so difficult to get readings of FOMO because maybe a couple of stocks start to move. People are, institutions maybe still selling some stocks they're worried about. So before you get these moments of broad-based strength, there's actually a lot of upside in individual leading stocks first.
Yeah, and I think CLS is a great example because it's acting how you would like to want to see your stock act when the reading gets high. It's not pulling back super dramatically until the end here where it gets a little bit wider and looser. It's pulling back into the moving averages. The pullback's a little bit more contained. And just to dive a little bit deeper in that, you've got a good position in a name. When you get an extended reading, how would you like to see it work that out as the reading, comes back, as this general market kind of resets in the short term? What price and volume action are you ideally seeing with the individual name?
I think these are like these last movements are kind of like what would be the ideal thing that, like, if you could say like, Matt, what's the textbook? What's the most bullish setup you can look for? It's like, right here, if you look at this FOMO reading, think about almost all stocks got above their 5 days. So you have broad FOMO. This stock has been a leader. As then most stocks kind of switch from everyone being really excited to kind of suddenly everyone being concerned. This is a perfect example. Like I said, on that last day when fear was present, CLS gapped lower that day, tagged as 21, and then after close basically where it opened. So over the course of time where people went from FOMO to fear, CLS went absolutely nowhere. So like no institutions were willing to sell CLS despite it being a leader, despite it being up so much. As the markets had these internal gyrations, nobody sold CLS. The moment even a little bit of buying came back into the market, we went vertical. I mean, we went from, what was that, maybe let's say 95 to 125 in a week and a half. Like just because this was just showing you there was no selling pressure and or just tremendous buying pressure under the surface. So this is like a perfect kind of short-term way to look at, you know, a leading stock with its averages and price action.
And maybe another really good example recently, which we don't have a chart of right now, but you know, Hood has been one that's performed really well. And at times when the market and the chart itself maybe looks extended, it just kind of resets and keeps going. I'd be curious to hear from your perspective. You know, you've mentioned when you get overbought stuff, you know, you might take some actions to your portfolio, whether that's selling some, whether that's putting a hedge on, whether that's, you know, selling other stuff in your portfolio as well to, you know, weaker stuff that are more lagging. How do you make that personal decision between, you know, a few of your options where you recognize the stock might be a little bit short-term extended, the market might be a little bit short-term extended, you're expecting or bracing for a potential pullback like you've seen in these examples? What's kind of your thought process and how you make that decision and choose, you know, how to handle things in your portfolio?
It depends on a few things. So it depends on general exposure. If you're on margin, you're running really hot, you know, like we can see these pull even 14%, but if every stock is falling 14 or 15%,
because they all do at the same time.
Yeah, it all happens at the same time, right? That's the problem, you know. So one is you're looking at so what's my general exposure? That's kind of question number one. If let's say it's early in a trend and I only have 2 positions on, I'm 35% exposed. Like, well, whatever. I'm in general accumulation mode. I don't really mind if things pull back. I'm protected. So that's a big question. And then 2, let's say I am fully invested. It's like, you know, which are my leading stocks? That's what I think about every day when I'm looking at my portfolio. If I want to sell stocks tomorrow, which is the first ones I would sell? And when we get to these kind of FOMO readings, those are the ones I would sell. And actually, if we bring over Hood, because Hood's been my biggest winner of the year so far. I've been buying this since was it here in early May. And this is a perfect example actually of how this worked in real time with the kind of the FOMO indicator. And this had those very similar dynamics to CLS. Let me just bring my averages on real quick. What you can see here, like I said, that really perfect example with CLS. Look how Hood had the same pattern. We got to general readings of FOMO. This is the leader. And throughout this entire time, as the market kind of cooled under the surface and everyone kind of went from excitement to fear, this stock went nowhere. On this day here, we closed at $62. On this day, we closed at $63. The moment some buying came back in, we went from 63 to 78 very quickly. And so that dynamic, understanding one, you know, you have to know what trend is, but being able to kind of incorporate that FOMO indicator to kind of time your, and again, similar, again, it did the same pattern here again. We got the high levels of FOMO. Yep. The stock was at 70, almost 75. We got all the way down to fear. The stock closed at maybe 72.60. The second buying came right back in. We went from 72 and we kind of launched up to 85 and then ultimately 99. So it's just understanding how much demand is there for this stock and how is it acting relative? Because every stock, it's all a relative game. Like besides retail investors, most funds are all running a relative game. Not just hedge funds where they're long short. Even if you're an institutional investor, it's all about like I have to be invested in the market. So it's not about, you know, how much do I invest? It's which stocks am I going to hold? So if they really like Hood, it's all going to be about, okay, I'm going to sell off these stocks and I'm going to buy Hood. So these relative games that we see with stocks under the hood is just so helpful, so important. And you can see even here, all of the, like kind of, you know, we've been talking about selling and all that, but take a look at all the most perfect buy points of Hood on this advance all took place when there was broad fear in the market. So it was a leading stock under accumulation. The moment we got the fear readings, we bottomed, we took off. The moment we got the fear readings, we bottomed, essentially the low, we took off. We got the fear, we bottomed, we took off. So again, you don't want to trade just with this tool alone, but it should be a really important tool for context. Like, should I be hitting my stop? Should I be shorting this stock? Or should I be trying to really accumulate at this point in time? It's been super helpful. And this is Hood. If we bring up, let's say, a GE Vernova, which has been very strong as well, exact same kind of patterns. The very few times this ever paused, like let's say it did right here for 4 days, another one of our big winners this year is we got the high levels of FOMO. As the market kind of cooled, this went sideways. The second we saw fear, boom, we kind of got going. So been a super, super helpful tool.
I think we were talking about Gev the last time we did a podcast or something, but a lot
That's
earlier.
good. I think I had you. Yeah, that's right. It was way back. I was talking about how I was buying it in this area. I think we were in this area here or something. So yeah, that's right. That's right.
It's been a great name outside the DeepSeek gap down.
Right,
but,
right.
Yeah.
Yeah.
Do you looking at the recent readings and the trends? Do you judge anything in the indicator about how quickly it snaps back from oversold to middle of the range or higher? Because if you look at a few of the circles that you have there recently, you see maybe the next day we get a gap up in the reading or a big bar up. Is do you read anything into that, or you just kind of are looking at the extremes?
This has been like one of those like lockout rallies, like people will say.
Right.
So this has been a very fast like market to snap back from. Generally, like a healthier market should snap back quicker, but there's times like, let's say here, for example, where it took a week where the market just like was depressed and couldn't really get itself going, and then we got going. That ability to snap back quickly goes back to like that liquidity question, the NFCI, net highs. Are we in that strong bull? Like the stronger that bull market, the faster we'll just snap back from these kind of oversold readings. So it depends. The better markets definitely will, and it's a good sign. But you can also see some chop sometimes. So I just kind of think of them as general zones of how aggressive should I be and what should I be kind of looking at.
Gotcha. And it's almost, if you go back to that September area of last year, actually, so sorry, but it's kind of interesting as it was forming that high handle above the base breakout a little bit later on. It was right after the market pullback, and again just went tight, just didn't want to pull back in. It's interesting. It's kind of like using the relative strength line, but you're looking at the market versus the individual stock to judge that RS. So it's really interesting. You mentioned one quote that I want to rewatch and take the notes, but it was basically about your time frame is much more. I don't want to classify you because please tell me if I'm wrong, but more active investor. Position trader. When the market's good, you want to sit with it. You said that big money is made in the sitting, harkening back to the great Jesse Livermore quote. How does this FOMO indicator help you ride a core position for longer, get more out of the trend? It seems a lot to do with the awareness of and just being mentally ready for the pullbacks that are going to come during a strong uptrend, and just being able to weather the storm. Having that awareness to just helps you deal with it a little bit better.
Yeah, I mean the mental readiness, but also like the financial readiness. It's like Mike Tyson. He's famous for saying everyone has a plan until they're punched in the face. You can say like, "Hey, I'm going to hold these stocks. These are great companies. They're transforming things." But let's say numbers. You took your account from 50 to 100,000. You're feeling great, and all of a sudden, 3 days later, you're back at 60,000. You're going to be pretty upset. I can guarantee it. So it's about putting yourself in a position to win, and part of that is being able to kind of sit in those pullbacks. Trading is a lot, let's say like racing. Like I love racing, let's say Formula One and the rest, and everyone who wants to race or likes fast cars, we think of the speed, we think of the acceleration. But if you want to win a race, if you don't have braking, like you're not gonna get very far, So like it's not the sexy part. Yeah, no one ever thinks of racing. Thinks of like, oh, how much braking can we do? Unless let's say you're someone really in the field, So similar with trading, everyone comes to markets and it's exciting to find like the setups and look at this go and like let's go everybody and make money. But that won't get you to the finish line. Like if you don't have the full process, and I know it's a little more of a boring topic for some people. People would just want to hear the buy points, but I'm trying to like talk about something that I wish people would have pointed out to me when I started off, because there's just so much about buy points, and buy points are important, but it's really only one part of the whole process. So again, you want to sit with the leader, great. Go back to a leading stock. Go to, let's say, Qualcomm, 1999. Let's say you go back a little bit in time, and you say like, wow, this is like what a move from 7 to 100. This is like, wow, this must have been so easy. Well, like sit back and look at some of these pullbacks. You went from, this is split adjusted, but from 15 down to 10 something in like a week's time. If you're on a margin to count, like, what's that pullback? Let's see here. Let's say you're in a margin to count, even if it's not all in Qualcomm, but it's in a basket of Qualcomm type stocks. Yeah. And so if you're fully invested in the all pullback 20, well, guess what? Your account's down 56% in a week and a half. How are you going to, do you think you're going to be able to capture the rest of this? And when you look back at this blip, it's like, oh yeah, pull back to the 50-day. That's normal. Yeah, it's normal, but in real time, this is what you see, and it doesn't feel so. You're saying, "Whoa, is it over? Was this the big move? Should I get out of this?" And then you look back and like, oh, that was so easy, and next time I'll do it. But the reality is, if you don't set yourself up to win by proactively being prepared for the pullbacks, proactively being prepared for the right exposure levels, you'll never be able to mentally or even monetarily survive to go the whole way. It just won't happen. You'll never be able to do it.
And like I said, your perspective, your style of trading is a little bit, it's on the longer end. It seems like people are getting shorter and faster these days. But how can a swing trader, a more active trader, incorporate this as well, in addition to yourself, which you use it to more weather positions, weather pullbacks? How can a short-term trader take advantage of this indicator?
So I'm kind of like an odd like outlier, I guess, compared to some people, because I started as a market maker where I traded, I don't know, hundreds of times a day, to now I try and sit in things. But I kind of enter into stocks like a swing day trader, but with the aim of really being able to kind of sit for longer if it works. So I mean, I totally get like the short-term like component of things, but if let's say you are someone who's very much short-term oriented, never mind hedging and all the rest, but just like, hey, like, where do I put down the hammer? Like, where do I really get aggressive? It's like, if I think this is a leading stock, whatever, let's say it's Palantir, let's say it's Hood, whoever, like, I really want to get aggressive when I see those momentary readings of fear. Doesn't always work. You can see here we went up a couple of, well, then it was earnings, so that's not a fair point in time, but let's say like right here, and this is actually where we bought Palantir, so that's how I used it in real time. But that's really like, where do I want to get maximum aggressive is maybe not right at fear, but you begin to, and as you see strength, and you want to kind of get fully invested before you get up into the fear readings. And that's kind of, as a shorter term person, how to best get the most out of it.
Yeah, I think that's perfect. And it's really funny because, back in early 2019, 2020, when I was first really getting started trading and getting under my feet, I would pick the right stocks, but enter at the wrong time, which I think is a common trading problem. And you talked about that today. And I did a post analysis and looked at where I was buying, and I was always buying like 2-3 days too late from the proper buy point. And
it felt good.
It felt good. And then it goes on without me, like you said, and then it feels bad. But looking back on that, it made me change my buy points and refine and get a little bit closer to the moving averages. Kind of how I approach it is I like to buy coils near the 21 EMA. I know you have very similar methods there, but this kind of adds another layer onto that, where it's not just the individual stock timing its chart, which of course incorporates the market, but looking at the market as a whole, and has it already used up a lot of its juice, moved up over the past few days, versus is it coiled and ready and ready to go from oversold to overbought. So I think this is really useful for folks, and I think will help a lot with the entries, because that's the fun part, but also managing a position, like you said, being ready to weather the storm financially and mentally when we do get those pullbacks. Yeah,
it's really about how do you manage both sides of the trade. And I find what's nice about this is it's kind of like an objective numerical way to measure general FOMO. So if you're reacting something out of impulse, and maybe it's a really good stock that's breaking away. And so just because there's, let's say, FOMO, doesn't mean you can't buy into a stock. If you think it's great, this is the opportunity, you're looked into it. But should you be buying like 6 stocks that day? Like, probably not. Like, so it's all about like scale. And at the margin, again, going back to racing, like the wins are all at the margin. It's all like, like no one's winning by like, 10 seconds a lap or something. It's like these small differences, but that's the difference between a professional and an amateur. And in the business of trading, it's like, trading is dominated by like the power law. Like the very few make the vast majority of money. So, it's like that with everything in business related. The best athletes make by far the lion's share amount of the money. So you really, same with actors. You want to get to the top echelon. So those small improvements have dramatic impacts on your performance. So like once you get past the original learning curve, like we were saying 4 or 5 years ago, if you want to get to the point where you can be, a continual winner and build and scale, you have to refine. You have to know. You have to be able to shave off those bad ideas, and that really kind of will shift you out of like boom bust and more into more consistency. And part of it as well is also knowing when it's the right environment in total to trade or not. Right. That's the larger picture. Of course. Any other nuances with the indicator, maybe even
especially looking at when it's approaching oversold conditions, or sorry, overbought conditions, because it does look like there's some instances where it can stay elevated for, 3-4 days. Anything else that you look at during those cases to see, okay, I see it's overbought, but I'm waiting for this one more thing to really, put on a hedge or something similar to that?
Yeah. So one, like I mentioned, like first of all, if they would look at the leader of this cycle, or one of, is
Yep.
Hood. So I mean, just looking at the way Hood reacted with this overbought, let's say Shopify, which has not been like a leader of this cycle, and look at how this kind of like won't get anywhere, and the second you get to FOMO, it's like you give it all back to where you were. So
Right.
if you're holding, let's say Hood and Shop, whereas Hood basically just went sideways, if you didn't sell your shops, you're always giving up all of your profits. So definitely selling off like the laggard types of names. But the other thing also, we had Hood from like way down here. Like I mentioned, we added to it in this area. I forget the exact, I have to check my notes. But what I like to do is, if I do want to hedge, I love to do it on an expansion day.
Mm-hmm.
So those days where you feel really good, like let's say, we had this big up, we climbed 12%. When this advanced the next day, I think it was around 98 actually when we hedged. Felt a little bit off when it went to 100 and plus 100 the day after. But I bought puts lower down, so I didn't actually sell the stock. But at least putting in that hedge is helpful. But when you're already in FOMO, if you have a leader, ideally you hedge when there's that extension. If you take a look at, let's even like CLS for like earlier in the year, let me just get rid of this 34%. But if you take a look here, like when you approach FOMO, again, like the best time was as you were approaching when you got that extension, like a big range bar. I mean, like, because think about it. If you look at Hood as an example, it's pretty odd that this is a stock that's been accumulated for like weeks, months at a consistent pace. And although it's outpaced the market, it's outpaced its peers, it outpaced everybody, it wasn't affected really by even general market overbought conditions. After all of that, people are now scrambling even more to get into this at an accelerated pace. It's like an abnormal, acceleration. And again, we're talking FOMO fear, like probably shows that people are just like, get me in at any price. So if you're going to hedge, that's really the ideal time, is when you're really getting that stretch moment, when you feel so good and like you want to call up your wife or your girlfriend and like say like, hey, like what a day. You better do something to protect yourself a little bit. Yep. Because chances are that's when you're going to run into trouble.
And how much do you typically hedge, and what's your process kind of around that?
So this is something I've gone to like over time and like thought about in different ways. I hate selling the stock outright unless I think it's like a bigger top, because again, rule number one, we're trying to find these leaders. I hate like selling calls, because then I'm giving up my upside, but I have the downside. So what I like to do is I'll look at where I think the stock should pull back to, or at least a minimal amount pull back to. So here it was like 98. I bought like the 90 puts. It wasn't expensive, about 3-4 weeks out. So if this pulls back to, let's say, the 21, or even let's say the 50-day, like really quickly, let's say it's a short-term climax top, like my pain ends really quickly. And rather than being panicked, if it gets down to key averages, I can actually do some buying, because my original core position is kind of handled.
Right.
So it's kind of, if you think of options like insurance, it's like you want to buy insurance when everything is sunny. You don't want to do it when the hurricane is here. So it's kind of, buying out of the money puts is usually pretty inexpensive when you're getting these big stretch days. Oftentimes you can buy it at where the stock was yesterday for like very little money, and you just made that money today. So you can hedge months of gains for like very little cash for 3 or 4 weeks at a time where there's a high probability that you should get some kind of normal pullback. It doesn't even have to be a bad pullback, but like we looked at CLS and Twilio, it could still be 20% in like 6 days, which is pretty gut wrenching, because another thing about like these numbers, it's like 20% in 6 days. Let's just say, for example, let's say you pull back 20, that brings you down to 80. But let's say you bought the stock at 50, you're almost giving back half of the profit. So if like from the top, it looks like, it's a normal 20% pullback. Again, when you go back and study these old charts, I could handle a 20% pullback. But in reality, you're giving back like half the gains. It's worse if you bought even more on the way up. You're giving back maybe 3/4 of your gains.
Right.
So you really want to be cognizant of those swings, because it basically blows up your entire plan if you don't handle it properly.
And it is 3-4 weeks a typical time frame that you'll buy?
Yeah, because like that usually will give it enough time to kind of recatch up with its 21 if it's very extended, or like it's 10 week. It at least that's kind of like like we looked at those other examples, like Twilio and CLS. Like you'll notice like if the drops come, they probably happen over like 5 to 10 days. Those are trading days, So it gives you enough time to kind of assess whether or not this is a normal pullback, or if, let's say, it breaks really aggressively, like, whoa, maybe that was a climax top, and,
Right.
and I should just be happy I have my puts. So I found that 3 to 4 weeks is like a nice zone where they're not too expensive, but it gives you enough time to get a good understanding of what the pullback's like.
Yeah, and just to ask for clarification, the strike price that you did here you mentioned 90. Are you typically doing it, just below the recent range? How do you kind of pick that price?
Yeah, so this was 98 when we hedged it, which worked out nicely, thankfully. And I think the 90s were about $3. So I mean, taking this from $40, $45, whatever it was, this it's a small amount of the gains to protect like a big win all this way up. And so it kind of varies. It depends on the volatility of the stock. It depends like if you get an expansion bar like this, it's easier because you're getting so much short-term gains that you can afford to buy something a little bit closer to price. Because one, I like to use it to hedge downside, but two, the other angle I like to use is that if it does pull back normally, then I can actually double my position. I can get extra aggressive because I have a hedge on the original position. So there's been some times where you already have a good sized position, but you kind of get that turn just right, and you can put on a monster position at very low risk because you have your puts to protect you for another 2 or 3 weeks. And if you can catch the turn, then you get a really, really nice move in the portfolio. So it varies, but usually I'm always looking at about maybe 10 to 15% lower. So, because if you're buying 40% lower, it's like, first of all, it's not protecting you very much.
Yep.
And it's unlikely to ever really help you. So it's about just kind of balancing cost and the likelihood of it actually kind of coming into effect for you.
Yeah, no, that's super helpful. And what would be kind of a situation where you would actually sell some of your position versus looking to buy protection with a put?
So a couple of times, for example, we had MicroStrategy last year, which was really nice. So this really looked like a very classic climax top. So I think we sold this. I think it was on this day here, like 475 or something. It went higher, than it kind of broke. So that's an example where, if from a bigger picture view, if I think it's really extreme, I'll sell. Another one that's interesting is, let's say, ARM, which I have an IPO rule where if I can get a double out of an IPO base, I just sell a position. Because usually after an IPO, so many months later, like the insiders will finally be able to sell their stock. They're restricted for a few months. And that usually puts so much pressure on the stock that your gains tend to disappear, at least in my experience. So this is one where we were kind of buying at the bottom of this base. We added a little bit here, and we were really fortunate to get this great earnings reaction. And so we actually sold this, I think it was like 118, like getting that double from the bottoms. But I mean, it's very hard to take a stock. This ended up, the next day was 164. I felt like kicking myself, but then ultimately it chopped and grinded. And this is what tends to happen, but there's not a perfect science. But so if it's a recent IPO, or if I think it's a true climax top, that's where I don't look to hedge. I just kind of sell the stock and take the win if we're so lucky to have it.
Excellent. Well, this has been fantastic, Matt. Thank you so much. For any indicator, I think it's always best for people to build conviction for themselves, study it, see where it worked, when it didn't work. Any advice for people as they're doing their own research on this indicator, in terms of how to get the most out of that practice? You showed some great examples going back to major corrections and the starts of new uptrends, which I think is the perfect thing to do. Anything else that you might want to mention?
No, I think what helped me was just kind of basically looking at my recent trades and kind of just like the dates of when I did things and plotting with the FOMO indicator just to kind of see, was I succumbing to FOMO? And sometimes, it's psychological, right? So you don't think you are, but subconsciously it is, you are affected by the general portfolio movements and the rest. So just see how helpful could it have been to maybe at least, like I said, to be a pro, it's on the margin. Like, could I have improved my results by 10%, 20%, 50% if it was really helpful, right? or 5%? Like, what could I have done differently if I would have known at the time that, right now, like 87% of stocks are above their 5-day, or only 5% of stocks are above their 5-day. So I think that would be very helpful. Just take that, go with your own trades as step one, and see how affected was I by general FOMO, and you'll be surprised at what the results are.
Excellent. Matt, where can people reach out to you if they'd like to learn more? I know you had that slide up previously, but what's the best email or place for them to your website?
There's CarusoInsights.com. I'm also on YouTube. You can type in Caruso Insights, or on X, you can type in Caruso Insights. So the major platform. I put a lot of informative videos on YouTube. You can check that out, or or just have some general tweets on X. So I'm all around if you want to take a look.
Excellent. Well, Matt, thank you so much. Any last bits of maybe more general advice for folks watching? Maybe pointing to somebody who's a little bit earlier in their trading journey.
I've been trading since I was a teenager. Even before I was allowed to open an account, I had to open up my dad's account. So I've been doing it for a while. I think one of the keys of this business, if you really love it, and you say I want to stick to it for an extended period of time, is you want to focus on longevity too, and not just returns. Because the bigger the returns, and myself too, I've got to follow because I had some good years, so it's normal. That's what people are attracted to. But everyone will always talk about good times. If you want longevity, you have to learn how to survive different environments. And it may not be the sexy part of trading, but the only real fun times come if you know that you have the confidence that I can adapt to different environments. I actually have a good business plan, and it's not just a one-off. Markets are not gambling. To me, it's a structured business, but it can be treated that way. So think longevity, and this is like a beautiful machine that can work for you year after year, cycle after cycle. And so just, think of long game, and it's amazing as you grow, your profits build, your earning power builds at wherever you work, and that pays compounding returns over your lifetime. And that's where like the massive wins happen, and you never feel like the horrible stress of like things blowing up around you, which is, I've seen a lot of times from other people, it's not fun. So just think long-term and think about building an intelligent business with the right tools.
I think that's great advice. Matt, thank you so much. I always learn something new talking with you. Everybody watching, I hope you guys enjoyed as well. Make sure to thank Matt in the chat, and definitely check out his previous presentations at the conferences. They were excellent. There was one on entries. Matt, do you remember the other topic you did?
Yeah, I think I did one on entries, and I forget the other. We did three of them, but
was it at kind of the Fed and the high level macro perspective? That might have been it.
I think one I did on that as well, but like a different variation, and one we did on entries. So
gotcha.
Yeah.
Regardless, they're worth checking out for sure. So, Matt, thanks again so much for your time. Thanks to all of you for tuning in, and we'll be right back with the next presenter. Cheers. All right, welcome back, everybody. It's my honor to close out the 2025 TraderLion conference. First of all, it's been fantastic. Thank you guys all for tuning in. Hopefully, you guys have gotten a lot of actionable takeaways from all the amazing presenters we've had. Today, I'll be presenting on finding and trading VCP setups with RMV, which stands for Relative Measured Volatility. This is an indicator that I created and is proprietary to DeepView that helps you basically identify tight areas which can be actionable both for swing as well as position trading. So let's go ahead and dive right in. First things first, this obviously is the goal, to find a stock like Robinhood early on in its trend, identify a tight area which allows you to enter with a decent amount of size because you can manage risk tightly and logically, and ride that stock as it continues to trend for you above the moving averages. You could enter here, this is a tight area, here's a tight area as well, here is another tight area, and by entering at these points, again, you're able to manage risk tightly with a stop loss under the low of the day of the entry or the recent swing low, and get 10, 15, 20% size into it, and ideally just ride that trend until we ultimately roll over and break the moving averages. But how in the first place do we identify these tight areas? That's what we'll really be focusing on today, and talking about how RMV and looking for RMV close to zero can help you spot those areas. And first things first, this isn't just hindsight trading. Obviously, Hood has been one of the great leaders of this cycle, but I really want to emphasize that this is something that I'll be sharing, in terms of a process focus in order to identify these spots in real time. And these were my real-time thoughts right before this broke out. I actually mentioned it the day before as well, in order to identify this tight area so you can potentially enter on the breakout from that range and ride those trends. So again, we're going to try as much as we can to not be hindsight traders and establish a process, and hopefully I'll teach you my process to identify these spots every single week so you can identify the best risk reward opportunities in the market that's available in every market cycle, not just the current one. Here's also my real-time thoughts in Hood as it was setting up right here. It broke out the next day and continued to trend from this tight area. Again, RMV going close to zero helps me spot that. And I'll show you my process in DeepView for sorting by RMV to help spot these that much faster. Here's another example. We've got Gev from last year. This set up several nice tight areas, tight pivots right here, opportunities through this area here as well, and here on this follow-on buy point. Again, RMV going close to zero during these instances. And this is just another great example and a great stock to study as well, just in general, to help identify these low risk entries. Here is GEV this year now. It basically set up almost this exact same setup with another base, forming tight areas up the right hand side that allow you to manage risk tightly, enter on, and ride this super strong trend that's been on so far. Here again is my real-time thoughts as it approached this most recent tight area, and these allow you again to manage risk tightly and enter at those points where you can size up nicely while keeping your risk in check. Here's app, one of the best examples from last year. Set up a nice proper base, tight area, RMV going down to zero, and just an explosive move and great trend thereafter. So again, I'm going to try as much as I can to not just be pointing out things in hindsight. We will be looking at a bunch of charts today, but what I really want to stress to you today is it's about the process. It's not about really individual case studies that we'll show. It's about how do we develop a repeatable process to find and trade these opportunities at these tight areas, up the right-hand side of a base, at the up the right-hand side of a VCP to participate in that strong trend. All right, so here are the key goals for today's webinar. First, we're gonna talk about how to read charts like a market wizard. You're using RMV as a tool. Know when a stock is ready to go. This is a question I often see. How do I know when to put a stock on my watch list? I've been tracking it for a while. How do I know that it's likely going to make a move the next day? That's what we'll be talking about, and where RMV can really help us. And then we'll also help you identify strong entry points from tight areas. We'll discuss how to trade those tight ranges, and then also develop a repeatable process to find strong VCPs and make use of RMV and DeepView preset screens to help us save time and make sure our routines don't last 2 hours. And instead we can get it done, in a much more manageable time. 30 minutes is, pretty typical for me in terms of going through my major screens and finding these potential entries. So here's the overall agenda. What is a VCP? We'll talk about that. Tight areas, visualizing tight areas with RMV. The RMV indicator explained. I'll talk through the rationale behind it. Screening for VCPs and DeepView, we'll touch on that. How to trade the tight areas, the tight ranges. Handling failed tight areas, because it's important to also show when these instances fail and talk through that. And then we'll have a little bit of a live demo and deep view showing my actual process in terms of my daily routine to find and use RMV. So find VCPs with RMV. And then we'll have lots of examples along the way and case studies, both historical as well as relatively recent. All right, so first is, what is a volatility contraction pattern? Well, a volatility contraction pattern is basically a constructive consolidation pattern within the context of a longer term uptrend. Again, we're focusing on stocks that are trending overall. They're in stage 2 uptrends. We're not necessarily looking to buy a stock that's been in a downtrend for 3 years, looking for a great bargain. This is more of a momentum trend following setup. It's a continuation setup for a stock that's already in longer term uptrend and has paused for a few weeks and is looking to explode and continue on that longer term trend. Basically what a VCP is tightening in price and volume from left to right throughout the base. So this is the prior uptrend. Then we begin the basing process and see higher lows within the base. Maybe there's one lower low, but then overall it really tightens up as it approaches the top of that base right here. What does a VCP indicate? It basically indicates accumulation. These higher lows and overall tightening in price and volume indicate that institutions or larger parties are net accumulating shares, tightening up that supply, and that tight supply, which is a little bit more demand, creates that breakout and expansion that we can ride as traders. The term VCP was coined by Mark Minervini. All legendary traders looked for similar patterns going back to Wyckoff, Darvas boxes, all of that. I even say right here, Darvas boxes, O'Neill cup and handles, Wyckoff springs. All of these are basically looking for the same element of market structure. A strong expansion followed by contraction, followed by continuation expansion, entering here and riding that trend to higher prices. So VCP, is it cause or effect? As I mentioned, it's really a function of supply and demand. Just memorizing the pattern isn't something that you want to do. Memorizing and hoping it'll work. But the process here isn't that there's a lot of traders that are looking for VCPs and that's why they all enter here and that's why it works. What's really going on behind the scenes with the major players, institutions that are accumulating hundreds of thousands, even millions of shares throughout a base and are actually forming the space, and that dry up in supply is what creates the pattern. So again, it's not, we're not just trading a pattern here, we're trading an element of market structure, something that happens over and over again and basically happens every market cycle and will continue to happen as long as the stock market is available. So basing and contractions are caused by sellers getting absorbed throughout these contractions. Buying pressure supports the stock on any pullbacks, and selling pressure gets weaker and weaker, causing those higher lows, especially at the right-hand side of a base. So here's a zoom in of what William O'Neill looked for in terms of his version of the VCP, which was the cup and handle. We've got some examples here from his notes. He basically looked for tight weekly closes, especially in the handle. Volume dry up in the handle. You can see right here a good example. We've got tight closes as well as really strong dry up or significant dry up in volume, and then expansion on the actual breakout. And we're looking for larger volume up weeks, lower volume down weeks, volume explosion on breakouts, patterns within patterns, tight areas equals accumulation. And this point right here, I really recommend you guys go look back at Ross Haber's presentation at the very end, where he talks about looking at a weekly chart and counting accumulation versus distribution, because that's exactly what we're talking about here. We're looking for constructive price and volume action within the base, suggesting accumulation. We're not looking for big distribution within the base and then it might be faulty. We're trying to find really clean A+ examples. Stan Weinstein also looks for this exact same thing. Here's his continuation setup from his book. We've got a longer term uptrend. We're above a rising 30-week moving average. We're forming a base for several weeks, and this is the stage 2A continuation breakout. The stage 2 breakout right here, breaking out of this base. We're in an existing stage 2 uptrend, and then this is a base, a continuation pattern, and we're off to the races and continuing on with that longer term trend. So let's take a step back. Tight areas, why are they important? Basically, we're looking for tight ranges, tight closes, low volume, and I'm speaking more on a daily chart here in terms of the time frame that I'm focused on, but the same process and same rationale definitely works on weekly charts, and that's a way to find constructive bases, but also on lower time frames as well. Basically, a tight range indicates a lack of sellers. As I mentioned, basically big players are accumulating supply, and absorbing any sellers that come to market. And throughout the base, the sellers become less and less powerful, and that's what creates the breakout out of the base itself. It's basically a key sign of accumulation as buying pressure pins the stock to a level and accumulates any drawdown that happens and pushes it back higher. And most importantly, and this is what's great about tight areas, is that these spots, which often occur up the right hand side of the base and shortly thereafter the base, often can be used as an excellent entry tactic / setup, because we've got a clear pivot point, which is your buy point. We can manage risk tightly by putting your stop at the low of the swing low here, or at the low of the day as we actually break through this consolidation pivot or breakout point here. And what's best is if we fail and roll over, quickly if we're wrong, and either the base needs to tighten further and mature more, or simply we roll over and that's the end of the trend. But either way, you're out with a small loss relative to the potential gain if it does push higher, break out, and continue on with this trend. And that risk reward, that asymmetric risk reward, is exactly what we're looking for with this setup. So what makes an actual tight area? I mentioned a few of these things already, but we're always looking for a strong stock backed by a story, theme, an edge. What's been driving the markets the past few years, AI and AI peripheral themes. Recently, we're looking for a recent show of RS, of power. That could be a recent gap up, maybe the gap up off the lows of the base or even through the base pivot, and then we tighten up, form a tight range. Or it could just be, again, a push off the base lows powerfully for a week or two, that then pulls back, tightens up, forms that higher low. That's what we're looking for in terms of recent show power and relative strength. Another one that happened quite a bit recently with Palantir, with Hood, is as the market was correcting recently, this most recent market cycle, all those bases, these base lows, held that 200-day moving average when the market broke below it. So again, we're looking for signs of relative strength. We're kind of accumulating that evidence that the stock is showing potential. And that is a great example, just recently, the past few months, of a sign of relative strength that then you want to look for a push off lows, the first higher low or second higher low, and a tight range to form that you can enter while managing risk. So again, we're looking for a larger pattern such as an early stage base, and then a tight area that happens within that larger pattern. And again, it's best when the tight area occurs near a key level. This could be a moving average, the 21 EMA. Maybe we broke through the 21 EMA and are pulling back into it. That would be good confluence where a tight range here forms right against that moving average. It could be the anchored VWAP from lows or earnings gaps, or just under or over a base pivot. If a tight area formed right near the top of the base or just below it, that's significant as well. And basically what we want is it to be tight enough to manage risk. So again, this should be against the range lows, the low of the day. Ideally, we've got an inside day upside reversal on the right-hand side of that tight range, and I'll talk about priming the setup in just a minute. But also going back to this here, we're always looking for a confluence. We're looking for a confluence of reasons why we should be focused on a particular spot on the chart. Confluence gives us confidence that the trade is more likely to work. So again, when a tight range, which is a constructive price and volume characteristic, occurs near a significant level, that should really catch your eye, and again, get a name on your radar. The Hood example we showed recently, the first tight range that was really actionable happened right above the 21 EMA. On a pullback to the 21 EMA, formed a tight range, showed support there, and then pushed off, and that was an excellent, low risk, high potential entry spot. So that's a good example to go back and revisit. Some characteristics of the best tight areas. Again, it should be in the top 2/3, so kind of, off the bottom third. I don't really like playing down there too much, but the top 2/3 of the base, that's kind of where I look to focus and find tight areas. It could be the first 21 EMA pullback after the base breakout. So say we actually broke out here and then we pull back into the 21 EMA, that caught up to price. That can be a great actionable area as well as a 21 EMA pullback within the base itself. It should be a high momentum name. It could be the first pullback to the 10 EMA versus the 21 EMA. For the very fast names, if it's pulling back to the 21 EMA, maybe the trend's actually already over. But for the really fast ones, and we've seen a lot of that this cycle, they won't even pull back all the way to the 21 EMA. They'll stay above the 10 EMA. So that's what I'm talking about here for very high momentum names in strong markets. We want to ideally see low volume on the pullback. Again, constructive price and volume signatures. And ideally we get a shakeout or an upside reversal or inside day to prime the breakout. So within the tight range, if there's an upside reversal that got bought up, That ideally, makes the setup even better because we shook out a lot of the traders, the weak holders, and they have to buy it back, or they're just left for dead when the stock ultimately breaks out, and they have to chase it higher, adding fuel to the fire. So I always like to see a shakeout or upside reversal within the tight range before that pivot breakout occurs. So here are a few of the priming patterns I look for. Again, it could be an inside bar. It could be an upside reversal. It could be a positive expectation breaker where we close negatively. Maybe we undercut the low of the recent range. We undercut that and then gap up and hold back in the range. We'd be looking for a breakout the next day, or even just a tight setup day where the range is much tighter than usual, or the range from the open to close is much tighter than usual, and this overall range again is tighter than recent bars. These are 4 priming patterns that are really good to learn, but not just memorize. Again, understand why we're looking at these. Inside bars and tight setup days are basically signs of overall contraction, and from contraction comes expansion, while these middle two, the upside reversal and positive expectation breaker, is basically a shift in short-term momentum, where momentum was going down and it tried to go down further and then was immediately bought up and supported, and we're looking for follow through up. Similar to this one, we're expecting continuation down after a very negative bar that closed near lows, but what happens instead? We basically pop up and push higher and hold. That's a positive expectation breaker. And this was coined by Mike Webster. Shout out to him, taught me an immense amount. So again, the positive expectation breaker, great short-term pattern to learn, to understand. But again, don't memorize these. Understand why we're looking at them. And context for these, and I even say it right here, context for these is huge. You don't want to just be trading a random inside bar in the context of a downtrend below the moving averages, expecting a strong expansion the next day that follows through and is the bottom of the stock. We want to be looking for a strong stock with a great edge behind it, a great theme, up the right hand side of a constructed price and volume base, showing a VCP characteristics, and then within that a tight area, a tight range that then has an inside bar. That's what's going to make the move, the expansion, more explosive, and what gets us in a profit right away and allows us to manage risk tightly at the low of the day as we break out, or at maybe the low of the prior inside bar. So again, for each of these patterns, we're looking to enter as it breaks through the short-term pivots and completes larger setups. That's key. All right. So another great example of VCP characteristics is after a gap up. You guys have probably already seen these. There's a strong earnings gap. You feel like you missed it, but then it consolidates, it pulls back, it tightens, and forms a tight range. Now, this might seem very scary to trade because we had this recent gap up. All gap ups get filled, as we know. That's a joke. Not all of them do. But it's a great way to enter a name like that while managing risk tightly. So after a gap up, if we get a tight range that forms, look for a breakout through that range pivot here, and that can be a great spot to enter. So again, after a strong gap up from a catalyst, stocks will often tighten, or U-turn will get a gap up and then a tightening in price and volume action. This will be shorter than a larger VCP, but basically be the same thing, condensed. Then we're looking for lower volume on these pullbacks and tightening and subtle higher lows if possible. And even better, if we get a shakeout that then gets bought up and forms a higher low, that's ideal. And again, this allows us to manage risk tightly and logically. And when gaps are in vogue, this is an excellent entry technique that can really get you on some of the high flyers. Last year, Sezzle, Dave, there were so many earnings gaps that, moved a tremendous amount. And it's hard to get on those, but you can find a spot using a tight VCP after that gap up. So again, tight areas can help you position with size after a stock has already shown that it is special with that gap up. Here's an example from Reddit. This is one I traded personally. I had a position before it, but also it pushed higher, then pulled in and formed a tight range. You can see R&V went down to 0, volume declining as we're pulling back, constructive price and volume action, and then we get a breakout through these highs, this tight range. Entering here, I added, in this case, and you're off to the races and are positioned nicely for the resulting move. So again, after an earnings gap, move higher, look for a range, the first pullback, the first higher low, and look for lower volume on the pullback, and then a tight range to form where you can manage risk. That's the name of the game. We have to be able to manage risk, and this gives you a way to do that. And R&V going to 0 after that is a great way to objectively say, okay, ranges have tightened, we're looking for expansion that reconfirms the move we saw with the strong gap up. So train your eyes, look for tight areas of VCP action, looking for tight ranges, tight closes, low volume at the right-hand side of a base. These tight ranges can be as little as 2 to 3 days, so it can be pretty subtle. And this is where, it gets complicated, especially for newer traders, because it can be hard to spot out these ranges when you're not quite used to looking at, many charts. Everything might look like a tight range, but we'll kind of walk through how to, train your eye, and also talk about how RMV can help in this situation, especially if you're new at this, to at least confirm that yes, what you're looking for is a tight range. So again, tightness can be even 2 to 3 days, and we'll go through some examples shortly here. So here's Palantir. I don't really have the ranges marked here, so take a moment, look for yourself, follow the stock's chart from left to right, and try to identify any tight ranges that you can see. And again, these can be as little as 2 to 3 days of tightness where the market, the stock pauses and goes sideways, drifts slightly lower. That's what we're looking for. So let us see, what we can find, and I'll show the example in just a minute here as I get a sip of water. So think in your head which tight ranges you see, and I'll show the example in just a minute. And you might be able to cheat a little bit and use when RMV goes down to 0. That can help you spot some of these as well. But let's go ahead and show the answer here. So here in yellow, I've identified a few of the tight ranges. We've got the IPO base that forms. Then up the right-hand side of that IPO base, we see tightening in price and volume here. Very tight action, inside bar right before that breakout. Again, priming that setup. And then as we expand higher, we kind of contract again. So after expansion comes contraction. Expansion again, contraction for 2-3 days here, expansion again, and then we draw down a little bit more, are forming more of a base, and within this base, we are seeing tight areas. So this is a short 2-day one, this is a little bit longer, but again, we're just looking for a period where there's contraction and volatility relative to the recent price action. And that can be, again, a spot where you can enter. This could have been a nice swing trade, very quick swing trade, but also just it's a constructive sign of accumulation and tells you to really focus on that name. And as we continue throughout the space, there's tight action, very low volume overall within the space, exactly what you want to see, very textbook, tight area to end out the base, and then we get the breakout and a nice, I think, 50% swing, out of here before it rolled over, as many IPOs do. But this is a good example of training your eyes to spot these subtle tight areas, and likely there are a few in here that I missed, so think to yourself, this could have been a little bit of a tight area here. Right here, this first two days, tight area, we get expansion out of there. So basically, you're just looking, again, for a spot where there's contraction for at least a few days. It can be on a little bit of a drift lower, sometimes a little bit on a drift higher, as long as there's maybe an inside day, 1 day of pullback at the end of it. But yeah, basically very simply, we're looking for a pause after some expansion higher. Here's some examples to further cement this. We've got Shop back in 2016, I believe. We got a nice base VCP getting tighter from left to right. We see a steep drawdown here. It immediately pops back up, a sign of power. And then what happens here? A very tight range forms relative to recent price action. And this is at least actually about 5% deep. And this is the pivot right here. And if you look at this, it drifts a little bit higher, but overall is within the same consolidation. This is the breakout, and as we go on, here's another tight area, move higher, tight area, this becomes the next pivot. Breakout of that forms a consolidation, a little bit whippier here, but breaks out of that and continues on. And I think this moved about 200% over the next year or so. Here's another example. Later on during its move, we have a base that forms. It's a little bit sloppier, but as we go from left to right, you can see higher lows start to form. And then we see a nice tight range. Look at how the highs are close together here. We're tightening up. We're in a slight pullback mode here, but it's on lower volume. And we see, a clear pivot that forms through these two highs. And then we break out here and are off to the races. And the big benefit here, and I should have mentioned this earlier, why are we focusing on these tight areas? Why aren't we just buying the base breakout? Well, if you're just buying the base breakout, you can do that, but it's a little bit more obvious and in the eyes of the market, and there's often a lot of volatility, a lot of shake and bake here near this pivot, where traders that bought the low of the base that are playing the mean reversion to the top are selling. We get a large drop, and you can easily get stopped out before it ultimately breaks out and works. And if you want to manage risk tighter, say you're buying this breakout, you can't really use a 4% stop here because, you know, it could easily pull back 4% and have nothing be wrong with it, just form another higher low and continue on without you. So really the benefit of the tight range, it allows you to enter at a spot where you can manage risk that much tighter and therefore size a little bit bigger if you're more experienced, or just keep overall your risk management in check and basically have a cushion going into the spot where there's likely to be some volatility. And that allows you to sit through any pullback here and let the stock work and let the stock trend. So that's the big benefit of buying a little bit earlier, is we're not trying to buy the low of the base necessarily, but we're trying to find spots where we can manage risk at the right hand side. And if we're right, we get in a little bit earlier, a better cost, and are able to sit with any, you know, normal natural reactions, as Mark Minervini likes to say. Here's the Google IPO base here. Again, we've got to push higher, start to form a base. These IPO bases can be a lot shorter than normal bases, and we see very tight action near the bottom of this base, and then we get the breakout. We get an inside day priming the setup before this breakout, and enter, and you're off to the races. And this is one of the obviously best stocks in history here with Google. Here's a very recent example with CoreWeave. We've got strong power off the initial days of the IPO. Pullback here. We try to break lower, but instead, you know, pull back into the base and respond nicely, and then form a nice tight range. RMV going to 0. You can draw the pivot across. We get a gap above it, retest of it, and then strong action the rest of the day. There's another spot here. RMV going to 0. You can draw that pivot across, where you get another positive expectation breaker, and you're off to the races again, about 300% in about 35 days. So again, RMV can really help with these faster IPOs to identify the first tight range within the IPO base. That's what we're really looking for the first or second tight range here within the IPO base. That's often a great spot to get into. You can see there's a little bit of volatility here at the actual pivot, but this helps you get in earlier and potentially participate in a strong move like this, which was definitely an outlier, but can really happen with IPOs, and you want to be involved when it does happen. Here's FSLR back in 2007, just to show, you know, this happens throughout history. We've got a typical base within the context of a longer term uptrend. We have a tight area that forms right near the 21 EMA. This would have been a potential buy point here. It pulls back into that level, responds again, and then right below the base pivot, again looking for confluence here, right below that key level, we get the next tight area that forms. RMV goes to 0, and then that's your signal, say, hey, watch this for a breakout, watch this for a breakout of this tight range. That would also coincide with that confluence of breaking through the base pivot. So that's what we're looking for, confluence, and just you know, more reason that the stock is going to expand quickly from that area. You know, if instead the stock, you know, just went straight off the bottom and approached the pivot here, there's not as much juice left to really start the trend and get it going. Versus here, you've got contraction right before it, so when it gets going, it can trend a little bit nicer and cleaner after it breaks out. Here is Palo Alto Networks. You've got a base here. This is more of a bottoming base, but we get a strong move higher and then a tight contraction after this gap. Look how, you know, we get a gap up here, and anyone who owned here who's maybe looking to sell, you know, sells out here, but all that selling pressure is absorbed. There's some tight days on volume here, and basically we form this overall contraction, and then we get a nice pop here, and then a very tight range right after. Both of these would have been sound buy points here. You get a setup day right here, and then this day again is just very, you know, overall tight, and we get a nice breakout, and we're off to the races, and you get a few other tight days, tight ranges after during the trend as well. Here's Tesla after the gap again. This is back in 2019. Strong gap up on the highest volume in the year, highest volume in the year again, and we get, you know, push higher, tight range, U-turn pattern, and then this is the buy point to right here, and then even after it pulls back, resets, we get another tight range here that ultimately breaks out and trends nicely. Here's TTD on a daily chart showing this nice overall VCP pattern. This is the handle, and if we look at a weekly chart, because RMB can help with that as well, when we're seeing these tightening ranges on a weekly chart, this, especially for position traders, is something to look out for. RMV on a weekly chart goes down to 0, really showing you this tightness, and then from this expansion, this went about 200% in just a matter of a few months. So again, on a weekly, you can definitely use this as well as an objective measure of, hey, we're tightening, likely it's a 3 weeks tight, and this helps you spot that as well. So again, returning to some characteristics of the best tight areas. Again, we're looking for the top half or top 2/3, you know, from the base breakout. We're looking for the first 21 EMA pullback after the base breakout as well, or for really high momentum names, it could be the first pullback to the 10 EMA. Ideally, we get low volume on the pullback, And ideally, again, we get that setup, that tight range primed with an upside reversal or an inside day, a tight day, or a positive expectation breaker. That's what we're really looking for to really say, okay, this tight range is ready. I'm gonna have it on my watch list, my focus list the next day for potential entry. Here's another example from app. This was last year. Many of you guys probably trade this. Again, we get a little bit of volatility near the top of the base here, but it resets, forms a nice tight range. RMB goes down to 0 at the 21 EMA, and the confluence of not just the 21 EMA, but the overall base pivot as well. So this just adds fuel to the fire. You get all the highs lining up. That becomes your buy point. That's your pivot, and you're entering the next day, and this just exploded. And as it trended, it formed more tight areas where you could have added or just step aside and say, hey, it's trending nicely, showing natural price action. I'm going to stick with it until it really breaks trend. It's always good to see further on ranges within a strong trend that allows it to keep going. That further contraction allows it to re-break out, pause, re-break out, and that's what really creates the strong momentum moves that we see in the markets. Here's another example on a monthly chart. So again, this is app on a monthly. We've got the first tight range defined by RMV here on a monthly here, breakout. This was when Nick was getting involved here. He was trading this really nicely throughout this move. And then this base, look how tight this was on a monthly chart, RMV going down to 0, and we just saw great expansion from this point, one of the great opportunities off these bear market lows. Here's QFIN on a daily chart, again showing a really nice tight range, RMV going to 0, volume is nothing compared to the average, and then we see the breakout move here, tight range again, expansion, slight pullback, and expansion again. So often, we'll push higher, tighten again, and then expand higher. That's really constructive after a breakout. That's what we really want to see. Here's an example with Duolingo, where the first breakout move, this would have been bought through the high after the upside reversal. It fails, but overall, it still stays tight, and it's just kind of maturing in its base. Overall, this entire base is pretty tight, but we pull back, form another tight range at the 21 EMA. I prefer tight ranges at that moving average, and here's the next buy point through those highs, expands higher, tightens up again, expands higher, and then this was a strong 35% move in 12 days from that buy point. Here's SE. Again, we have strong expansion higher, pull back into the confluence of levels where we got the base pivot, we've got the 21 EMA, we've got the tight range with RMV forming here, and we see strong expansion from this contraction, and it even forms one more and expands again as it begins its trend. Here's UPST. You've got a very short tight range, just 2 days, RMV going down to 0, and this is the low risk buy point. It's very hard to find a tight entry on a name like UPST, but this helps you identify those, and you can put your stop under the low of the day, the low of the prior day, and ride this trend. And again, this is about 36% move in just 10 days. Here's another example with ASTS, a very powerful mover, gap up after a news catalyst partnership with either Verizon or T-Mobile, I don't remember, on this day, and we had a further partnership announcement on this day, but we have a strong gap up, expansion move higher, then that normal pullback and higher low that then tightens up, RMV going down to 0, and then we see an expansion higher from that level. So we're really looking for two situations. One, we've got a base that is a VCP tightening from left to right. Maybe there's a shakeout in there, maybe it's a double bottom, but overall it's a mature base, and we're seeing a tight range up the right hand side of the base after the stock already looks to have bottomed and had pushed higher off the base lows. And then we're looking for, again, that first higher low tight area. Maybe it coincides with the 21 EMA within the base, maybe it doesn't, but again, we're looking, that's kind of the first situation. Then second situation here is exemplified with a gap up, expansion higher, pullback, and tight range. We saw this with Reddit. You see this over and over where we get an expansion higher, there's some natural selling, and then we expand higher again and really begin that trend. So that's kind of the second situation that we're looking for in terms of RMV and VCP characteristics. Here's RBRK, a recent IPO. Back here, this is this IPO base, and it formed a nice tight range here. Even here is tight as we form the first higher low. Look at these closes all close together. We've got RMV down to 0. This would have been the first viable pivot, even through this high, this upside reversal, and then we push higher, form another tight area, really tight inside day, RMV down to 0. These highs line up, that's your pivot, and we expand higher from that point, and we're off to the races. And RBRK has continued to be a really strong stock in the cybersecurity space. And here we expanded 15% in just 3 days during this move. Here's Oklo, very fast mover. We had tight areas up the right-hand side of the base here that could have been tradable. And then here we had a 20% move in 1 day after a subtle tight area that, if you're not, looking at RMV or aren't very experienced, it might be hard to find, this type of setup. But very strong expansion after this contraction. Here's Lunar again, strong price and volume action up the right-hand side of the base, higher low. RMV goes down to 0. Very tight day. Look how tight this is. This is a key thing you want to look at. During these tight ranges, watch for these very tight days on very low volume. This is what Leif Sarita calls the reverse pocket pivot, the lowest volume over the past 10 days or so. And that really, that often happens before we expand higher. So look for this type of day within the context of a tight range, within the context of a larger chart pattern that is in a strong uptrend and showing a lot of power as well. This is great for swing trading, entering through that high, and then selling into strength or just riding that trend, that 10 EMA trend higher. Here's MSTR again, really strong move, multiple tight areas during this move higher. Again, they could just be as little as 2-3 days. This is a good question here. I get this question a lot. If there's a wick, do you draw the pivot? And I typically ignore it. I'm looking for to draw the pivot, the actual buy point, where most of the highs coincide. And usually I'll use the most recent high if they're a little bit different. But basically for this area right here, we've got this wick higher, but I'm not looking to buy here because for me, to my eye, the range is right here. And this high becomes the buy point. We've got an upside reversal that primes it, and we're off to the races the next day. Again here, upside reversal, buy through the high. This coincides with the base pivot here. So numerous reasons to be watching and buying at that point. And again, we've got some volatility at the base breakout. So if you're buying here, stop, here, you're stopped out right before it actually makes the move. And again, here, we're in the trend already. We get a sell tight area. One more opportunity to jump on the trend before we get the key reversal bar down. And we begin the larger drawdown here, in this case with MSTR. NVIDIA, great stock, obviously, to study back in 2024, 2023. Constructive base here. We get the expansion down, higher lows off the bottom, really nice tight areas. You can see RMV fluctuates up and down. That's fine as long as it's staying below 10. I pretty much consider that tight. And we'll be looking for an entry, an expansion higher, or a way to accumulate versus the lows or versus the 21 EMA or 10 EMA even in this case. All right, so revisiting again, the characteristics of the best tight areas. Now that we've seen more examples, you've trained your eye a little bit more. We're looking for the top half to top 2/3 of a base. We're looking for the first 21 EMA pullback after the base breakout as well. That can be actionable, or for high momentum names, because some don't even pull back to 21 EMA, it can also be the 10 EMA. We're looking for low volume on the pullback, a shakeout or upside reversal or other priming setup just before the potential breakout through that pivot. And ideally, again, it's part of a larger theme. It's got a catalyst behind it, and it's ideally a name that can actually move. It's got a 3% ADR at least, and ideally also recent IPOs. They tend to work really well for this type of setup. All right, so now we've covered a bunch of examples. Let's talk about how to find VCPs and tight areas easily. So let's go ahead and dive right in. So again, RMV allows you to kind of objectively define whether a stock is forming a tight range or not. It basically looks back at a set of days. Typically the default is 15 days, and defines what a normal volatility looks like. And then whenever volatility on average over recent days gets below a certain number, it will then objectively define volatility RMV on a score of 0 to 100, with 0 being very tight and 100 being price expansion. If we're getting close to 10 and below, especially 5 and below, that suggests that the tight range recently is much tighter than normal, as potentially actionable. So again, RMV compares the current volatility to the average over a certain period, a look back period. A value of 100 equals price expansion. A value of 0 equals price contraction. You can change the period. Default is 15 days. I'll tell you when I like to change this. I'll use 5 for IPOs or recent gaps. I'll talk about that a little bit more later. But just remember, low RMV, getting close to this lower band here, getting close to 0, equals low volatility, and a tight range that forms. High RMV suggests expansion. It can be expansion up or expansion down as well. So either way, it will be expansion. So again, up here, price expansion. When RMV is down here, price contraction and a tight range is forming. So why use RMV? For sure, experienced traders who have been doing this for forever, they don't need an indicator to help them identify tight areas. But for people who are newer at this can be a really helpful, objective way of defining whether a stock is tight enough for a potential entry, or is even potentially actionable the next day on expansion from that tight range. And in addition to that, and for even advanced traders, RMV and using that indicator to sort and screen buy saves you time by allowing you to focus on names that are actually tightening up constructively. So that's the benefit of RMV. So again, it helps draw your eye to key price action, identify stocks that are ready to go, and can save you time during screening and sorting, and we'll show actual examples about how it does that in just a minute. So interpreting RMV, just to show some examples, again, NVIDIA moves strongly from this point. Here we've got RMV plotted below. We've got price expansion when we get near 100, and then this lower band here is under 10, and whenever RMV gets below 0, we're basically tightening up in price. Here again, it's getting below 0. We're seeing price tightening relative to recent price action. Here we get below 0, and we're tightening relative to recent expansion. Here we get below 0, and you can see tightening in closes and constructive range building. Here we get below 0 again. We're starting to see tightness over a few days. You can see it's pretty sensitive, which actually makes it better and more useful. There's not too many false signals here. And here we get below 0 a few times and stay below, really showing and emphasizing this tight range that we're forming. And then again, here's the buy point through these highs, and we're off to the races and into the next part of the trend. So again, really look out for when this gets below 10, especially below 5, and especially if it stays there. Now, there might be a tight range where it gets a little bit, we get a shakeout, upside reversal, and it stays within that range. That might jump the RMV a little bit, but as long as we're still in a range that was identified when RMV went below 10, below 5, that's still what I consider a true range and is actionable on a swing trade or position trade basis. Here's DocuSign. This part, this portion of the chart really is a great example for interpreting RMV. Again, gets below 0. Look how tight this range is. We pop higher. We start to form a range here. It approaches 0, gets very low here. Identifies this range. We see some expansion higher. Expansion goes to 100. Here's a tight range again. We go to 0, and we see this over again. Expansion. RMV goes down to 0 when we contract after that expansion. Expansion, contraction. Expansion down. So again, we increase the RMV here because even though there's an expansion down, it's still expansion. And then we get further contraction, RMV getting very close to 0 here, and we expand higher, and that pattern continues over and over again. All right. So probably some of you guys are asking this, do I always use a 15-day look back period? And that is the default in DeepView. I pretty much always have it at 15, except in a few situations. So 15, if you're only going to use one number and don't want to change it ever, just use 15. It will do just fine. But I do like to switch it to a 5-day period look back for IPO bases, recent gaps and very high momentum movers, hide AER names over 4%. And basically what this will mean, it'll be more sensitive and will track those faster names a little bit better. But you will get a little bit more fluctuations up and down. So use RMV 15 if you just want to set it and forget it. But if you're more advanced and like to trade the faster names, RMV 5 is really good. But what I would suggest to you is just go ahead and experiment. Try it out for yourself. Try it out on trade examples from the past where you're trading VCPs or post gap ranges, and see which one helps you out the more, whether it's keeping it at 15 or switching it between 15 and 5. Here's an example of comparing RMV 15 and RMV 5 here with Palantir during the IPO base. Again, both of them identify this last really good buy point with the inside day. You can see it went down to 0, but the RMV 5 is going to be a little bit more sensitive. So the RMV 5 is on the right hand side, the RMV 15 is on the left hand side. And you can see the RMV 15 needs 15 days of training data to actually show a result, while the RMV5 only needs 5 days. So that's another benefit of using it for IPO basis. So that's one more example. It can show earlier tight areas, but this compares it nicely on PLTR. Also, after gap ups where there's really big expansion, RMV5 is better and will give you a cleaner signal after the fact, because if you look at RMV15, all the ranges that are forming in here 15 days from that expansion are being compared to the significant expansion we saw. So they're always going to look a little bit low, and sometimes they're going to be low, but the RMV5 will reset a little bit faster and show kind of true tight areas after a gap up like this. So that's why I like to use RMV5 after a strong gap up. On a weekly chart, I like switching it over to 3. That does a really good job of finding tight weekly ranges, and this can be really helpful. This is the NVIDIA classic breakout that had a 3 weeks tight at the end of it. RMV went down to 0 right before it, and we saw that expansion up nicely and quick double here. So for weekly charts, I like RMV equals 3. All right. So let's take a step back and really talk about how this becomes actionable. And this is RKLB, a really great swing trading name from last year. And let's talk about how to identify ranges and identify the pivot points from these ranges. So again, going from left to right, here we've got a base, expansion higher. We see tightening in price, especially these last 2 days. RMV goes to 0, so we've identified a range. What's next? We have to identify the potential buy point, the pivot point. I look at the range and see where the highs are typically, and basically I'll ignore most reversal down days and look at kind of the true highs and highs that kind of form the range. And for me, I would draw the pivot point from this upside reversal high over across, and if you're on this day, that would be my buy point for the next day. So we'd be looking to enter here, and as it pushes higher, you buy off the open. Set your stop either at the low of the day or even the low of the previous day, because that's pretty tight as well, and you're off to the races. So that would be the buy point. And you can see, these highs are pretty close together. So if you use this high versus this high, in this situation, it didn't really make a difference. But typically, I like to ignore the wicks, the downside reversal highs. Let's go to another example. So again, we get expansion up. We're forming another mini base. Here we get RMV close to 0. All the closes are close together. Again, I try to ignore these wicks. So I would actually use this high to draw it across. This high matches up with this high nicely. So that would be my buy point. In this case, the pivot breakout doesn't work, and we expand lower, so you'd be stopped out here. That's trading, that happens. But it tightens up again and forms another tight range. So RMV goes down to 0 on this day where we have an inside bar. So what do? We look for where the highs are and where the buy point would be. So looking at this range, which was identified by RMV, this high, this high, and this high are all pretty close together, so it's not too bad to use either of them. But to my eye, this high and this high line up closer together. This one a little bit of fade off highs, and just the inside bar is the most recent high. And from contraction from an inside bar often comes expansion. So I pretty much draw it right through these two highs and more weighting it towards the inside bar high, and that would be the pivot point. Really good entry, nice expansion the next day. So again, we can do another example. Here RMV goes down to 0, so you're looking for where the highs line up. All these highs are pretty much the same, so I draw one across here, and that would be the pivot point. It expands a little bit higher and then tightens up and forms another range here. And this pivot point is pretty much the same as this pivot point. And I've actually noticed that this is a really good thing because basically ranges are happening right on top of ranges. And I'd move it towards these highs. This would be the new pivot point. The high of this upside reversal, this inside bar line up pretty close together. So that would be the new pivot point, and you're off to the races here. Let's do one more example. We're in a consolidation here. This is the point where you get on your screens, RMV equals 0. This is the inside bar. So I'd basically put my pivot point right at that high. It's a little bit lower than this high, which is the other part of the range. And just again, from inside bars, I typically draw the pivot at the inside bar or the upside reversal because I like those priming setups. So that's a few examples of actually drawing the pivots. And here's a few of the ranges we just talked about. Here again, we set up, I wouldn't draw it at this wick, I draw it at this high. And that would give you a good buy point to add, and this continued on and trended really nicely. I do want to mention that this doesn't just work for to the long side, but to the short side as well. It works extremely well. Again, all markets oscillate between expansion and contraction. That's the element of market structure that RMV is helping identify. And expansion definitely happens to the downside as well, especially during corrections. And here we've got ARM. Again, we've got a base that moved up. It wasn't able to really push higher. It's forming a base. You've got some lower highs. It's very tight, maybe too tight for too long. It tried to break out, couldn't. So there's some sign of potential distribution in here, downside reversals. And overall, I think the market was weakening here. And you can see the base high, all these base lows here actually lining up pretty close together. And what do we have on the right-hand side of that? We have a tight 2-day range with RMV getting close to zero. Where would you draw your pivot here? You draw it instead of at the highs, you draw it at the lows. So these lows line up extremely close together. That would be your shorting point, and from there you got quick expansion down in just a matter of days from this setup. So RMV can work really well to the downside as well. I do want to emphasize, not all RMV tight signals are created equal. Context and details matter. Again, we're looking for the top half, the 2/3 of the base, first 21 EM pullback, high momentum names, first pullback to the 10 EMA, low volume on the pullback, shakeout, an upside reversal, or other priming setups to set up the breakout. And we want to be part of a larger theme and catalyst, and ideally be a fast mover recent IPO. You can see I've repeated this slide 3 times because it's really important. Context and details matter extreme amount, and the tighter the range, the better. A tight inside day right, the right of the range, that makes the setup that much better, that much more explosive. So all these details are really important, and as you gain more familiarity with trading VCPs and all that, you'll start to pick up on these details that can really make the difference. All right, so let's get into more detail about how to trade these tight areas. So say we've identified it, you've drawn the pivot point, how do you actually trade it? Okay, so there's 3 steps for trading VCPs. First, screening and ideation. You have to actually get the name on your radar and notice that's forming a tight area. And you can use DFU presets, RMV to do that. Then you want to build a focus list with the tightest setups, the most mature bases, near key level, a base pivot or a moving average, and consider other criteria, again, theme, growth, end factor. You basically want to have these ready names on a watch list and then be looking for tight areas, tight entries to trade. Then, once you've identified a range in a stock that meets some of this criteria, showing relative strength as well, you can execute using 1 of 4 entry tactics that we'll get into in just a minute. And to do that, basically what you want to do is set alerts just under the pivot point that we identified. As the stock is pushing through, ideally there's high volume run rate, and we're looking for immediate expansion through, and the best stocks just don't look back and just continue to go and expand higher. So that's in a 3-step process, how to trade these VCPs. So when a stock is forming a tight range, these are all representations of ranges. So picture this as, maybe 3 days of price action that's forming a tight range. The first option of the 4 is to accumulate versus the lows of the range. This is something that RAI does extremely well, especially when there's a whole number as well, 15 that it's pulling back into. You're basically adding a little bit on each time that pulls back to the bottom of the range, and kind of anticipating the breakout from the range. That's a great way to accumulate a nice sizable position while keeping your risk in check by putting your stop a little bit below the range. And if it continues to form that range and then break out, you've got an excellent cost basis and your risk was very, very tight. The second option is to buy tightness anticipation. So again, we've been forming the range for maybe 2, 3, 4 days. Maybe we get an upside reversal and then it recovers the range and then forms a subtle higher low on a lower time frame, maybe at 65 or an hourly, and forms a higher low. You could enter as it's approaching the top of the range and set your stop at the higher low. So this again would be an anticipation setup, expecting the breakout, and that would be the second way to trade this range. The third one, and this is my personal favorite, is trading an undercut and rally of a daily range. So again, this is maybe 2, 3, 4 days of price action. Maybe it forms a range for 2 days, has an inside day, but then fails a breakout and goes below the range, but that intraday recovers that range low. That would be a great spot to manage risk because you can manage risk just below that swing low, and basically anticipate again the breakout, the recovery of the range, and maybe add a little bit more on the breakout, add a little bit more on a higher low, and you're off to the races and have a great cost basis. And this flash in the pan move again gets you at a profit immediately. This is kind of my favorite here. Maybe also we've been forming a range for 2-3 days. We get news, general market news, and there's an overall gap down. Then this could kind of, we gap down below the range and recover through it in the first 5, 10, 30 minutes of the day. That's a great spot to manage risk against, again, versus that low of the day. And that happens a lot with OOPS reversals, which you probably heard me talk about before. So again, this is probably my favorite way to trade ranges. The last way is just the standard range breakout. As it approaches and breaks through the high of the last day or the inside day, you enter. And maybe this is your final ad if you've accumulated a little bit on the prior 3 ways to trade ranges, but this is the more standard way to trade through the highs, the daily highs, and enter and manage risk at the most recent swing low on a lower time frame, or on the low of the day as you enter. So this is the traditional range breakout. So any of those 4 ways work well, and when I put on a trade, I might use a combination of a lot of these. I like using this one when not only do we have the low of the range here, but we have maybe the 10 EMA rising here or the 21 EMA rising here. You've got that confluence, and I might look to build half of my position, maybe a 10% position on this, and then add on a breakout here, another 10, 5, 10% to make it a full position. So that's how I might use a combination of these to build into position. All right. Handling failed tight areas. This is important because they're going to fail. It's just a matter of a rule. That's what the market, what happens in the market sometimes. Here we've got an example with coin. You've got a tight range here. You've got RMV down to 0 that tells you to draw a pivot across. It doesn't really break out here until this day and pushes strong for 2 days and then reverses and stops you out. But when you've got a failed tight area, you really want to stay focused on that stock and see if it sets up again. And sure enough, it does. We've got RMV goes down to 0. We've got a tight area that forms here. And this is a good example of where I draw a pivot, because you've got a wick here, you've got a wick here, and you've got an upside reversal type bar here. That's why I've got the pivot, through this high pretty much, and you re-enter, and then it's off to the races. So don't give up, and don't ignore a stock just because it's had one failed tight area. Keep it on your radar, and if it sets up again another one, that might even work stronger because it shook out a lot of the weak holders. So that's a key thing to remember here. All right, here's an example with Peloton. Again, you've got a tight area that forms off the right hand side of the base. It fails. You set your stop here, and you're stopped out, and it never really resets. And this actually was pretty much the top of Peloton before it dropped out. I actually traded this tight area and reversed, stopped out on this day for a small loss. And thank God I did, because obviously it had a huge drawdown. So that's why it's so important to use stops. And again, my stop is typically, if I'm see it this day, this would be my pivot. My stop as it pushes through is almost always at the low of the day. I might move it up a little bit if I'm in profit even, and I'm stopped out on this day or on the fall through to the downside. And again, it's just a small paper cut, very, very small relative to the potential gain that could arise if I catch a trend and start the position as it begins a new trend, new part of the move. Here's Duolingo. Again, we used this example earlier. You've got a new tight area that forms after this one fails, and after that one is off to the races and a really nice trend. All right, some screens in deep view for tight areas. We've got 2 that are really good. We've got the volatility contraction pattern and tight range one. You can see the criteria here. Basically looking for a high relative strength name that has a tight area, RMV of less than 10, ADR over 2.25%, at least minimum dollar volume, and above the 50 SMA. This one's pretty similar, but just also looking for a particular amount of tightness within that range. And also, if there's a double inside days, those ones are really good as well. So that's why I included that in this tight range screen. And these are presets in deep view that anyone can use. You just search the presets and are able to find that. Also, what's really cool in deep view, and I'll show you guys this in just a minute, is you can combine those screens or a general screen with the mini chart view here in deep view, and basically look through very quickly to see if there's any potential actionable tight areas that you want to click here and then add to your watch list. So that's a really cool one. Also, and this is really how I speed up my workflow in DeepView and looking to find these tight areas, is I'll use the DeepView leader screen, which is my go-to screen. It's like a general growth stock universe screen, and then I'll sort my entire screen results, my watch list, by RMV from lowest to highest. So zeros will be at the top, the tightest names will be at the top, and the expansion will be 100 at the bottom. And then I just spacebar through these and look for any actual tight areas that are setting up within the strong context that I'm looking for, and I'll show you how to do that in just a minute. But before I do that, I just want to have one last ending point. Again, RMV is a fantastic tool that can save you time trading for both swing and position trading, but like with all tools, maximum leverage comes when knowing exactly when and how to use it. What context does it work best in? What types of stocks does it work best in? Choppy traders, it's not going to work that well because there's going to be a lot of failed breakouts. So know when to use it, and hopefully in this presentation, I've helped kind of share a little bit of my experience and my experience with it, so you can use it better right off the bat. All right, so let's actually show in deep view how I use it and how it helps me save time during my daily routines. So here is Core Weave, and actually before I show the routines part of it, I just want to show as well that this is RMV. To adjust the time period, you want to hover over it, go over to the gear icon, and you can change that from 15 to 5, or whatever number you'd like. That's basically change your look back period. And also in deep view, you can see there's some blue dots below it here. We have the technical patterns indicator, and if you go ahead and add that to your charts and check out the gear icon, you can actually drop a dot below the chart whenever RMV gets below a certain amount. So if you don't want to have the RMV graph down here, you just have this whenever RMV gets below 10 or below 5, depending on how sensitive you want it to be. I like 8, that's a good number here. And so you can plot it on your chart basically whenever RMV gets below that. So you can see the strong buy point from this tightness, expansion, and recently we've had tightness again below the 50, and then we expanded down from that level. So just want to show the technical patterns indicator as well. So let's hide that for now and show you my routine. So GV Leaders is my go-to screen. This is basically if I show the criteria, looking for strong relative strength names that are liquid and have strong growth potential. So a great foundational growth stock leader screen. This is my go-to screen that I run every single day. Then on my columns, I've added the RMV value. So you can see AAP will have strong expansion. This went to the downside recently. AGX expansion higher. ECG expansion higher. This is actually on my watch list yesterday. Strong expansion higher. FIX expansion higher. So 100 will be showing expansion to the upside or to the downside. But if we click this column header again, we can sort from lowest to highest. And now what we're seeing is names with RMV at 0, and what you want to do is just spacebar through and look for spots that are in strong context. Again, recent gap up with CENX, now forming a tight range. So this is a little bit more actionable than CCJ. If we go back up, this is forming a tight range over the past few days, but we're already extended in a trend. So I wouldn't be as interested in this. Maybe a swing trader would be drawing a pivot here, and that would be a potential swing trade. But for me, I'm looking for a little bit more of a base here. Dave, tight recently, but a little bit immature of a base, sharp extension down, and still needs to work things out. Grail, a faster mover, tight range. This is more of a swing trade opportunity. I draw my pivot through here. This would be actionable just because it's more of a fast name, and that's why a shorter pattern works a little bit more. KC, expansion higher, tightening, but this is a choppy trader, so I'd ignore it. LEU, tightening, but needs a little bit more time. All right, METC, you've got expansion higher, potential for a swing trade. Let's see how fast this was. Yeah, so this is a really fast mover. So a short amount of time with RMV could be actionable through these highs. And again, I ignore this wick, draw the pivot through here. So you go ahead and draw it. And there you go. Add alert. Create. All right. Let's bring back data panel. ALAB, again, I've drawn this pivot here, but it's just tightening and needs a little bit more days. Roadblock, so again, you still need to do the work. You're never going to not have to do work, but what this does do, it allows you to get the tight ranges here, and then you can consider where the overall context of the tight range is happening. MP, again, recent gap power mover, tightening, a little bit of a setup day here. I've got this pivot already drawn from yesterday because I noticed the RMV 0 yesterday. Draw that pivot, so it's still on my list. Core weave, circle, forming a tight range, but still just a little bit, base bottoming here, so it wouldn't be necessarily on my radar. HIMS, expansion higher, and now tightening here, tight closes. Not necessarily actionable, but potentially looking for reconfirmation. SMDC, and I'm looking for a name that has a more mature base. AVAV, this one very tight closes recently, so I draw the pivot right through these highs. More of a swing trade type setup, and I want it through the high of the upside reversal. I'm looking for one with a more mature base, but we've been trending so long that there isn't really many with the base. All right, this one's okay. So again, tight range recently, RMV was really low recently and it popped through that range, but now it's tightening right on top of that range. So that's actually still valid. And I draw a pivot right through all these highs, and that would be more of a consolidation versus this would be the range pivot. And you can see I did the same thing down here. MedPace, RMV lower just because we've had huge expansion. WDC, yeah, there's not many bases unfortunately to show up the right hand side, but you get the idea. I'm looking for a tight range that's RMV pretty low within the strong context of a VCP type base. And this one, we'll see, it's 5 below, so it doesn't move too fast. But yeah, I basically space bar through this, and I'm going from tightest charts to least tight. We're at 11 now. So as we go through, you'll see more and more expansion recently versus tightness. So as we get to about 25, 30 or so, I actually go through the whole thing because it's a great way to review my chart. But after we get above 25, most of these aren't really actionable from a tight range perspective. Maybe it's a shakeout type setup, but it's not necessarily actionable from a tight range. So that's kind of how I do it, to sort by this column. And then by default, you've got the tightest ranges all the way at top here. So if you're pressed for time, just in 20 minutes, you can get through the tightest charts. And likely that will be 90% of your watch list that you'd want anyway, just in one sort and going through a handful of names. I also want to show that you can go ahead and load the mini chart view of this screen. So now we're looking at the DeFi leader screen, but on the mini chart view, and in settings, you can see I'm sorted by relative measure volatility. So I'm sorting it from lowest to highest already, but basically we can go ahead and X this out. And let me just do last just to show the change. So let's go ahead and choose the data point that we want to sort the mini charts by. So let's go ahead and type in relative, if I can type correctly, measured volatility, 15 days. By default, it typically does highest to lowest. So now we've got the expansion here, but I like to click it and do lowest by highest. And daily, that's good. And now I can just kind of scroll through this, and any names that are interesting, I can go ahead and add to a watch list, test, save. And so now if KC is interesting to me, I can add it, keep scrolling, and basically you can keep doing that and scrolling through and adding any stocks you want to particular watch lists. All right, so that's pretty much what I wanted to show today. So again, thank you so much for tuning in. Hopefully this helps. The concept of finding tight ranges is used throughout market wizards that I've interviewed, and it can be a great, tremendous buy point, as well as just constructive price and volume action. And hopefully I showed today a little bit about how RMV can speed up that process, help you identify it objectively, and trade those tight areas a little bit better. So thank you guys so much for tuning in, and I'll be right back for some closing messages to round off the conference. So thanks so much, and stay tuned. All right, and with that, that's the end of day 6 of the 2025 TraderLion Trading Conference. Hopefully you guys enjoyed all the presentations and got a few great golden nuggets today that can help your trading going into the future. Again, an immense thank you to all the presenters this year. You guys knocked it out of the park. And let us know in the chat right now who was most impactful to you. Which one did you get the most golden nuggets from? And it'd be great to hear your feedback and who you enjoyed the most hearing from. Sometimes it's not who you would expect. I think there was a tremendously diverse set of speakers this year, from day traders to futures traders, swing traders, position traders. There was something for everybody. Investors as well, with Morgan Housel, Brad Freeman. They were fantastic. So again, let us know in the chat right now who you most learned from. And it'll be interesting to see, what were your most important key takeaways. And with that, again, to get the most out of the experience, we highly recommend, if you haven't yet, get access to the free VIP pass. It's 100% free. This gives you access to the recordings all in one place, the bonus resources we're creating, the notes we're creating, and access to free giveaways of TraderLion Masterclasses and DFU. So definitely go ahead and do this. This not only gives you access to this year's material, but also the previous years as well. So it's all in one place for you to study. There's been so many fantastic presentations over the years, and this can really help shorten your learning curve. So again, definitely go ahead and get your free VIP pass if you haven't already. The link is right here if you scan this, or it's also in the description and should be in the chat right now as well. All right. Again, a huge thank you to Ninja Trader Live for sponsoring the conference this year. You can tune into Ninja Trader Live 6 days a week for daily futures trading, real-time market coverage and actionable strategies. You can scan this QR code to learn more. And I highly recommend checking this out if you're a futures trader or just want to learn more about trading. They've got fantastic educators. And you can click the link in the description or in the chat right now to learn more about Ninja Trader Live. Highly recommend checking them out and their YouTube channel. It's a great resource. All right. So with that said, again, a huge thank you to everybody who's read and picked up a copy of the Trader's Handbook. If you haven't yet, I recommend doing so shortly. It's currently on sale, 25% off on Amazon. Not sure how long that will last. That's something that Amazon controls, not us. So take advantage of it while it lasts. And you can scan this QR code to pick it up. We're rated 4.9 stars with over 400 reviews, over 13,000 readers as well. Amazing feedback that we've heard. And I really think this is a resource that can help out a lot of traders out there as they build and refine their trading system. Here's a review from Stan Weinstein himself. The Trader's Handbook is a clear, no-nonsense resource for anyone serious about improving their trading. It's rooted in common sense, sound technical principles, and most importantly, discipline. The authors focus on price action, trends, risk management, and teach you how to build a real process, not just chase opinions. It's a practical book that respects and emphasizes the core truth that the tape tells all. I recommend that you pick up a copy for your trading library. So again, if you haven't yet, go ahead and pick up a book, a copy of this resource. This gives you access to the free educational resource that's on TraderLion.com that houses bonus webinars, bonus resources, bonus model books as well. So again, you're not just unlocking a book, it's kind of your ticket to a whole suite of tools that can help you level up as a trader. So again, take advantage of the sale that's currently on right now at Amazon. If you haven't already yet picked a copy, go ahead and grab yours. And if you've already picked up one, it's a great time to grab another to share with a friend or gift later on. So again, huge thank you to all the readers. Let us know what you think in the chat right now if you've picked up your copy. And if you haven't yet, don't wait. Go ahead and take advantage of that sale. All right. So with that said, a heartfelt thank you to everybody who's been involved this year in the conference. This includes the viewers, the audience, you guys, as well as our fantastic presenters. They were great. As I mentioned before, such a diverse group of market wizards, top traders, top investors, top educators that each shared bits and pieces of their system that you can take and make your own. And I think, again, this is one of the best resources out there for traders to learn how to trade for real with risk management, the right principles, all of that. So again, hopefully you guys have gotten a lot of great takeaways from this year. Let us know what you think in the chat. Again, a huge thank you to the audience members. We couldn't do this without you. And again, a huge thank you to our presenters who are absolutely fantastic. So go ahead, pick up that free VIP pass, study this conference, watch the presentations that really resonate with you a couple times. Take notes, each time, revisit it 3 months later, and you'll learn even more from them. And also, if you haven't yet, and this is your first year watching, it's amazing how so many of you who have tuned in, this is actually your first conference that you've seen. There's so many great presentations in all the previous years that you can go back and revisit and study. Absolutely fantastic knowledge that's being shared. So again, I think this is the best resource out there, 100% free for traders that can help shorten their learning curves. So go ahead and make use of it. Don't just watch the conference, take notes as you go. And also don't forget to apply the concepts to your actual trading. That's the way to go. You don't want to passively learn. You want to actually study it and apply it. So again, a huge thank you to everybody. This has been another fantastic year of the conference. I look forward to seeing you guys next year for the next great event. But until then, thanks so much for tuning in. Leave a like down below in the stream if you've enjoyed. Subscribe if you're new to the channel, and we'll see you guys shortly.